now notches another all-time high and a closing record. Okay.
So they just about bought around 69.45 crores. DIIs net bought around 1174 odd crores. Now, in terms of overnight global cues, the US markets closed lower. The AI impact on the financial sector as well as the consumer spending data weighed on sentiment there. So do watch out for that trickling in terms of a couple of, the AI impact on the Indian equities as well, as that continues to be in focus. Asia is largely higher in today's trading session. Result reactions, we have Apollo Hospitals, Titan, Britannia, Eicher Motors, Jubilant FoodWorks to watch out for in terms of result reactions. And in terms of cues, we have the US January non-farm payrolls data. So that will be critical to watch out for from the US. Besides that, we have Ashok Leyland, Divi's Labs, IOL Chemicals, all of these stocks which will be reporting numbers back home as we close out the earnings season for Q3.
Okay, thank you so much for that, Ekta. But in the final update that we have for you all today, Sudarshan is joining us to give us what we should watch out for in terms of the FNO data. Good morning, Sudarshan.
Good morning, Vinny. So yesterday we had talked about that Nifty is facing resistance around 26,000 level, and that's what we have seen through the day, that from the level around 26,000 Nifty has slipped again. But till the time it remains above 25,790, that's the 50-day moving average, we can see only one side move, that is the upside. And now the door for the record high for Nifty has already opened. And if you go by the GIFT Nifty today, it's indicating that in all probability Nifty is going to open above 26,000. Now coming to the put call ratio, it has increased further. Yesterday it was at 1.20 versus 1.11 that we had seen on Monday. It's indicating you that put writing continues in the range of 25,800 to 25,900. That's the reason 25 contracts on the long side. Now their longs exposure has increased data 25,900 and 25,800 put options have seen 25,790 resistance. First resistance would be around, has been seeing fresh longs, and Aurobindo Pharma, there is a
Much for that, Sud, but wait on because Eminem is
family.
Welcome back to Power Breakfast on CNBC TV 18. Now let's get an update in terms of what happened in the US market. The S&P 500 that slipped on Tuesday as investors reacted to weaker than expected retail sales data. The broad-based index lost 0.33% at close. The Nasdaq Composite slid over 0.5%, while the Dow Jones rose 52 points to post a record close. Let's go across to CNBC's Steve Kowak, who's here to give us a wrap on what happened on Wall Street.
U.S. markets were mixed across the major indexes in Tuesday trading, with the Dow hitting another all-time high. The Dow rose 52 points, the S&P 500 dropped 23 points, and the Nasdaq lost 136 points. December retail sales were released Monday and showed unexpected weakness at the end of the year, with sales flat compared to November. The holiday shopping season slowed amid bad weather, the impact of tariffs, and persistently higher inflation. That's according to the Commerce Department, as households cut back spending on big-ticket items, potentially putting the economy on a slower growth path for the rest of this year. That downbeat report ended an otherwise solid year of retail sales. For a big change in U.S. climate policy, the EPA are a threat to public health in the United States. That finds what's happening in the U.S.
Thanks for staying tuned into Power Breakfast in CNBC TV 18. Now it's time to get you the latest update in the world of commodities. And we have Manisha Gupta joining in with us as always. Good morning, Manisha. And, the geopolitical tensions, uncertainties, US-Iran talks, that's continuing. What are we keeping an eye out on today?
Well, all of those factors that you mentioned on, Vineet, is the crude oil prices which continue to trade firm, just about flirting with that $70 a barrel mark. Well, EIA also says that we've seen $67 a barrel of an average for the month of January. Now, even as US and Iran are having their conversations, there are reports that US is building military presence in Middle East if these talks fail, and that is what is keeping the premium in case of prices. Having said that, the cold weather has boosted heating demand in the West, and that has taken the natural gas prices also on the higher side. So whether it is about crude oil or crude oil products, almost everything seems to be trading in the positive for 2026. What isn't been doing well has been the base metal prices. With China heading into the Lunar New Year holidays from this weekend onwards, you're looking at lesser buying from there. Also, there is rising inventories in the major trading hubs. So whether it's LME, Shanghai, CME, we are looking at inventories rising for copper and aluminum. So both of these commodities are off the kind of highs that we saw in the month of January. What has continued to do well, though, has been the gold prices today. With the U.S. retail sales data coming in softer, and now the market's waiting for U.S. payrolls data that comes in today, the U.S. inflation data that comes in on Friday. So ahead of these numbers, there's a bit of a choppiness and some safe haven buying returning in case of gold.
Okay, Manisha, thank you so much for that. But on that note, we actually are absolutely out of time in this edition of Power Breakfast on CNBC TV 18. Thank you so much for tuning in. Up next, we Bazaar Morning Call.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. It's a Wednesday morning, middle of the week. Markets, of course, have done well last two sessions. We'll see what happens. Last night, Q's not all that great. I'm Prashant. With me, my colleagues Rima and Nigel. Guys, good morning.
Hi, good morning. So no decisive moves coming in from the global markets. So I guess it will be all about individual stocks. All the big four earnings, Nifty earnings that we were expecting came post-market hours. And today is going to be another earnings-heavy day with Eminem, Ashok Leyland coming out with the results.
Point well taken, Dreama, but I think the bigger action really is in the broader markets because that suddenly come back to life. And the big outperformance you've seen the last few trading sessions, if that continues, people will be feeling good because for the last 18 months or so, you had the headline index that was holding steady, but the mid-caps were under pressure. And now that's reversing a little bit. So hope that continues.
And I think a lot of people will be, even if the Nifty doesn't go anywhere.
That's okay.
I think broader markets doing well makes a lot of difference. Well, let's just take a quick look at the limited Qs we have, actually, if I can put it that way. Not very much, right? US equities kind of ending sideways, slightly lower. NASDAQ down about 0.6%. And, it's every day there is something new with regards to AI anxiety. So it was software stocks last week. Beginning of this week, it was insurance brokers. Last night, it was wealth management firms, which sold off. So financials as a space was under pressure. Morgan Stanley, for example, was down 3-4%. A bunch of other names. Charles Schwab, of course, is the leader there, and that was down about 8% or so. So, these are newer models, specialist models which are being built on top of large language models like ChatGPT. They're being released out there in the market, you're seeing the market starting to worry about whether some of these business models are going to come under threat. Sometimes it is not really that significant, and because the overarching theme, which is real, is AI and what AI will do to various industries over a period of time. I guess what's also happening is that people are shooting first and asking questions later because you sort of in a way put one headline and take that and put that on top of one entire industry, and it's that kind of thing because people are just trying to figure out how fast are things moving and what is the actual impact of all of this new technology and the specialist kind of models going to be on things like, as I said, insurance broking, wealth management, and of course, enterprise software as well. Now, retail sales, if I can talk about that, unexpectedly stalled in December. And of course, the implication of that is the market is going to resume rate cuts on the back of this. President Trump, of course, wants rate cuts. But you've got two gentlemen, both hawks, I must say, from the Federal Reserve, who spoke last night in favor of rates being kept unchanged, right? But those are both have been historically hawks. Anyway, the 10-year yield fell about 6 basis points to 4.14. So that clearly responding to the weaker retail sales number. And of course, what that implies in terms of data. Later today in the evening, we will get the US jobs report. And I think that's going to be important. Remember, President Trump's team, last, of course, was Kevin Hassett. They've been trying to get people up to speed with the idea that maybe the jobs number is not going to be all that great. Do you remember that comment that the job numbers perhaps going forward in months ahead could be weaker, but that's because of population degrowth? So I would assume, comments like that are just getting the market ready for perhaps what is going to be a weaker data set. We'll see if that really is the case, and the number usually comes around market open. Now, with regards to oil prices did not move, but you had two things here. So Oman essentially saying, the foreign minister is saying discussions between U.S. With regards to Iran, U.S. last week were productive, but Trump essentially said that he might send a second carrier to strike Iran if talks fail. So it could be carrot and stick. It could be just pressure, building up pressure more than anything else. But prices did not move. But there is a bit of buoyancy there in oil prices. Now, I'll just tie in the levels here. So, as I said, Monday, of course, was great. Yesterday was good. What will today hold? So, if you look at the price action yesterday, the opening and the closing are pretty much around the same levels. typically that would indicate a bit of a loss of momentum. The high yesterday was almost at the level we put out yesterday, which is 26,020. That is basically the midpoint of the big bar that we saw 3 days back. So we almost got to 2620, and then the market opens, and then finally sort of closes around those same levels. So it's just a question at this stage. As the market moves, losing a bit of momentum, we'll see. Supports remain the same, unchanged. The gap zone is 25,450 to about 25,640. I think today there's so many earnings which have come through from last night, and large numbers, big numbers. So we'll spend a lot of time through the course of the day to decipher some of that as the day goes on. GIFT Nifty, I think, is still indicative of a slightly higher open, 50, 60 odd points. It's not bad at all. So 26,052 is the indicative open as far as GIFT Nifty is concerned. Positioning and what did funds and institutions do yesterday? Nigel has walked across to the wall for an explanation. Nigel, over to you.
Well, part of the reason that the Nifty came off yesterday's high was, in fact, it was the weekly expiry as well. So that was the factor that did play out. And that's why towards the end of trade, you did see the Nifty slip a little bit. In terms of flows, the DIs, they bought large, close to 1,000 crores. And the FIs didn't sell. That's pretty good news, right? Even if they don't buy big, you don't want them to sell, because that's been plaguing the market over the last 12 to around 18 months. But covering was evident, both on the Nifty as well as on the Nifty Bank. You had them end, higher yesterday, and you had the open interest that was lower. So there were signs that there was a bit of short covering that did take place, and that perfectly tied in, because you pull up the FI net short number, in trade yesterday, you had the shorts that covered out close to around 5,800 contracts, and now the short position has come down to around 78% or thereabouts. And the power of short covering really has been on display, because the FI short positions, just in the last few trading sessions, it's down by close to around 65,000 contracts is what we've seen out there. While the Nifty, well, it's popped up close to around 1,100 points. So the power of short covering is on display. And I've been repeatedly saying this. A net short market actually could be a blessing disguise. And that's precisely what's happened in the last few days, going by the bounce we have seen and the kind of short covering that we're seeing. Clients, they are net long. Yes, they continue to remain net long. But they have unwound close to around 50,000 contracts in the similar period between February 1st as well as in yesterday's trading session. So long, but gradually they are booking some profits, because they were doing the counter, they were going against the trend at that point of time, and now they're booking some profits. The PCR, well, it's holding at around 1.2, and there were signs of writing, both at the 26,000 call as well as the 25,900 call. And out there, if you look at the premium on the 26,000 call, it's more than 120 rupees or thereabouts. There were signs of writing out there, while on the put as well, 110 rupees out there. So just to tie in the levels, the near-term resistance comes in at around the 26,100 odd mark, going by the options data. Yesterday, the 26,000 mark was resisted, so we'll have to keep an eye out on that. And support is at ballpark around 25,700. First reference point around the 50 DMA as well. The Nifty Bank went through a bit of consolidation yesterday, but remember, it has support at around the 20 as well as the 50 DMA. That comes in at around that 59,400 to around 59,500 odd mark. That's about the headline index. But I think the best part about the last few trading sessions is the way the broader markets have outperformed. Even in yesterday's trade, you had more number of stocks advancing than declining. You'll want more amount the same. Even if the headline index needs to consolidate, you'll want the broader markets to participate, because that's what makes your portfolios feel good. Otherwise, we're in a good space, I think.
Thank you very much for that. Let's straight away address the global markets where we're headed. Drew Pettit, Director, U.S. Equity Strategy at Citi, is now joining in. Drew, the latest AI fear to grip the markets is the potential disruption to financial advisory companies, wealth management, tax planning companies. And we saw that in the stock price. Charles Schwab was down 7-8%. LPL Financial got crushed yesterday. How big a disruption is it? Is it just preemptive de-risking, as Prashant put it? Shoot first and then ask questions later. How are you all analyzing the impact on financial services companies?
Yeah, it's funny. I'm going to take this back to the software discussion and just AI disruption in general. It's not about the near-term earnings. Financials looked really good during earnings season. Software stocks before that looked really good during earnings season, and actually had numbers revised up for the full year and even next year. When we have disruption, when there's new tech and innovation in any industry, it's a problem out in the future. It is what we call a terminal multiple problem. So for software to sell off 20% from its highs, over the past 6 months, it really just took a couple multiple turns out of the terminal multiple. So instead of putting, let's call it a 26 PE on software stocks in 3 years' time, you put a 24 PE on them, and guess what? You have a pretty aggressive sell-off. The same thing could be said of financials today. So again, investors are assessing that long-term risk, but it has a really large impact on values today.
Yeah, so Drew, overdone or not?
I think in software, yes. The way I think about this is if I de-risk the terminal multiple and I stop trading stocks or buying stocks that have to go up because I'm going to put a bigger PE on them in the future and really de-risk that, take that down, make the story not about the multiple going higher, then I feel better. So again, we're dip buyers in software. We still like owning cyclical risk, but understand that no risk, whether it's on the growth side of the market or the cyclical side of the market in the US, is cheap right now. So we want to be barbelled. We want to own both so we can manage these really aggressive rotations from one area to the next.
Hi, Drew. Good to see you, Ben. How are you approaching equity markets, though? You know, the developed markets, the mother market, the US market actually has outperformed. At current reckoning, how would you approach global equities between developed markets and emerging markets? And I think in the past you've mentioned that India could be one of the preferred emerging markets. You stick by that?
So we're talking about diversification. So the story we're telling in the US around buy growth and buy cyclicals, we like risk, we like beta. So don't buy GDP plus companies, but don't buy defensives, buy diversified types of risk. That story is the exact same one we're telling globally. We're overweight emerging markets. We like Japan. We're neutral on the United States. And then we're underweight UK and Australia, a little bit kind of less risk, a little bit less cyclicality in those markets. The broadening trade and different opportunities in cyclicals and growth is how we want to position, whether it's in the US or globally. And on India specifically, look, we've been neutral on India within our EM overweight, but we totally understand that the trade news recently can definitely bolster sentiment. It could bolster flows. You could see some more positive action from the FIIs. India's been underweight in a lot of emerging market portfolios. General, we like being there, but we still like some other markets like Taiwan and South Korea a little bit more right now.
So neutral on India in the emerging market basket, Drew, but is there a case to upgrade India?
We'll see. That's something we'll have to talk about in our next global discussion. We tend to look at these things on a quarterly basis. But to us, when we're thinking about any emerging market in this environment right now, it's all about the revision trend. So we'll see how the trade news and earnings season plays out. As revisions shift, that tends to be our focus globally, including in emerging markets.
Yeah. Drew, any other strong sort of views across assets? I mean, so much has happened, right? Gold and silver and oil is, of course, another one. What's any strong views here?
Get some sleep while you can, because the news cycles just keep coming faster and faster, and you see these little pockets of volatility everywhere. But honestly, from a diversification standpoint and from an investor reaction standpoint, what we're seeing is people actually buying more international equities against this backdrop, against volatility in commodities, flows there decelerated. Fixed income's been a really good holding place. Again, diversified fixed income exposure. People are buying different types of credit. It's not just treasuries and safe plays. And then on the equity side, look, I think this is a really important talking point. U.S. investors bought more international equities than they bought home country equities and ETFs in January for the first time in almost 3 years. So you're starting to see global diversification on the equity side play out in a lot of U.S. portfolios right now.
Yeah. Drew, we'll leave it there. Thank you very much for joining us. Get some sleep. I think that's the wise words. But we're starting our day, you're ending yours, and look forward to our next one. Thank you very much for joining us here on CNBC TV 18. Well, let me just quickly run you through interactions which are lined up here on the program. 8:35, we've got the management of Balrampur Chini joining us to discuss their third quarter numbers. 9 o'clock, Vishal Manchanda of Systematics Group to talk about developments in the pharma space. 9:20, Shreyas Devalkar of Axis Mutual Fund will be a market master of the day. 9:30, Apollo Hospitals joins us to discuss their December quarter performance. The management of Titan will be speaking with us at 9:40 on third quarter. 9:50 we'll be speaking with Samvardhana Madison on their third quarter earnings. Oil India. It's a long list of companies. Oil India management at 10 o'clock to talk about earnings, and towards the end of the program, Lata talks about the trade deal and its impact on the rupee, India's macro. Santanu Sengupta and Arup Rakshit join her for that.
Time to slip into a quick break. A lot of stock-specific action to track for you. Get at that in just a bit in our special Top 10 segment. We're looking at Titan, Apollo Hospitals, Britannia, Eicher Motors, Jubilant Food, United Breweries, Torrent Power, as well as Aether Energy. All of them will be reacting to positive news flow, while BHAL and Auto Pharma will be reacting to negative news flow.
Good morning. You're watching Bazaar Morning Call. It's a Wednesday morning. The GIFT Nifty is trading with a positive bias, but we've got a heavy slate of corporate earnings and news to react to today. So let's straight away get to the action with our research team. This is CNBC TV 18's list of top stocks for the day. And the big one is going to be Titan. Vinny, how did the numbers look?
So as expected, it's a good set of numbers that's coming from Titan. Better than what the street was expecting as well. Revenue growth 40%. Obviously, that we had in the Q3 update as well. But 40% revenue growth. EBITDA is grown 55%. Margins have seen an improvement of 100 basis points. 10.4% is what the EBITDA margin stands at. And there's an exceptional loss this time of 138 crores. So profits now are at 48% growth on a year-on-year basis. Now, what was good? Obviously, EBITDA, that was better than what the poll was. Jewelry EBIT margin, that is also coming at 10.6% versus 9.5%. So the bigger segment is doing well for the company. And overall, a started ratio 26% versus 28%. New buyer share, that has seen an increase. That's at 45% as well. CaratLane seeing good growth of 42.3% on a year-on-year basis. And the jewelry market share continues to be at 8%. We're expecting green for the stock today. Con call is underway. We'll get some key updates there as well.
Okay, all right. Thanks a lot for that, Vinny. Let's hop across to Ekta. She's here to tell us about Apollo Hospitals. Morning, Ekta.
Morning. Well, better than expected set of numbers. The revenue was up around 17%. The street was expecting around an 11% growth. The margins also came in at around 15% and the profit at around 516 crores. Now, it was firing on all three cylinders. So Apollo Healthco, which is basically the pharmacy plus Apollo 24/7, the revenue was up 20% this quarter. Lowest ever digital cash loss is what they incurred this time at around 29 crores. Hospitals, which is basically the bulk of the business, Q3 revenue was up 14%, margins at 24.8%, which was up 73 basis points year on year. And Apollo Health and Lifestyle, which is basically the retail and diagnostics business, revenue was up around 20% there as well. There's a call taking place at 2 p.m., but I expect the stock to be in the green today.
Thank you very much for that. Big day for FMCG numbers. Vinny, back to you for Britannia.
Britannia also, again, a good set of numbers coming in from the company. So a good day that we're expecting from Britannia. Revenue growth in line with expectations. EBITDA margins have seen a good expansion on a year-on-year basis. Around 130 basis point expansion in terms of EBITDA margins. Gross margins, also good improvement there. Profits of the company, 17% growth. The company has said that, in October, there's some disruption by GST transition. Business over there grew by 12%, and in November and December, they saw better growths coming in. So yes, disruption in October, November, December, 12% growth. Healthy growth mainly was driven by momentum across biscuits and adjacent categories, and they saw a relatively stable commodity environment. So that's a positive for Britannia. All in all, good numbers. Green expected here as well.
All right, Vinny, thank you very much once again. Eicher Motors is the next one we're going to focus on. Surya's got details on this one. So, good morning.
Morning, Prashant. So, if you remember, 2 years ago, there were talks about competition and everything, and then Eicher Motors had changed its focus to growth over margin. Now, even margin is back, and it has come at a 5-quarter high. For the first time after several quarters, margin has come in about 25%. And on the volume front, there has never been any complaint as far as Eicher Motors is concerned. Volumes in the Q3, Royal Enfield volumes were up 21% year-on-year. Even commercial vehicle volumes have increased by 24%. And with all-round performance, revenue has increased by 23%. EBITDA too has seen an increase of 30%. And margin has come in at 25.5% versus 24.2%. And after several quarters, EBITDA growth has been higher than revenue growth and the volume growth for the company. What's going forward? In Q4, company is saying that trend will continue, strong trend will continue, and even in FY27 for the industry, the growth is seen in high single digit. And on the market share front, company continues to gain the market share in the mid-size segment, and the exit market share in the mid-size in Q3 FY26 was almost 89%. And considering all the factors, I'm going with green for Eicher Motors.
Okay, all right. Sir, thanks a lot. And they're going ahead and increasing capacity as well. So great news for, buyers as well. Thanks a lot for that. Well, let's go back to Vinny. She's having a busy morning. Vinny, tell us about Jubilant FoodWorks as well as United Breweries. What a combination.
Absolutely. I think you should order both for me this afternoon. I'm waiting for that. But Jubilant FoodWorks, good set of numbers come from the company. Strong operational performance. So overall, when you're looking at the EBITDA margins, around 100 basis point, more than that expansion in terms of EBITDA margins on a year-on-year basis. Overall, revenue seen a growth of 12%, profits a 31% growth there as well. Domino's like-for-like growth, that's coming at 5%. And do not forget, this is the 8th consecutive quarter that we're seeing positive like-for-like growth for Domino's. Popeyes also has seen a record high double-digit like-for-like growth. So good performance coming in from their brands as well. And overall, green expected here. United Breweries, again, good numbers come from the company. Strong internals that have come in. Revenue growth that is coming at 3.6%. Volumes, bit muted. Negative 1.3% is there. So we're seeing a bit of a decline there. Pricing mix and cost initiatives have led to an improvement in terms of gross margins by around 200 basis points. Overall, EBITDA margins have seen a sharp improvement of more than 300 basis points. 10.9% is now what the EBITDA margin stands at. There is obviously a bit of an exceptional loss that's come in this time of 18 crores versus last year also there was an exceptional loss of 25 crores. So watch out for that. And overall, operationally, performance has been strong. Top line a bit muted, but nonetheless a growth that we're seeing over there, and all in all, green expected here as well.
Okay, all right, Vinny, I know I've got a lot of messages that have already come in. If you're going to be buying pizza as well as beer, and Vinny's part of the plan, a lot of people want to be part of it. So, we'll deal with that a little later, Vinny. You're in demand. Thanks a lot for joining in.
Thanks.
Well, let's hop across to Sudarshan. Sudarshan, BHEL as well as Eicher, some supply coming into the market. Tell us more.
That's correct. So for Eicher Energy, we are expecting a block deal of around 1.92% equity. It's going to be a clean out trade from National Investment Infrastructure Fund. And this 1.92% equity is worth around 534 crore rupees. And price range is seen at 706 to 728 rupees per share. That would be a discount up to 3% to yesterday's close. But because of the clean out trade, I'm going with Eicher Energy. As far as the demand for Eicher Energy is concerned, vehicle demand, it remains strong. It continues to be at the number 3 as far as the electric two-wheeler is concerned. For BHEL, I'm going with red. Government is looking to sell up to 5% equity via OFS, and base size is 3% equity. And if it exercises the green shoe option, there would be another 2% equity. And this 5% equity is worth around rupees 4,420 crore, and floor price is rupees 254 rupees per share, which is a 8% discount to current market price. And for non-retail portion, OFS opens today, and for retail portion, OFS opens tomorrow. And because of the 8% discount, I'm going with red for BHEL.
All right, thanks very much for that. That's BHEL for you. Aurobindo, of course, was the top Nifty loser yesterday. Ekta is here with more details. Ekta, morning.
Morning. Well, the news is that their Unit 7, which is basically their Jed Sherla unit, has been inspected by the US FDA and issued 9 observations. It was inspected from Jan 28 to Feb 10. The company, however, has categorically said that the observations are procedural, and this is what they have indicated about the 11 observations they just got a few days ago for their UGR Unit 3 as well. They had mentioned this in their conference call, that those observations are procedural and they should see resolution on that. Now, remember that it also reacted to its numbers and conference call takeaways yesterday. So brokerages have come out this morning based on earnings. CLSA maintains an outperform with the target price raised to 1370, and DAM Capital has a buy with the target price of 1513.
Got it. Okay, all right. Thanks a lot for that, Ekta. Well, I'm looking at Torrent Power, and those numbers, actually, there was a bit of an improvement. If you're looking at the top line, a mild improvement out there. But what was heartening was that the margins, that came in at around 20%. That compares with around 17%. And the net profit number as well looked quite good. The Q3 really was aided by increase in contribution from the gas-based power plants, the improvement in license as well as franchise distribution businesses, and also the improved operational performance from the renewable energy segment. So put that together, explains why things looked quite good. The operational capacity is estimated now to grow to around 10.6 gigawatts. So all in all, the numbers look quite good. Operational performance good. Commentary as well fairly okay. Going with green on that one. Well, let's do a quick recap of all the top stocks we discussed. The stocks with positive news flow: Titan, Apollo Hospitals, Britannia, Eicher Motors, Jubilant Food, United Breweries, Torrent Power, and Eicher Energy. While stocks with negative news flow include BHEL and Oro Pharma. That's about equities. Well, let's turn our attention to the commodity space. Manisha Gupta joins in early this morning to tell us what's going on there. Hey, Manisha, morning.
Morning, Nigel. Thank you for that. I'll start with gold, which is trading firm, and this is on the back of weak or softer U.S. retail sales numbers. The markets do believe that a rate cut is not too far away. And then there is focus, of course, on the U.S. payroll data that comes in today and the inflation numbers from U.S. that comes in on Friday. Gold is holding well above $5,000 an ounce. What has seen a bit of a profit taking, though, has been metals, including silver, which is just about holding $81 an ounce. With China heading to Lunar New Year holidays, you've seen buying from China kind of decline. And then there is rising inventories in major trading hubs across LME, CME, and Shanghai weighing onto the market. So copper is just about holding $13,000 a ton. Remember, it did hit an all-time high of $14,500 in the last week of January. Aluminum and zinc can also have come off its three-year highs. What is holding firm really is the crude oil prices, though, because even as the U.S. and Iran talks continue, the U.S. is building military presence in Middle East, saying that if the talks fail, this is going to be the next step there. The street is also looking at the U.S. natural gas inventories continue to declining. The cold weather has boosted heating oil demand in the Western world. So whether it's about crude oil, crude products, almost everything seems to be doing positive.
Thank you very much for that, Manisha. We will get into a break. On the other side, we'll get chatting with the management of Balrampur Chini on the other side on their Q3 numbers. Stay tuned.
Welcome back and hope you're having a good morning. Well, Balrampur Chini Mills, that's the first management on the show. It reported actually a strong set of numbers in Q3, driven by higher volumes as well as realizations in the sugar and the distillery division. To help us out with the past quarter and more importantly, the way ahead, we're joined by Mr. Pramod Patwari, the CFO of the company. Hi, Mr. Patwari. Always good speaking to you. It's been a while since we chatted. Well, let's take a couple of aspects out of the way first. Sugar production actually is relatively lower against the bumper crop that was expected earlier. Could you tell me what's the outlook on sugar prices from here on?
Yeah, against the initial estimates of sugar production, currently we are of the view that gross sugar production can be in the region of around 32.5 million ton.
Okay.
And on the basis of ethanol tender which had happened, looks like diversion will be around 3.5 to 3.7 million ton. On that basis, net production is expected to be around 28.8 million ton in our view. Against this, taking into consideration the 4 lakh tons of export contracts which had already happened and the domestic consumption, we see a total utilization of inventory through exports and domestic consumption to the tune of around 29.2 million ton. So this will result into a slightly eating away from the opening inventory of 5 million ton. So currently we are selling sugar in UP in the region of around 41 to 41.5 per kg. And this is during the midst of a peak crushing season. So looks like as far as this season is concerned, we have already seen the bottom of sugar prices. From here on, we are not seeing any runaway in the sugar prices, but the trajectory will be positive only.
Okay, got it. The other point, sir, is that, higher sugar cane or the SAP impact will be seen from the next quarter. In that case, how do you maintain the profitability in Q4?
So we have seen an increase in SAP by 30 rupees per quintal in UP. So the impact of this is normally seen over 2 financial years. Around 30 to 35% of impact is seen in the ongoing financial year, which would be FY 25-26, and the rest will be seen in the next year. But we at Balrampur, we are sensing an increase in the cane availability of say around 5 to 6%. This will help in absorbing the fixed overheads better. We are also hopeful of achieving a slightly better recovery, maybe around 8-10 basis points. This will also help in arresting the cost of production. On top of it, as we have said that there will be an increase in the sugar prices on a comparative basis, what we achieved last year. All this will help in largely mitigating the impact of the sugarcane price increase.
So what about on ethanol prices? Ethanol procurement prices have not gone up, and that is putting pressure on your distillery margins. What is the outlook on that? And at this price, considering that, the sugarcane SAP price has gone up, as you said, by 30, does it still make sense to divert towards ethanol? What is the mix going to be?
Yeah, you are right, Rima. We have seen an increase in FRP by 16.5% in last 3 years. And against this, we have not seen any increase in the ethanol prices. This is really surprising. But in the overall scheme of things, we at Balrampur still believe that as far as this season is concerned, it is better and wiser to make use of juice heavy as well as B heavy route ethanol production. Going forward, revision in the ethanol prices will be extremely crucial to decide whether anyone will operate ethanol facilities under sugarcane juice or not.
Okay. All right. Let's focus on the way ahead then. The PLA. Could you tell us, is there a strong market for the product that you're going to be launching? And I think you're looking at Q3 of FY27. So what kind of revenue potential do we see for that one quarter in FY27? And then FY28 onwards, how much can PLA contribute to your entire basket?
Yes, Nigel, we are looking at Q3 of FY27, wherein we are expecting the commercialization of PLA to happen.
Yes.
This will be the first time that we will be doing this project. So I really don't know how much time it will take in stabilization. It can happen in 1 month, it can happen in 2 months. So for FY27, we are not building up a very large revenue from the PLA segment. But for FY28, we are hoping that our entire capacity would be utilized.
FY28. Okay. And what is the optimum levels of revenue? 2,000 crores, right?
That's the peak revenue potential.
FY28. Got that. And the market is there, right, for this product?
Yeah, market is there. See, a lot of imports are happening as of now. It is very difficult to quantify because the PLA is coming in knit form as well as in the finished form.
Okay.
So HSN-wise code capturing data is not happening as of now. But we are in touch with more than 150, 170 customers. For institution, we are in touch with railways, temples. So we are hopeful of achieving our capacity. And the most interesting part at this point in time is PMO has initiated a development of sachet for pan masala and gutka. So that is very encouraging.
Yeah. Right. Pramod, hi. Morning. Prashant here. You know, my colleagues have asked all the serious questions, so let me ask a non-serious question.
Yeah.
You know, you saw that headline, GLP-1 drugs are going to save the airline industry some $700 million. Did you see that? There was a headline.
No.
Basically, people are going to lose weight and airlines are going to be able to carry more people. I mean, I think that was the interpretation. I'm talking about the Ozempics and the Mounjaros of the world, right? There's also research now, more and more research which is coming in, which shows that wider adoption of all these GLP drugs. By the way, Mounjaro is already the top-selling drug in India, medicine in India, leads to some 60-65% reduction in sugar consumption. Sugary stuff. I don't know. I mean, this all seems like far into the future and that kind of stuff. But have you guys seen this? And what is the institutional sales for you at Balrampur?
So at a country level, the institutional sales is around 65%, and the direct consumption in the form of household consumption is around 33%.
Right.
So Prashant, just to add something on this kind of news, we have seen this kind of news all along, and we continue to survive in this kind of environment. Population with a increasing population, increasing in the prosperity of the people, increase in the change in the lifestyle, economic development. So there will be some tapering of demand in the form of health consciousness, alternative sweeteners, and the stuff
on the institutional side, which is 60-65% of your business, there has been no demand. There's no. I mean, it's doing well, right? There's nothing.
So we are still sensing an increase in demand to the extent of, I would say, 1.5% on a CAGR basis.
Okay.
In spite of all these adversities.
Okay, got that. Thank you very much, Pramod.
Thank you.
Sorry for that googly off tangent, but I thought should ask you since we have you. Appreciate it. Well, I think we'll take a quick commercial break here. We're going to come back in just a bit from now, and we will connect with Rahul Arora, CEO at Ashika Institutional Equities, for some fundamental stock conversation. Stay tuned. Coming up.
Fractal.
I just want to quickly point out what the GIFT Nifty is starting at this point in time. And it's about, 73, 74 odd points in the green, 26,060. Rahul Arora is with us, CEO at Ashika Institutional Equities. Rahul, good morning. And I guess I should say congratulations are in order. So after a long stint at Nirmal Bang, you've moved on to Ashika. So wish you all the best of luck. Markets, of course, have started 26 on pretty much a frenzied note, at least globally. Here it's been more slow, not so slow in the last 7 days with India, US, and all these other things which have come in. But what's your sense, Rahul, the broader, sort of bigger view for markets from here on?
Good morning, Prashant. Thank you for having me on and appreciate the wishes. Thank you so much for that. So I think, Prashant, if you look at it, see, at the end of the day, liquidity drives markets. We have domestic liquidity and you have foreign liquidity. Now, let's look at FY27 as a case point. We're expecting consensus earnings at about 12-13%. So if I'm an FII looking into India at that 12-13%, I'm starting off minus 3-4% on currency depreciation any which ways. I think the fiscal has been projected at 4.3% for next year. And the tax projections are a bit somber as well. So there will be a slight concern on that rupee depreciation at the back of the foreigner's mind. Add to that about 12.5% LTCG and maybe 1.5-2% inflation in their country. You're basically talking about if you're expecting the market returns to be same as earnings growth at 12-13%, you're talking about post these adjustments about 5.5-6%. I'm getting the US 10-year at about 4.5%, which is a very safe asset. So just for 100 basis points, why take the trouble in investing in a market like India? So that could be one school of thought as to why it's been so difficult for India to attract FI flows for quite some time. And that same logic, Prashant, would hold for DIIs because you just replace the rupee depreciation by your domestic inflation. And then you have fixed deposit rates at about 7%. Most of the people would be taxed at about 20%. So you're talking about 5.6% post-tax on a fixed deposit. Again, for 100-150 basis points, the spread is not that much. So I think, Prashant, for a convincing case for the markets to make a new high and sustain that, we need to get into a situation where the expected returns of the markets are at least 20%. And that probably won't happen unless you're going into a fiscal year with 16-18% kind of earnings growth projections, which I still think we're a little way of a distance away from. So I think that volatility that you spoke about with respect to the STT announcement and then the trade deal positive, I think that's behind us. We're looking ahead to earnings now. In a couple of months, we'll start looking to the heavens for projections on the rains and see how that goes. But I would think that this would be another year of consolidation, Prashant. It could be a very tough year. You could see the Nifty consolidate, say, between 24.5 to 27.5. That's not to say you won't make money, but it'll just be another very challenging year because both domestics and FIs have other asset class allocations. And I don't for a minute buy the theory that people are going to stop investing in gold and silver because of what's happened in the last month and a half. I think those are still very viable alternate asset classes.
Okay. All right. Hi, Rahul. Good morning. Good to see you in and all the best in your new role. Seen you going from strength to strength over the years. And I only wish you the best, Rahul. And we look forward to interacting you more often as well. Since you mentioned gold and silver, let's talk about Titan. We'll be having the management shortly who will be joining in on the show. What do you make of the numbers? Expected to be good. They were pretty good as well. So if you want to give us your take.
No, so thank you for your wishes, Nigel. So I think I've been a believer in Titan for a very, very long time. I mean, we've spoken over the years. See, these kind of stocks won't come cheap, Nigel, when you're talking about 10-11% kind of growth rate, which is very, very difficult for consumer staples to give you at this point in time. I'm sure you've looked at the numbers for most of the consumer staples numbers that have come out so far, barring the foods. If you keep Britannia, Tata Consumer and Nestle aside, the rest are all giving you between 3-5% kind of volume growth. So I think in that backdrop, if you have a Titan that's giving you strong double-digit growth, I don't see why you wouldn't want that to be part of your portfolio. Of course, valuations will never be cheap, but I think it's not just Titan. Nigel, I would sort of take that discussion further to other consumer discretionary names as well. I'd still be a believer in names like UNSP. United Breweries, I think today should react very well to its numbers. It was a very, very strong set of numbers overnight. Hotel stocks have been doing extremely well. You're looking at 8-9% kind of growth in ARRs. Occupancies are holding in that 65 to 75% range, depending on which hotel you pick up. So I think Titan, liquor stocks, hotel stocks, aviation stocks would be the preferred names because you're struggling to get volume growth in frontline staples. And there as well, I think if you look at most consumer staples, bar Emami and ITC, they're still trading at between 43 to 50 times on a 1 year forward basis. So if I'm getting a 10-12% kind of growth or even higher than that in Titan, for me, it's a no-brainer to be adding it at any corrections if at all you get them.
Do you think QSR is going to make a comeback in a more durable way this time? Jubilant FoodWorks say like-for-like growth was about 5%. Is that good enough? And we've seen so much consolidation in this space, Rahul.
So, Rima, when Swiggy and Zomato came out, I actually thought these would be enablers for the business. They've actually turned out to be disruptors for the business. Now, I know there was a day last week where you had all the QSR stocks up between 5 to 15%. But we have to keep in mind that a lot of these bases, barring Jubilant FoodWorks, are coming off the same store sales growth that you saw for this quarter are coming off very low bases. In fact, Jubilant was the other way around. It came off an 11% like-for-like growth, and that has tapered down into the low single digits. So I personally think, Rima, I mean, if you look at a McDonald's, for example, you have the most expensive item there is your chicken Maharaja Mac, which is 250 rupees. If you look at a pizza, decent size, you're talking about 500 rupees at least for a chicken pizza. Now look at the options that Swiggy and Zomato have given you in those price ranges across cuisines, not just Indian and more. So I think there is a challenge. The other thing, especially for dine-in QSRs like Burger King, McDonald's, etc., is that barring the last 6 months, movies have been very soft in India. So the footfalls into the malls haven't been that good, which hasn't translated that much into growth. So Jubilant is still coming to you at 65, 70 PE. McDonald's is close to about 100 PE. A lot of these have assets, in countries like Indonesia, Sri Lanka, Turkey, where things could go wrong at the whim, and we won't even know it. It'll just show up in the earnings. We'll be talking all about it, but it may just surprise us on the negative side. So I would stay clear. As I was telling Nigel a while earlier, if I have to play food, I would probably still play through names like Britannia, Tata Consumer, and Nestle. I still think the times ahead could be relatively challenging, both from a growth as well as from a valuation standpoint for the QSR sector.
Okay, all right, Rahul. Time for a beer, a pizza, or whatever you choose. Thanks a lot for joining in. Catch you soon.
He goes for expensive things, right? Like Titan, beer. He's not going for the 200 rupee Maharaja Mac.
Okay.
It's a premium play.
Rahul, you know what's on demand then.
Let's hope my bonuses continue.
Catch you soon.
Talk about that, but thank you so much, Nigel.
Okay. Catch you soon for the pizza or the burger. That's on me. The other expensive stuff on you. All right. Time to slip into a short break. Come back. We'll get you pre-open rates. We'll also be joined by Vishal Manchanda of Systematics Group to discuss developments in the pharma sector. Also, our technical experts will be joining in. So stay tuned for all of that. Welcome back. Hope you're having a good morning. Let's hop across to Sudarshan. He's in to tell us about the MSCI rejig announcement that came in earlier today. Morning, sir. Take it away.
So early in the morning today, MSCI has announced some of the changes to its major indexes. In the MSCI Standard Index, 2 stocks will be added while 1 stock will be deleted. And because of this rejig, India's weightage in MSCI Standard Index will remain steady at around 14.1%. But because of the underperformance that we have seen in the broader markets, there have been several changes in the small cap index. And because of this, total number of stocks in small cap index will come down to 480 from 508. And these changes would be effective February 27, 2026. Now, in the MSCI Standard Index, 2 major inclusions. First one is AB Capital, and because of this, likely inflows we are expected to see of $257 million. Another one is L&T Finance Holdings, and that also may see inflows of around $238 million. In MSCI Standard Index, 1 stock that will be excluded is IRCTC, and outflows are seen at around $142 million. Coming to MSCI Small Cap Index, some of the major inclusions are Prima Energies, NSTL, MCure, GSW Cement, Ashapura Mine, Canada HSBC Life and Thyrocare Technologies. In exclusion list, Gokaldas Exports, Sterlite Tech, KNR, Jkumar Infra, VRL Logistics, Ashoka Bilcon, Anup Engineering are some of the major names, though that would be excluded from MSCI Small Cap Index. But as far as changes are concerned, are largely in line with analyst expectations.
All right, so thank you very much for that. Changes in line with expectations, as Asud points out. Sudarshan Sukhani is with us, and we also have Mitesh Thakkar with us with what they'd want you to do in terms of specific trading strategies in stocks. The GIFT Nifty implied open is another 80-85 odd points. Yesterday, of course, I mean, we pretty much opened and closed around the same kind of levels. Mitesh, you go first. Any significance of that? And what's the trade as we open on indices first?
I think, very clearly, yesterday, in fact, a couple of days back, I was talking about that if we don't break 25,500, it is likely that the bounce back will extend to about levels of 26,000 and maybe even 26,300. So yesterday, we made a high near 26,000, and I think today also we open around that level. To me, it's an important level. There's a couple of intraday pivots placed over there. It's also a round number. So I would be inclined to take some profits around those levels, but the idea is that the directional bias on an hourly, 2-hourly, 4-hourly chart basis is up. So I eventually believe that even if you get a 100-point lift from there, buy back longs again or get into fresh longs if you don't have. And I think this time we might retest this 26,250, 300 zone. So positive in the short term.
Positive in the short term. Got it. Thanks, Mitesh, for that. Well, let's get Sudarshan as well into the discussion. Sudarshan, what do you make of it? A 1,000-point move in a matter of a week, and the shots have got squeezed out. More to go. How would you trade the index?
Yeah, good morning. Well, we've got most of this move, and luckily, I think the time has come to take profits and step aside, at least for the day. That doesn't mean this will be valid tomorrow or day after, but today is probably a day when I would like to take profits. I would say, okay, we'll see where the Nifty goes. Remember, we are also going to cross maybe that 26,000 threshold. So perhaps the markets could feel nervous there. In any case, a big rally is a very good reason to take to step out and bank some money in. So today the trade is exit your long positions and do nothing else.
Exit longs and do nothing else. Sudarshan, pretty clean and straightforward. In terms of specific stock trades, Sudarshan, what would you say?
Well, I have Dabur as a buy with a stop under 505. Muthoot Finance with a stop under is a buy with a stop under 38.10. I have Alchem is my final and third buy, stop under 56.65. I also have an intraday short or even a positional short, whatever you like to take. That is persistent with a stop above 59.70. The shorts are coming after a long time.
Okay, all right. Got that, Sudarshan. Mitesh, what about you?
Yeah. I also have an all-buy list. The idea is that the directional bias is on the upside, so we'll trade more with long bias. Adani Ports is my first recommendation. Recommend a buy here with a stop at 15 or just below 15.25, and 16.10 on the upside is the near-term target. Then Astral is another stock which I like. Keep a stop below 1500. Look for targets of around 1595, 1600 on the upside. A buy on Eternal. It was a buy yesterday as well. I think today is a fresh buy. So people who have longs, I think, can trail the stop losses, but now recommending a buy with a stop below 300 for the next target at 310. And IRCTC is something which gave a reversal. It's still below its 34-day exponential average. So in case it crosses that, and it's only about a point below. So buy about 639, 640, keep a stop at 625, and a target of 670 is what I recommend.
Got it. Okay. All right. Thanks a lot for that, Mitesh, as well as Sudarshan. Well, let's focus on a couple of names then from the pharma pack. We have Vishal Manchanda from Systematics who joins in. Hi, Vishal. Good morning. Good to see you in, Vishal. I wanted to focus on Auto Pharma. Yesterday, the stock got clobbered. And now, in fact, we have the Unit 7 as well, observations that are coming. What do you make of it? And how would you approach the stock? Yesterday, I think it was down close to 7%.
Right. I think so we are seeing two facilities getting inspected back to back. So it was Unit 3 earlier, and kind of they got observations there, and likewise Unit 7 is also a large facility for them. But I think that's part of being in the US business. You will keep getting Form 483 observations, and I think that's the way the US business usually would turn out. Maybe it's you can't really comment on how the observations are and what impact these observations would have. But I think given Aurobindo's track record in terms of managing their facilities for so long, they have never seen a. So I think they at worst, I think they've seen OAIs in their history, and I think large part of the growth that Aurobindo is looking at in the next 1 year is going to come from their Pen-G business. US probably is not that important imminently for them.
Got that. Vishal, hi, morning. Can you give us an overall synopsis, analysis of how the Q3 earnings season has been so far for the Indian pharma, healthcare, hospitality space? What were the big trends that stood out, which you can take forward?
So you mean the pharmaceuticals or the?
No, across the different bracket segments for pharma, for in the domestic side, for healthcare.
Right.
Hospital, yeah.
So I think on the pharma side, specifically, a few companies have done well on the IPM business, Indian pharmaceutical markets. So Sun, Ajanta Pharma, Dr. Reddy's, and Zydus. These are few names that have done extraordinarily well, especially Sun Pharma, which has grown 16% on a YoY basis. While I think many of these companies have also been dependent on acquisitions and licensing for bringing that growth. Apart from that, I think US business largely has been kind of a mixed bag. So a few companies have outperformed expectations, while a few have underperformed. Like Cipla has underperformed expectations. Zydus did better than expectation. Even Reddy's did better than expectations on the US business. But I think US is probably, if you look at the near to medium term, that may be on a downturn. The US generic business will be on downturn for most names.
And on the India-US trade deal, because that is contingent on the investigation of under Section 232, whether we get that preferential treatment for Indian generic companies. How are you? Yeah, go ahead.
I think so. Right now we are exempt, and then I think that 232 investigations. So we have been hearing on that for a while. So that remains an overhang. But if you look at generics, and if you look at US, so I don't think US kind of has an option, but has no other option but to kind of keep outsourcing generic drugs from other countries. They can only diversify their sourcing, like reduce their over dependence on India. Tariffs are unlikely to serve any purpose here. It's going to be a long-term mandate that US has to execute in terms of de-risking their dependence, de-risking in terms of their dependence. So India, probably they're over-dependent on India, they're over-dependent on China. But that's going to be a gradual process through which they can manage their risk.
All right, we'll leave it there, Vishal. Thank you very much for joining us. Good speaking with you, and appreciate your time here on CNBC TV 18. I mean, I think the pre-open has kicked off, and I think we're coming to an end, actually, of the pre-open session. So it's 90 points higher. If you can just quickly, we do this towards the end of the pre-open and actually before markets open, but I guess we can, if you have the stock stacks in terms of the stuff we addressed since the morning, if you can pull those up, and BHEL down 5%. There is, of course, the Aether block there. Torrent Power is up about 1.25%. We've got Aether is absolutely flat right now. Eicher is up about 2.7%. Britannia is starting about 2.5 higher. Jubilant Food, of course, 3% in the green on numbers. United Breweries is up about 3%. Stocks at about 1,670. And Apollo Hospitals, 2.5 higher. Numbers are pretty good. Aurobindo, top Nifty loser yesterday, but I mean, we just spoke with Vishal there. So about 2% higher, some recovery. Titan is up about 2.5% as well at this stage. So that is the sort of picture and what's coming through. I mean, the Aether block, I'm not sure if everything has gotten done, but shares worth some 233 odd crores have changed hands. I thought the amount was perhaps slightly larger in with the information that we put out yesterday, but we'll just confirm that in just a bit from now. But the stock's not moving, and it's kind of flattish. It's been done. I mean, this particular block, 230 odd crores, done in the block deal window. In that sense, maybe the pre-open has ended, and if you can put up the wealth guys, the wealth management stocks, right? I mean, just out of curiosity, because last night in the US, the wealth stocks sold off, wealth management stocks, Charles Schwab, etc. Nuvama is down about 1.25%. I'm not sure if this has necessarily got to do when the transmission is so fast from the. I mean, sometimes it is. But this is a niche part of the market in the US which got impacted because of AI anxiety. 361 perhaps is another name which we could put out. Motilal, of course, does a bunch of things, but 360 is, of course, pure wealth. I mean, not really. So it's, I guess, I mean, if it really was the AI risk to wealth firms, as we saw in the US, it should show up at least in 2 or 3 in these names, at least the pure play wealth names in that sense, which is not the case. So that is the picture on some of these names right now. So the pre-open, as I think, is settled. And we have ended absolutely, I mean, actually, it's about 60 odd points higher, which is not bad at all. 25,997 is where we are at. So about 60 odd points in the green. So we're at the upper end. I mean, I think we'll open around yesterday's high, which is the first resistance from here is about 26,020. And we got almost to it. This morning, we are again getting very close to it. Let's see if that acts as a bit of a resistance, or I mean, the market's able to take that out. But the close, the open and close were pretty much around the same levels yesterday for the Nifty. Usually, typically, that signals a bit of exhaustion more than anything else. So we'll see if we are able to latch on and hold on to these gains. But in any case, as I've been saying, I mean, I think a lot of the sort of focus is really going to be on individual stocks with regards to numbers, earnings, etc. I think we can get to the 9-10 calls. Sudarshan and Mitesh are with us. Sudarshan, what would you say? What would you do?
It's Alchem. Buy Alchem with a stop under 56.65.
Okay, Alchem is Sudarshan's pick right now. It is up 0.5%, 30 rupees higher. Mitesh, what about you?
I'll go with the buy on Eternal for targets of 310.
Okay, Eternals for targets of 310. I think Eternal, of course, was one of the top. Eternal, Swiggy both did very well yesterday. Mitesh, just a quick word. I don't know if BSC, we can pull it up. Any thoughts there? Again, it was a big mover yesterday.
BSC, Prashant, I personally hold and I have interest. A good breakout with a gap into all-time highs, for me, I think that's a very positive setup. I have a minimum target of roughly around 3250, but that is close. But the extended target, could be very interesting in the range of around 3750, 3800.
Okay, all right, Mitesh and Sudarshan, thank you very much for joining us. Well, Jubilant Foodworks is what I want to focus on. Vinny's here with us to revise the numbers and, of course, what the street made of it. Vinny, morning.
Hi, morning. So yes, overall, good set of numbers. Operationally, a good performance that's coming from Jubilant FoodWorks this time. Revenue growth of 12%. Margins have seen an expansion of more than 100 basis points. Profit growth of around 32%. Domino's like-for-like growth, that's seen an improvement that's at around 5%. An 8th consecutive quarter that you are seeing like-for-like growth that has been positive for Domino's. Popeyes also recorded a double-digit like-for-like growth in this quarter. So good performance overall coming in there. Now, what's the street saying? What are analysts highlighting? Jubilant FoodWorks, for Jubilant FoodWorks, Jefferies is maintaining a buy call, target price of 850 rupees per share. Even CLSA is maintaining their whole call and the target price is 505 rupees per share, while HSBC also continues to maintain the buy call, target price of 700 rupees per share. And obviously the management has given a like-for-like growth guidance of 5 to 7%. So that is going to be key in the next couple of quarters to watch out for as well.
Okay, all right, Vinny, thank you very much for that. Jubilant Food is up on your screen. Well, let's just move on to the next one, right? Eicher Motors and Tata Motors commercial vehicles. Sudarshan is here with details on these two. So over to you.
So Eicher Motors in the pre-opening session is up almost 3%. It's one amongst the top Nifty gainers. It's on the back of strong set of earnings that company has reported for Q3 FY26. Both on the volume front and the margin front, company has been outperforming the peers. Margin has come in at 25.5%. It's a 5-quarter high. On the volume front, also Royal Enfield volumes are up 21% year-on-year. Even commercial volumes have increased by 24%. And because of sharp increase in the volumes, company has seen an increase in the revenue by 23%. EBITDA has increased by 30%. And margin has increased to 25.5% versus 24.2%. Going forward, also company is saying that in the Q4, strong momentum will continue, and even in FY27, industry is expected to see a high single-digit growth. Coming to Tata Motors commercial vehicle, it has seen a big order for the Indonesian arm from the Indonesian government company. It's for the 70,000 vehicles, and 70,000 vehicles will consist of 35,000 vehicles of Yodha pickup and 35,000 vehicles of Ultra T.7 truck. Now, just I have done the rough calculation. Rough calculation suggests that the order is going to be in the range of 7,000 to 9,000 crores. So it's a huge order, and on the back of this, in the pre-opening session, the stock is up almost 3%.
Thank you very much for that. Midesh, Titan is going to be a big mover today. It rallied yesterday. It's up another 2% in pre-open. Is there a trade?
I was looking at this stock yesterday because it made a fresh high, and I was wondering, if it's slightly stretched and maybe a pullback will help me buy. But I think today's morning would suggest that may not happen. I'm looking at a target of around 4,500 over here, so still positive on that.
Got it. All right. Thanks a lot for that, Mitesh. By the way, a few more stocks actually are doing quite well. HEG, actually, those numbers look quite good. I think the stock is up close to around 5.5% as we speak. So big up move is what we are seeing on that one. Numbers look pretty good. Good growth on the top line. The management had told us that actually they're not expecting any kind of big move on realization. So it appears utilization levels have improved. And the margins have clocked 20%. Remember, it's a far cry away from the 60-70% that they did at peak of the cycle. But the management has told us that don't hope for that 60-70%, but some improvement is warranted. And it appears the street has taken note of that as well. Net, good set of numbers, and the street has acknowledged that. But Prashant, we're bracing for a positive opening today. The Nifty is up. And I tell you what, if we can end somewhere close to where we're starting, the bulls will feel very, very good, because this has been a bit of a resistance zone.
Well, absolutely. And I think the first rate should be coming in terms of where we are at. So 25,997, about 60 odd points higher. The first headline level rate should come in, and then we'll dive into individual names, because a lot of it, of course, is about specific stocks on the back of earnings and everything else. So what do we have? So just about starting up and starting out, specific pockets, large moves, right? And we'll focus on those in about 2 minutes' time. So 25,970, so it's up, but not holding straight away. 25,960, so it's up about 0.15%. Bank Nifty is kind of flattish, sideways, 60,555. The Midcap Index is about 50-point change. So again, absolutely flat. Small caps perhaps should be something similar. Broader market breadth, 2:1. It's right out of the gate. So I guess give it some more time for things to settle. But what is trading right now, it's more up than down. The Nifty heat map up next should give you a quick sense of where we are starting before we go any further. What do we have? 25,976 and 35, 36 names are up. Eicher, Apollo Hospitals, Titan on one end. There is ONGC Coal and Hindalco, which is the other end. So resource companies losing a little bit. On the other side, you've got some of the consumer names which are up and about 40 points. So it's not a bad start. Rima.
Well, it's all about the earnings reaction. So right on top is Eicher Motors. Stock has opened with a gain of 5%, gap up and gone straight away to a fresh 52-week high, 76.50. Strong numbers. Royal Enfield volumes were known, expected to be good, but the street is happy with the margin performance this time, as Sudarshan was talking about. Apollo Hospitals, again, a good set of numbers. For Titan, jewelry sales have been strong, in excess of 40%, but they managed to increase the margins also, and the street is excited. Max Healthcare is higher in trade. You've got strength in a couple of the other consumption names. So Nestle, Tata Consumer. Eternal was a 5% mover yesterday on the way up, seeing some follow-on buying, a gain of about 1% to begin trade with. On the way down, Hindalco, Coal India, ONGC. HDFC Bank has been a bit of a drag. This week, HDFC Bank is down 1.25% from the start of the year. It's lower by nearly 6.5%. Quietish start, holding on with a positive bias, but it's largely about the earnings reaction when you look at the frontline stocks.
Well, that's right, Rima. A few stocks actually deserve special mention. You have HEG, the stock is flying away, doing pretty well in today's trading session. I think it's seen some bit of profit taking from the top. Yeah, that one comes up for you. But Ashiana Housing, not a very large company, 3,500 crores. That's up close to around 15%. They came out with their set of numbers, so that's one's bucking the trend. All cargo terminals as well is holding with solid gains in today's trading session. So good move is what we're seeing out there. TVS Supply Chain. Now that one's moving on decent volumes. That's up close to around 6% as we speak. So good move out there. On the flip side, you have Som Distilleries. Little, tipsy this morning, actually. That stock, in fact, is down close to around 10% as we speak. Some distilleries should come up for you on the screen. That one's lower. You have Skipper as well. That's actually corrected a fair bit from the recent peak. They were talking about a longer runway, but it seems that stock is coming for profit taking. I recall it at around 550 rupees now, at around 380 rupees, falling on decent volumes. And Lakshmi Dental as well. That's the other stock in there that's actually come in for some profit booking. So headline index is now back towards the high point of the day at around that 26,000 odd mark. But individual stocks doing a thing of their own. Karnataka Bank is another stock that's down close to around 3%.
Yeah, no, absolutely. By the way, the top two volume-led gainers in the NSE are both around 7,500, 7,600 rupees. That is Eicher, 7,700, and Apollo at about 7,550. So 5% and 4% respectively, and a tremendous amount of volumes right now. So, I mean, a 7,000 rupee stocks trading, a 250,000 shares straight at the word go. Impressive. HEG is up about 3%. I think we mentioned it. Tata Motors Commercial Vehicles, Sud mentioned it, 2.25%. Motherson, the management joins us in a bit, 3% higher. Britannia is up 4%. Stocks at about 6,100 odd. Naveen Fluorine, big day, I think day before it was, or yesterday, 3% higher. HBL is up about 2.33%. Sansera has had a one-way move last three sessions, 21.20 or so on Sansera. And by the way, I'm only highlighting things with large volumes there is more, but I'm not going there because volumes are a little thin. I think Nigel mentioned Ashiana, which is up 15%. Wakefit is coming up. Okay, Wakefit is up 1%, but it's got large volumes. So that's Iron Exchange is another one, which is up about 2% or so. Market breadth has converged. So this is interesting as we kind of sort of settle down. 1,300 stocks are higher and about 1,150 stocks are lower. And MCX is the top volume-led loser with about a 2% cut. Again, it's a stock which has done phenomenally well. Hero MotoCorp is down about 2.5%, 5,600. Sterlite Tech has had a bit of a crazy move last 5 sessions. It's seeing some profit booking down about 5%, pulling back a little bit. And then there is Kiri Industries and Skipper, which is down 5%. Walkart is down 1.5%. And again, I mean, volumes start to thin out pretty fast if you go down the list at this stage. Well, let's bring in our market voice now. Shreyas Devalkar is head of equity, Axis Mutual Fund. Shreyas, good morning. Great to have you with us here. Thanks very much for joining us. Are you watching, by the way, Shreyas, what's happening with this entire AI anxiety hitting various parts of the financial services sector in the US? Or how would you read it? You think the fact that maybe, I don't know, I mean, there are various ways to think about this, right? Maybe here in India, we are not that developed, right, in terms of financial products and offerings, etc., etc. So to get disrupted won't be that easy. That's one way. That's the optimistic view. But you can make an opposite case as well. What is your sense, Shreyas?
See, AI is having impact on multiple things. Obviously, financial services is one of them. But financial services sector is regulated, and there are we have seen this even earlier also. So it's not that a new thing which is happening out in the financial services. When it comes to digital, there are multiple startups which started some time back. Today it is about AI. But broader point here being, since this sector is regulated, there are multiple aspects of risk to be taken into consideration. So one should take it with a pinch of salt on all this development. Most important, in my opinion, as far as Indian markets are concerned, and as far as the earnings are concerned, the IT sector, which has seen a lot of beating during this time. And the impact on them, in my opinion, generally is also baked in terms of when you look at the growth of all these IT services companies, which we are considering around mid-single digit or low single digit. So this is actually factors in some sort of deflation in the revenue growth, actually deflation in the pricing as well, around 2 to 3%. So yes, AI is impacting multiple sectors, but a direct impact so far, in my opinion, is getting more reflected in the IT sector as such. As far as the financial services, I'm sure our Indian IT financial services industry also is evolving. Some of the companies actually highlighted that they are trying to use it to their benefit for reduction of cost. So cost to income ratio. Actually, if you see for multiple years, everyone predicted that cost to income ratio will come down, but actually it never turned out that way. Some of the NBFCs are trying to work more closely on it. And let's hope that we see the benefits somewhere in that as well.
Shreyas, hi, morning. This is Rima here. So yesterday we got the AMFI data for the month of January, and what stood out was one, equity inflows declined 14%, and two, gold ETFs soared 24,000 crore in terms of inflows. I mean, what is your opinion on that? And in the first 10 days of February, is this the trend which has continued?
Any asset class, so it's not about only gold. When it performs, obviously the flows track to them. We have seen the same earlier in mid-cap and small cap as well. In 2024 and part of 25, the mid and small cap also got a lot of flows. Actually, in these recent numbers of January, actually these segments are actually getting lower flows than the peak what we have seen earlier. So this rotation are part and parcel. In that sense, gold as a dollar debasement trade is continuing. Even recent data about China, the way they are buying gold, actually, it's one data suggests that they are almost 9% of the reserves in terms of gold. So this trend of the central banks buying gold still continues, and in that sense, gold as an asset class or a dollar debasement trade and the beneficiaries of that as asset class warrants allocation in the portfolio for the investors.
Hi Shreyas, good morning. Good to see you in. I think you have been reasonably positive on the auto space. And then, last year in September when you got that GST rationalization, the stocks did very, very well. How are you all positioned right now on autos? Do you all maintain that bullish stance? And within autos, what do you like?
So in auto post GST, and especially in the recent past, it is about a commercial vehicle CV cycle as well. So there are two aspects to it. So GST definitely benefited among all the sectors where there was a GST cut at that point in time. Auto is the only sector which showed some uptick in many segments, both in two-wheeler and four-wheeler. So we continue to be positive on that segment. Actually, incrementally in the last 2-3 months, the commercial vehicle cycle has improved. Even the tractor numbers are coming out very, very well. So if you see multiple aspects of auto, they are actually doing very good in the recent past, including some of the EV names as well. So as a pack, I think that this various companies are delivering on the product launches as well as the overall on-ground demand. We are seeing in multiple aspects. Only concerns in auto segment remains around the commodity price inflation and whether the industry will be able to pass it on or not. Historically, it depends on, frankly, it depends on how good is the demand for a particular product. And one need to take that kind of view. Even if you see 2016 to 20, overall auto demand was not that high, but some of the company or one of the company, when the product life cycle was good, at that time, despite commodity pressure, they could pass it on. So one need to take such kind of views in this environment. So the only two concerns, as I said, one is the commodity, and the second one being whether these US or European cars will come and will affect the industry. As of now, the way things stand, probably not at a mass market level, but we need to evaluate going ahead. So all in all, we are positive on the sector as reflected in our last month portfolio.
Shreyas, you have multi-asset funds, right, at Axis?
Yes.
So the reason I'm asking this is because I think Rima asked that question about flows, etc. Silver has fallen from whatever 150 to 80. Gold has seen not that much. I mean, 12-13% pullback, but silver is more. So if new money which comes in, how are you allocating? I mean, what is are you in a multi-asset kind of situation?
Sure. So if you look at multi-asset allocation funds, so obviously gold, silver is sizable part of it, right? It varies from 15 to 20, 22% based on the mandate of the fund, in which fundamentally the gold is where the world is.
No. Sorry. You're saying you are you can, in a multi-asset scheme, you can be very overweight on gold, silver, and underweight equities. That's the whole idea, right? And or vice versa. Or yeah, sorry, go on.
Sure. So there are two kinds of schemes. One is the equity taxation, right? And in which you have to be 65% odd in equity. So those kind of schemes, wherein then obviously the exposure to the gold to that extent comes down. While in other schemes it can be higher. Now, in which among the gold and silver, the real trade is about gold, right? And when it comes to silver, it is about more a proxy to it. And actually that trade even percolated to copper and other metals as well. And the arguments you are aware of what the way markets are making. The point here is one need to look at what is the, in all the commodities, what is the stock to flow ratio, what they call. So in case of gold, stock to flow ratio is as high as 67. And it varies month after month or year after year based on overall demand supply, but it's over a longer period of time. The point why you track this is the higher this ratio, it's not very easy to increase or decrease supply of that commodity. So in case of crude oil, it is low. In case of silver, it is somewhere around 10. And in case of other commodities, it even somewhere around 4 or 5. So with what is the ability of the industry to increase demand and supply is very important. So broadly, all in all, that's where gold is relatively preferable. Obviously, we have seen very high volatility in silver but we are broadly more positive on the gold.
Got it.
Thank you, Shreyas, for joining in. Always a pleasure interacting. Moving on now to Apollo Hospitals. That's gaining in trade. They reported a strong set of Q3 numbers. Profits have tripled on a year-on-year basis. Margins expanded. Sunita Reddy, MD of Apollo Hospitals, is now joining in. Good morning, ma'am. Thank you very much for joining in. This is Rima here. Let me begin with the hospital business. Now, your average revenue per patient, ARPP, grew by a massive 11% to 1.8 lakh. Is this kind of a double-digit run rate in this average revenue per patient sustainable? What is your own view? And even occupancy inching towards 70%. When does that happen?
That should happen over the next 2 quarters. What we're seeing is two significant movements. One is 9.2 lakh people, which is 18% growth. And I think they continue to grow their 3 streams of revenue. So they sold about 13,582 insurance policies, representing a GMV of 12.57 crores. So insurance is something that will gain traction. How they pay for insurance, I think, they will, it will come as EMIs. So you won't capture the full value in a single year. The revenue from selling medicines, etc., the e-pharmacy, has did about close to 35,000 transactions per day. Digital is picking up, and their diagnostics is also growing rapidly at about 24%.
Okay. The digital cash losses in the healthcare business are the lowest ever. When do you break even? Is it imminent?
Yes, I think in the next quarter it's imminent. But on the whole, I think we have to look at the company as a whole. 2,827 crores of revenue. They have come in with a strong EBITDA of 128 crores and 87 crores of profitability. So this is in spite of writing off 30 crores of ESOPs. So there is a very strong traction and a movement towards profitability, which should happen in the next 6 months.
Okay, in the next 6 months. Ma'am, what's the current status of the Apollo Healthco Keymed demerger? And is the listing timeline of Q4 FY27, Q1 FY28 still firmly on track?
So they've got CIC approval. I think the team is working very hard. My sister Shobna is working very hard on the listing process. So we'll hear more about it from her later.
Yeah. Ma'am, any outright acquisitions on the radar?
Right now, I think, we've got our hands full. We're opening 1,325 beds in the next 6 months. So this is our focus. And post that, another 1,500 beds that will come on stream in 28, 29. This should lead to revenues growth of about 18%. So the hospital services space will be in a very strong growth trajectory.
All right, final question, ma'am, before we let you go. You've delivered big wealth for shareholders and appear very, very focused with regard to the growth trajectory going ahead. Just one quick query. Promoter entity, they went ahead and they sold close to 100% middle of last year. Is there any target holding? Because the street is thinking maybe there could be a potential sale yet again. Is that possible?
Oh, not at all. Not at all.
Promoters intend to hold on to the entire stake?
Yes, no, I think promoters continue to be passionate about Apollo. We hope to be driving growth.
So no further promoter supply is what you're telling us in the market.
Yes.
Ma'am, sorry, since we have you on, we're on a earnings non-stop sort of treadmill here. But one last question: the Indraprastha Indraprastha hospital situation in Delhi. Could you tell us anything, ma'am? Because there's been a lot of chatter around that you're going to eventually increase stake and that Delhi government is the other partner on the other side. So anything you can tell us?
We continue to have a very collaborative dialogue with the Delhi government. It is a bit early to comment, but we are both hopeful of a very positive outcome.
Okay. Which kind of would mean you end up with a higher stake, if it comes to that, after all these negotiations. Obviously, I won't push you to give us more, but that's directionally right?
Yes, I think, we do feel that we would like to do more in Indraprastha. Let me just end with that. And very soon we'll probably be able to talk about how the contours will look like.
Okay. Thank you very much for that.
My pleasure.
Really appreciate it, ma'am. Thank you. 5% on Apollo Hospital. Stock's doing extremely well. Nigel, I think the Titan management ready.
Well, that's right. Let's go across to Titan that reported a rather strong set of numbers in the Q3. Revenues jumped 40%. Margins expanded by around 100 basis points. There was an exceptional loss due to the new labor code as well. We have Mr. Ashok Santalia, the CFO at Titan. Hi, sir. Good morning. Always good to have you on the show. Before we get to the numbers and push you for some guidance, how are demand trends shaping up? Q4 has a lesser number of weddings, but I understand that there is some, pre-buying that we're seeing in anticipation of the wedding season. So how have demand trends been, given that gold prices have spiked up?
Yeah, thank you, Nigel. I think gold prices have been spiking up for last now many months.
Yeah.
But January saw for the first time major correction also, albeit temporarily, from $5,600 per ounce, it came down to $4,700. And then again, it is towards $5,000. So, but January, to answer your question, has been again a very satisfying quarter. We do have, if you know that in Titan, we do the Festival of Diamond in January, February, and which is currently going on. And we have a good response on studded jewelry also. So hopefully Q4, while market and gold prices are volatile, but we expect it to end the financial year on a strong note.
What was the volume growth, sir, in Q3, or was the entire 40% growth driven by an increase in prices?
We mentioned, Rima, that buyer growth is flattish, while between the categories, if you see studded jewelry saw a low single-digit buyer growth, but gold jewelry actually have very, very minor negative growth in buyer.
Since you mentioned studded ratio a couple of times, sir, that's come down to around 26%. When we had spoken a couple of years or so ago, I think it was at more than 30%. So is this the new normal, mid 20%, 26 to say 28%?
So it's outcome of math where gold prices are, say, 60-70% up compared to last year, and while studded prices or diamond prices are holding up. So actually, while buyer are more absolute growth in studded jewelry is decent, but the ratio keeps coming down because the gold prices are skyrocketing.
Mr. Santalia, gold has been top of mind, top of headline, everything for the last, I think, months on end, and it reached a frenzied kind of thing. This pullback we've seen in gold prices, right, 10%, 12%, you think that helps volume growth at the margin in that sense? In this quarter, prices stay around here, and they're not like in a runaway frenzy?
Very difficult to talk about that. Gold seems to be in secular uptrend. Those factors which have been talked about for gold going up have not at all changed. So gold prices, some momentum would show. But at this level, in the rising gold price scenario, margins of jewelry business do see a little bit pressure. And we have talked about that, Prashant, that gold coin sale percentages have gone up, and even diamond jewelry margin come under pressure because gold content in terms of value goes up into those jewelry. But at the same time, we are taking a lot of actions which have some offset impact, like introducing 14 karat, 18 karat, 9 karat modern jewelry, and even light jewelry work has started doing well. And at the same time, a lot of campaigns, new collections, engagement with customer help us to still deliver a margin profile which we think is appropriate for our company and our business.
Okay, all right. Sir, could you tell us what's the target with regard to Beyond, the affordable, lab-grown diamonds business? What is the investment chest, if you could tell us about that? And expected revenue, say, in the next 3 years or the next 5 years, how large can it be?
I have talked about that in retail business allows you to experiment and not really define the end post upfront itself. Current idea is to set up 8 to 10 stores in next 4 to 5 months, and even deep dive what we have been studying this market and consumers on the actual, when they are actually making purchase at our store. So that's the 6-month, I would say, period which we have taken to us. And depending on the outcome and our conclusions, we will decide the ramp up speed. If everything works very well, then we can very, very quickly ramp up and then decide what are the goalposts. But first 4, 5, 6 months is still, I would say, exploratory on the ground with the real transactions.
Will you be able to give a number, sir, on the Beyond sales in Q3 and the kind of margins? I understand very early stages, but is there a number in Q3?
So Beyond only, the store was for 2 days in Q3.
All right.
29th December we opened. So it is only 2 days in Q3.
And how has it been in Q4 so far? The first
January month has been good, the way we expected. There is a lot of curiosity. There is a lot of interest. Many customers are coming and
Any
buying.
sales numbers, sir, for the first 40 days of Q4?
No, it will be too premature for me to talk about that.
What is the outlook on international expansion? Because you are expanding in GCC, Middle East. I think you'll acquire that Damas jewelry stake as well.
Yeah.
What is the international expansion plans?
So Damas has been 67% has been completed recently, and from 1st January that will get consolidated in our books of accounts. So Damas, of course, will now pick up its growth trajectory on the Arab segment side and kind of expand its retail network a little bit and do whatever it needs to be done. Some of the Tanishq expansion are also coming through, a couple of the mass stores which were in the catchment area where actually target segment or customer segment is more appropriate for Tanishq. So some of those stores in Q4, single digit number, I would say, will get converted, and that will kind of expand Tanishq footprint in GCC market. In US market, we had opened 2 stores in last quarter and couple of more. We were slightly slowing down and waiting for the outcome of tariff and our supply chain solutions. Both together have come in, like tariff situation also have eased out, and as well as our supply chain solutions have also fructified. So I think US will again start gaining traction on further expansion. We decided also Canada as a next geography for us. So in FY27, I expect 1 or 2 stores of Tanishq coming in Canada as well.
Okay, all right. Very quickly, sir, with regard to the EBIT guidance, you hold on to that 11.5%. I think is what you'll have been hinting for. Any upside risk there?
11% centered around, I think, FY27, 26 we will able to do, and then we will talk about next. But it is becoming increasingly clear to us that in rising gold environment, perhaps we need to think about absolute EBIT growth and then too much wedded about the margin, while we will be very mindful of the margin efficiency. But it might, if the gold prices keep going up, it might see some pressure and may fall, go below 11%.
Mr. Santalia, are you in talks to buy out TBZ, Tribhuvan Das Zaveri?
No plans, I think. No plans. No.
Okay. No approach, no talks, no initial talks, early talks, nothing?
I will not comment anything, but we don't have any plan.
Okay, no plans as of now. Thank you very much, Mr. Santalia. Appreciate you joining us, and good speaking with you here on CNBC TV 18. We'll take a quick commercial break here. We're going to come back in just a bit. Management of Samvardhana Motherson to talk about their third quarter numbers. Numbers were good. Stock was up yesterday. Pankaj Mittal is going to be with us on the other side.
Co-presented by Bank of Maharashtra, Ek Parivar, Ek Bank. Co-powered by Century HDF Premium Plus.
चलो चलो AI से पूछते हैं. Do fish get thirsty? If AI will use so much energy, then what is the future of energy?
Infinite clean energy. Avada, always clean, always on.
We have carefully reviewed your performance and promoting you to branch manager.
Sir. Hello, Motilal Oswal.
When life goes to the next level, download Rise by Motilal Oswal. Investments and securities market are subject to market risks. Read all the related documents carefully before investing.
This is Network 18, and you're watching CNBC TV 18.
Co-powered by SBI, the banker to every Indian. Truly.
Welcome back. Samvardhana Motherson is surging in trade today on the back of reporting a strong set of third quarter numbers. It reported the highest ever quarterly revenue. Margins came in above 9.5% for the second straight quarter. We have Pankaj Mittal, whole-time director and president at the company, to take some questions. Thank you very much for joining us, Pankaj. Good morning and congratulations. It's a strong set. Some specifics, I guess, if we can tackle first. Margins for the modules and polymer business came in at 9.7. Integrated assemblies 15.2. I guess the margin beat came through from these two segments, right? Is this structural? Is this one-off? And will you be able to sustain margins in these segments and then consequently overall numbers?
Good morning, and thank you for hosting us here today. Well, the company is having a diversified portfolio, and definitely we had highest ever quarterly revenues and good profitability. Our emerging businesses have also done very well. They led to a growth of about 57%, and the emerging businesses, especially the consumer electronics and aerospace business, is also poised to grow. The modules and polymer business has done well. We had announced in Q1 that of the transformative actions which we were taking, and these transformations have yielded results, and we will continue to see good results as we move forward. Similarly, in the integrated assembly, this is a new business which we had acquired. It was a profitable business which was doing good. And then it has had synergies coming from the group. It was only doing assemblies. As we moved forward in the group, we have had more integrations. We could do more products, which could be inbuilt into these integrated assemblies. And hence, we have seen a good, robust performance. We do believe that the markets are doing well. There is a stability as we move forward. The overall car volumes in the next year are also projected to be quite robust. The commercial vehicle industry had taken a beating in the last quarter.
We'll come to the volumes, actual volumes, Pankaj, in just a bit. But margins, you're saying, so the answer is in the affirmative, that you'll be able to hold. This is structural, this is improvement is here to stay, and margins will be at least what you reported in the quarter or higher?
Yes, basically, these are structural. And as we move forward, these businesses are also global. They're in different regions, different sets of customers, different profiles, but these are structural in nature.
And this 20% increase in copper prices, did that negatively impact margins in Q3? And how will it affect margins going forward? Is there a pass-through clause?
Yes, we do have pass-through clauses with all our customers. There is a lag in the recovery of copper prices, normally about a quarter or 6 months in some cases. So as we move forward, these will get averaged out, but they definitely have an impact of about 1% on the wiring harness business.
Okay, so there was a 1% impact on margins on account of higher copper prices in the wiring business. But in the next 1 or 2 quarters, there will be complete 100% pass-through.
Yes.
Okay, so what percentage of your revenues come in from the non-auto segment? Because you are seeing some very strong growth, for instance, in aerospace. So can you give the current performance in Q3 and the outlook on that, on the overall non-auto business?
Overall, if you see, the emerging business has grown by about 57%.
Correct.
Out of our total growth, this emerging business also includes the integration of HCLTech, which we had acquired. And the non-auto business we had mentioned last quarter was contributing around 5% of our total revenues. But these are businesses which are growing at a very fast pace. As you would see that our consumer electronics business is also poised on its ramp-up trajectory. So by the end of 26, financial year 26, we will be on a good way to produce about 16 million. And then with our plant 3, which is the largest plant in our whole group across all our divisions, is going to more than double the capacity again. So this is how we are poised on the consumer electronics side. On the aerospace side, also, we are tier 1 supplier to the major aerospace companies. And with the FTAs coming in, both from the European Union and also from the North American side, it will also give a very good tailwind to these businesses to grow further.
The aerospace manufacturing is in India, Pankaj?
It's also global. We do manufacture in India as well as in Europe at the moment. And as we move forward, it will again become more and more global. But yes, the aerospace companies have very strong interest in India.
So the share between automotive, aerospace and consumer electronics, what is it at now and where do you see it?
As I mentioned, that the non-auto business in the last to last quarter, when we had announced, was about 5%. We do see that our auto business also tends to keep growing. But these new businesses, which we had set up about 6-7 years ago, from nearly zero, they have come up very well. Consumer electronics was not there at all. And these are all being driven with the interest from the customers And they see a good execution capability in Motherson. They say that over a period of time, what we call as DEMAL, design, engineering, manufacturing, assembly, and also logistic capabilities, which we have built. So we have become a specialist, which helps us to support many different industries. And that will lead to our 5-year goal or vision of about 108 billion.
And since, so this non-auto revenue is roughly 5%, 2 quarters back. But because you're expanding capacity, consumer electronics is also seeing strong traction. What will that number increase to, and how are the margins? Because on the whole, when we look at your emerging markets business, the profitability is weakish.
That's because you see that there is a huge investment which has been there and the new acquisition which came in. So when you see the new, the emerging markets, you will see that. But over a period of time, as these capacities are bringing in the new volumes, it will even out. And we do see, as I was mentioning earlier, that the automotive business is also growing. The two new acquisitions, which are at different stages of completion, relating to Nexans as well as Yutaka Jiken, will also come in place, which will be giving us more than $2 billion of revenues in the coming years.
What could FY27 then look like because of the acquisitions? Then 10 of the 12 greenfields are also likely to be completed in FY27. What would the number look like that you're targeting next year?
Well, we are targeting a 5-year vision, and we do see all engines firing at the moment. Good growth. Markets should become better. With FTAs also, seamless supply chains will come in place. So we do see a very positive environment as we move forward.
Your capex during the quarter, sir, was about 52% of the EBITDA. What is the capex number? The number is 1,594 crore for Q3. What is the capex number for FY26 and FY27?
Well, capex for FY26 will be in the range of 6,000 crores plus 10% what we had mentioned. So we'll be around that. And for 27, we'll be coming at the end of this next quarter as we firm up our plans.
Will it be higher directionally?
Well, we see that, sorry, go ahead.
No, go ahead. FY26 capex compared to 26?
Well, FY27 capex, we will come to you end of the next quarter. We do see good growth coming in, and we will let you know at the end of the quarter.
Yeah, so just one question on consumer electronics, right? What is, so you were tied up with this company BIEL on the glass front, right? And presumably the client is Apple. So you're supplying to them, and then they kind of use this, or you're using you're part of the value chain here for stuff which is being made in India right now.
Yes, we have a partnership with BIEL. Who they are our technology partner, who help us in processing the parts which we manufacture, and then we are part of the supply chain.
For the phones which are assembled in India?
Well, for different products, and you know what BIEL manufactures, so that's what we do.
I see. Yeah. And hope is that, I mean, you'd be able to sort of, increase and do more along the way.
Yes, when the plant 3 comes up, we will also be doing more vertical integration with this, so the value content will grow. And as we move forward, we believe we will have more products, and the customer penetrations in different segments will grow.
Okay. One final question. In the North America CV market, you've spoken about a 5% quarter-on-quarter increase. Is that a cyclical bounce or the start of a sustained upcycle?
Last quarter, there was a downturn by about 27%, which was very sharp. The EPA 27 norms will be coming in, and that will lead to some pre-buy. So we do believe that the North American market will bounce back in this year. We have already started seeing the reports coming in from different commercial vehicle makers that their fleet owners are asking for more products.
Got that. Thank you very much for joining us. Appreciate it, and good luck as you continue to execute across a range of segments there. So that's Motherson stocks up about 4.5% as we speak. Now, Eicher Motors is, we're going to stay with the auto space, but Eicher, of course, along with Apollo, are the two biggest gainers across the board with huge volumes. Let's revisit Eicher with Sudarshan. Take it away.
So for Eicher is the top Nifty gainer, up currently more than 6%. For Eicher Motors, volume was never a concern. For the last 2 years, while company has been reporting a huge volume growth, one concern was the margin improvement. Now in this quarter, company has reported margin of 25.5%. That's at a 5-quarter high. Remember, when there was a talk about the competition 2 years ago, company had come out and given the statement that company would focus on growth over the margin. But this is the first time after several quarters that EBITDA has outperformed both volume and the revenue growth. And because of the big surge in the volume that we have seen for both Royal Enfield as well as the commercial vehicle, revenue has seen an increase of 23%, EBITDA has risen by 30%, and margin, as I told you, has come at 25.5% versus 24.2% in the same quarter last year. Even going forward, company is saying that strong momentum that we have seen in the last 2 quarters will continue in Q4, and even in FY27, company is expecting motorcycle industry to see a high single-digit growth, and it continues to gain the market share, especially in the mid-size segment, and the exit market share, the Q3 FY26 was almost 89%. So looking all good as far as Eicher Motors earnings and the outlook are concerned.
Thank you very much for that. For the markets, by the way, we've drifted lower after opening mildly higher, in the red now, or flat now. It's 25,930 on the Nifty, but the tape is red. The Midcap Index is down 1/3 of a percentage point. IT continues to remain weak, subdued, and PSUs like Coal India, ONGC are dragging and putting the pressure on the markets. But let's talk about Britannia. Vinny joins in with the numbers.
Hi, so yes, Britannia, good set of numbers that's coming from the company. Revenue growth is in line with expectations. EBITDA margins, that has seen an expansion of 130 basis point. Overall, EBITDA has seen, gross margins have seen a growth of 450 basis point, revenue growth of 8% as well. The company highlighted, yes, in October there was some disruption due to the GST transition that took place. But in November and December, again, things came back to normal, 12% in terms of a growth that came in for the business in November and December. Healthy growth mainly this time in November and December was driven by strong momentum across their segments, especially biscuits as well as adjacent categories. Both of them saw very good growth. Overall, stable commodity environment is also something that is supporting the margins. So on and on, good set of numbers that's coming from the company. The stock is buzzing in trade, more than 3% of gains.
All right. Thanks very much, Vinny, for that. We'll take a break. We're back. Manisha with us on the other side with commodities in focus. Stay tuned.
Welcome back. Let's talk commodities now. Manisha is joining in and she's focusing on silver this morning. Hi, Manisha. Why is that?
Well, that is because there's some stability that seems to be returning into the markets. For the longest time, we've been talking, especially for the last 1 month, on how the volatility in sense of standard deviation for silver is 85 versus 35 of Nifty. So silver in some sense right now seems to be stabilizing. For this year, we are up 14%. For the commodity, it gained 147% in the previous year. And we've done $121 an ounce of an all-time high on 29th of January. It's trading around, as I said, between that $80, $85 an ounce at this point in time. Well, the global silver demand is expected to be steady in 2026 is the view coming in from Silver Institute. They actually came out with a report overnight giving out a lot of numbers. They say that there is a very strong gain because of the retail investment demand. So whether it is about HNIs, institutions, family houses, they have been buying silver in physical and in ETF as well. The January data did tell us that it is record number of silver ETF buying that we've seen in the month of Jan therein. Interestingly, when you look at the global silver deficit, last year is estimated at 117 million ounces. This year, it is lower at 67 million ounces, but 2026 also is a 6th straight year that you're looking at a deficit within that. Industrial demand clearly has taken a hit because of the silver prices surging so much. So fabrication has come down by 2%. Jewelry demand, because of the high all-time volatile prices, is also declined by 9%. And silverware is expected to decline by 17% when it comes to 2026. Take a look at the overall estimates then in investment demand, 20% of gains there. As I said, ETF, central bank buying, institution buying, retail buying, all of that has been very, very strong. The global supply is anticipated to increase by 1.5% in this year, while the mine production also is expected to increase by a percentage point. This is the highest that we're looking at in last 4 or 5 years. So definitely more silver coming back into the markets, reacting to those all-time high numbers. Recycling also seems to be gaining at around 7% on your screens therein. So when it comes to demand, that has seen a bit of a decline. The supply in 2026 is expected to increase. The outlook for silver is quite interesting. So it has both sides, a market talking about both sides therein. Goldman Sachs still reiterates that $85 to $100 an ounce of a range is what you could be looking at for the rest of this year. Citi is put at a target of 110, and UBS talks about 85 to 105 as well. And then you have Saxo Bank saying that silver could average at $90. There is Bank of America talking about an average price of 65, and then you have JP Morgan talking 50 as well. So it's going to be a volatile year going forward as well, with banks talking about 50 on the lower side to 105 on the higher side.
All right, Manisha, thank you very much for that. Keep an eye out on those rates and those prices over the coming few weeks. Thank you. Well, time for a quick break. On the other side, our special segment, it's the economy. Latha discusses the trade deal and its impact on rupee, India's macros with Santanu Sengupta and Arup Parikshit. That conversation comes up next.
back to It's the Economy. Actually, let's start with the currency. The currency at the moment is stable at where we ended yesterday, 90.56 per dollar. And early morning trades did see the currency strengthen a bit to about 90.48. Now, what's going for the currency is that from February 2nd till today, every single day, there have been FII inflows. Like yesterday, it is sometimes not even like $1 million. It's a very small amount. And then there are days like the day after the deal when we got 5,600 crores, which, amounts to some $600 million. The flow has been extremely erratic, but there have been positive flows every single day. And that's given the currency some kind of a roof. Given the dollar some kind of a roof and the rupee some kind of a bottom since the announcement of the US trade deal. The FII flows have come in as well as sentiment has improved. That's as far as the rupee is concerned. When you come to the broad economy, the only index we have is, of course, the Nifty. And that, if you take it from February 3rd, the first trading day after the announcement of the deal, up to today, almost a 1,000-point rise in the Nifty. Expectation, therefore, that the economy will do well. Of course, not all can be attributed to the US deal itself. You can attribute textiles and leather perhaps to the US deal. But a large part of the bank Nifty improvement was because SBI announced far better than expected results. So there are many things working here. But overall, both the economy representative in the Nifty and the currency have done well after the deal. Well, to take the action forward as to how exactly the economy and the currency may pan out in the days to come, I have with me two experts. Arup Rakshit, the head of global markets and treasury at HDFC Bank, joins us in a bit. We will be joined by Shantanu Sengupta, the economist at Goldman Sachs. Arup, good morning and thank you very much for joining me. What's your call on the currency itself at 90.50, 90.60, thereabouts? Has it got legs to run higher? The rupee, that is.
Good morning, Lata, and thanks for inviting me here. No, sir, I think I continue to hold the view which I had said a couple of months back, even before the deal was anywhere nearby. Rupee would expect rupee to trade a 90 and 92 range. I don't think we are likely to see anything below 89.80 at this juncture. See, I think, yes, we have started seeing FII flows coming back into the system. There is a positive sentiment. And somewhere, I was going to talk about the dollar index. It's there on the screen. Somewhere we'll also have to keep a watch on the dollar index. At a 96.5 levels, I still don't think rupee will go below 90 or 89.80 levels. But if dollar index keeps falling and it goes somewhere below, more towards the 90 level, which can be a possibility given that there is a talk about a general dollar weakness across. That can then lead to a rupee appreciating further. But for the moment, I still think an 89, 80, 92 levels kind of a range is where we will likely to see.
Okay, so a little south of 90, the dollar can go.
Little south, depending if there is a bunched up flows which comes in, it can come down to
89, 80. But otherwise, you expect it to be above 90.
I expect it to be above 90.
Okay. The more crucial question is really on the economy, and Shantanu Sengupta is with us. Shantanu, when we last spoke after the deal, you said you see a 20 basis point bump up on the GDP, on India's GDP, and you had taken it to 6.9% for calendar 2026. Do you have a number for FY27? And if you can tell us what exactly will work well, why have you upgraded it?
Yeah, thanks, Lata. So our fiscal year number is 7%, which is sort of the midpoint of where the economic survey would be. We were at 6.8 earlier. Look, there are two things happening. One is on the trade side. This is just the arithmetic will get you better. We have also brought down our current account numbers from -1% of GDP to -0.8% of GDP. But what we haven't yet baked in, because that is more second half of the year or possibly to the second half of more of the fiscal year, is that the investment uncertainty, our understanding would have held back investments, private capex. And therefore, with this uncertainty overhang now gone, some of this we think will come back in a couple of quarters' time. As Arup mentioned, you're already seeing the turnaround in FPI flows. You're already $1.5 billion positive in the first 10 days of February versus about $3 billion negative in the month of January. So you can already see the sentiment changing around a little bit as we close in on the deal.
Okay. Since you refer to the current account deficit, let me take you up on that. You have cut, as you said, the current account deficit 2.8, that is, you brought it down by a quarter percentage point. Is there not a fear that it can also rise? One, because we may have to purchase slightly more expensive crude oil, and two, because we have a gun to our head in terms of having to import more from the United States. So is it not possible that trade deficit actually takes a hit?
Oh, the way it works out is not like linear arithmetic, right? So, you know, what we call is the general equilibrium is what will work out eventually. You're having multiple trade deals getting signed. We think this will be eventually quite positive for India's export potential also. The other thing that, you know, throughout the last couple of years we have found is that services exports have consistently been surprising on the upside. Even if you hold it constant as a percentage of GDP, which means that you're not letting it grow much faster than what the overall economy is growing, we think that you can contain the current account deficit within 1% of GDP. The point where it expands beyond, and let's say goes to 1.5 or 2% of GDP, can be mirroring a very strong capex cycle. So if you have your investment growth very high, at that point of time, you can have imports of machinery products and so forth, which can expand your current account deficit. But that will be, again, mirroring very strong growth on the public capex, on the private capex side. So overall, that is good for the economy. I mean, look, the main point I want to make is that, the uncertainty overhang was quite a big deal for FII investors as well as private capex. That is gone. And therefore, in the second half of the year, you're going to see some of this capex come back, and you're already seeing the turnaround in FDI flows.
Okay. Yeah, I agree. FDI flows have been good, but it was the net FDI which was a pain, not really the gross FDI. But I'll come to that in just a minute. Arup, what's your sense about how the Reserve Bank may act? Is it likely to allow an appreciation? I mean, just, speculating that as we come towards March, it is usually a BOP surplus month. And we could see both exporter sales as well as FPI sales of dollars, that is. Do you see the Reserve Bank resisting appreciation?
Lata, I think Reserve Bank has been very clear in their policy of stalling excessive volatility. So I don't think that they will have any levels in mind. If there is an excessive volatility, even there is an excessive appreciation, and that's what I said, you might see some amount of buying of dollars coming from RBI in that scenario. But I doubt whether there will be any targeted buying or a targeted level which they would have in mind. They have stuck to the fact that we will control volatility, and that's about it. So I don't think too much of an appreciation would be there, as I had mentioned on the levels. Just one point on this, the import part, which there is a lot of talk that India will have to import excessively from US. See, the fact of the matter remains that India will import what is needed. Now, the country basket may change. And also the talk about the quantum that people are going around, that's over a period, over a medium-term period. So it's not that the first year itself, it's equally divided into 5 equal buckets or something like that. So
No, it's not.
So that's the point. So as Shantanu did mention, I mean, only when the capex cycle picks up, you'll see a more imports kind of a thing picking up. But otherwise, it will be a more distributed thing. And some of these agreements are, or a part of the agreements are already in place. We are looking to, as in the private sector, we are always looking to buy some of the from the aircraft industries and all that. So those are there already. I mean, so this 500 may actually subsume into all those.
No, I agree with you, but there have been experts who have done the math, and even if you look at all the aircraft delivered and deliverable by Boeing, it works to about $60 billion. $500 billion is still a distance away. And there was this overnight scare, which was very wild on social media, that White House changed the word, intends to import 500 billion to commits. India commits to import 500 billion. And in a few hours, that word went back to status quo ante, and it became intends to import. So, we are living in very shaky ground here. But that apart, Shantanu, are you, worried that there can be impact on Indian industry because of cheaper imports?
Ultimately, over time, Lata, you just become more competitive, right? With more imports of goods which are not strategic in nature. And I think the government is being very astute about keeping strategic sectors away from completely opening up. Okay. And you're having multiple deals across the EU, the US. There's been a UAE already, and there's conversations on the GCC going on, New Zealand, and so on. So I think what I would say is that overall, we are becoming a more open economy. This will mean more products to choose from. We have become more open since the last 30 years also. Ultimately, it's meant that, Indian industries have become more competitive. So, over the medium term, we would not really look upon this as a big threat to industry. Okay. Ultimately, what is important is for the private capex cycle to really pick up. And if the uncertainty overhang, makes that possible, we think a lot of these problems will be behind us. Okay,
a bit of a rapid fire because I want to get some numbers from both of you. Shantanu, your rupee range for the next quarter and for the year?
Yeah, we are at 90.92. We don't think this is going back below 90. A, you have a short forward book. B, if even at a 0.8% of GDP current account deficit, we think that it is appropriate that the rupee will be in the 90.92 range and maybe a little bit higher over the 6 to 12 month period, around 93 odd.
Oh, 93. Okay, I got a 94 in my previous discussions with...
Our 12-month forecast is 94, but over a 6-month period, we are at 92, 93.
Okay, then not very different. Arup, would you see 93, 94 this year itself?
No, I would tend to agree with Shantanu. Okay. The numbers are similar.
All right. A quick word. I mean, it's a difficult question because tomorrow we are going to get a new series of the CPI. But regardless, there is a huge borrowing program. So what are you expecting in terms of 10-year yields, Shantanu, for the next quarter and for the year?
As you know, we do not put out a forecast for the 10-year, but I would say that the curve remains steep, given just the mix of policy now, both on the borrowing side as well as on the RBI. The RBI, again, the steepness is mainly, the long end aside. On the short end, I think what's going on is that they're being really committed towards injecting liquidity.
Yes.
And that will keep the short end sort of anchored. The very short end, I mean, the overnight sort of anchored. Yes. Whereas this borrowing program overhang will remain on the markets for a bit.
Yeah, both happened overnight. The call yields and the TREPs went down to 4.25 actually, 4.5. And we saw the SDL, the state loans, keeping the 10-year up at 6.7372. Arup, your range, at least for the quarter, for the 10-year?
I think the upside will be capped around the 675, 680. I don't see the 10-year yield going beyond that. Downside, I think maybe a 660, but that depends on what kind of a liquidity support suddenly comes in, if it is required and all. But I think it will be a very narrow range for the quarter.
Okay. All right, we'll leave it at that. We'll have many more impulses when the new GDP series comes and tomorrow when the new CPI series comes to ask you all fresh questions. Thank you very much, Shantanu and Arup, for joining me. We wrap up on Bazaar on that note. Chartbust is coming up.
Well, auto stocks are top sectorial gainers today, led by multiple triggers. Eicher Motors is the top gainer on the Nifty, led by a good quarter in the third quarter. Tata Motors CV surges on massive order coming in from Indonesia, while strong earnings also keeps Samvardhana Motherson higher in trade today.
Apollo Hospital delivers a stellar third quarter with performance from all segments beating expectations. The management also tells CNBC TV 18 that volumes in the hospital business are likely to improve further. The stock rallies 5%.
Britannia is the top gainer on the FMCG Index. The stock rallies on strong margin expansion and growth momentum across categories in the third quarter. Nomura is also bullish on the stock. They have a target price at 7,000 rupees a share.
And BHEL is the other stock that has been under pressure today, and this is because they have announced an OFS which is at a discount of 8% to yesterday's closing price. That is the reason that the stock is falling in trade.
Afcon's infra is under pressure. The third quarter profit falls 35%. East Indian Hotels too slumps on weak numbers as profit falls and margin contracts in the third quarter.
Hello, good morning. You've tuned into Chartbusters, coming live from the CNBC TV 18 Motilal Oswal studios. I'm Vinny Motiwala. With me is Nigel D'Souza as always. Nigel, good morning. Today I'm going to say that both of us are anchoring and now the markets have recovered from the day's low. It's again in the green, 25,970. So closing near that 26,000.
Always good to have you on the show, Vinny. Busting the charts as always. Good to have you in. Well, we've got a couple of management, so let's get straight to that. Let's welcome Mr. Yogesh Malhotra of Gravita India. They have gone ahead and they've done some inorganic growth. And this time around, they are looking at the copper space and Rashtriya Metal Industries. That's the company that they're looking at. Hi, Yogesh. Good morning. It's been a while since we spoke. Congratulations first on this particular acquisition. The street was wondering whether you're going to go into non-lead. Will it be plastic? Will it be aluminium? Out of syllabus this came. You're gone into copper. Give us a couple of details though. First, by when does this particular deal get closed out, the transaction that you're looking at? Point number one. Point number two is, how do you fund it? You'll have some money, you'll raise some money via the QIP. So how do you fund it?
So we are expecting this deal to close by 31st of March. And as far as funding is concerned, I think our overall plan is around to spend around 1,200 to 1,300 crores in capacity expansion by FY29 to take our capacity from current 3.3 lakh tons to around 7 lakh tons. Which includes greenfield projects, brownfield projects, and merger and acquisition opportunities. And it would also require an additional working capital of around 1,000 crores. So all this will come from our internal accrual and some surplus from the funds that we raised through QIP last year.
Okay. And this 565 crores
is included in this 1,200 to 1,300 crore.
Okay, it's included. So you won't be taking any fresh debt on your books, right?
Not right away, no.
Okay, let's focus on the acquired asset. Then we have the profitability. EBIT is close to around 60 crores and EBITDA, and you have revenue of around 900 crores. What is the revenue potential of the asset that you're acquiring? If you could help us out with that. And how do you see it grow? Because it's moved from a 550 crore revenue number to 900 crores very, very swiftly. So if you could help us out with that.
So copper demand is increasing. I mean, there's no, I mean, it's very, unknown fact now. So the ROIC currently is around 14% and the PAT last year was around 27 crores, I think, yes. And it comes to us at a very good valuation of around 10 EV to EBITDA ratio based on the FY25 numbers. But there is a great opportunity to grow here. I mean, if you look at the total capacity utilization, it stands currently at around 50%. And there's opportunity to improve it to around 65 to 70% by doing some debottlenecking of existing capacity. And then, of course, there is opportunity to increase the current capacity also to around 50,000 metric ton per annum to meet the increasing demand of copper products, which is already planned, but was put on hold as the current owner wanted to exit. So both capacity expansion and the better utilization would probably give us good growth opportunity in this asset.
Okay, good growth opportunity in the asset. Yogesh, I also just want to understand, you're completing this by 31st of March. You'll start seeing the synergy benefits coming in from FY27, I believe. And obviously, what does it mean for margins? Because seems like at least FY25, what I'm looking at, your margins for RMIL was around 6-7%. What will it mean for the company's margins?
So there are going to be some synergies in place because they are using some scrap for their products. We would definitely optimize on that, which is our strength. And on the marketing level also there would be some synergies because in some of the sectors that they are present, we are also present. So that will optimize our marketing effort also in those segments. But apart from that, I mean, if you look at, as I mentioned, that the current capacity utilization is a bit lower at 50%. So by debottlenecking the entire capacity, we would probably improve those margin numbers also going forward.
Okay, and you said that you want to take it to around 70%. Just if I look at it mathematically,
yes.
it was doing around 900 crores. So say in FY27, it could contribute close to 1,200 crores. Will that be fair? Last year, 25, it did 900 crores odd. This year, there'll be some growth. Next year as well, there'll be some growth over here. So FY27, yes. Around 1,200 crores from this asset?
Yes, definitely.
With margins of around 8-9%?
So too early to say that, but definitely we are looking at that margin number.
Okay, high single-digit margin, or do you want to extend it to double-digit?
High single-digit margins, yes. Right.
All right, got that then. So there are synergy benefits as well that will be worked out. Normally this copper business is a working capital intensive business. And sometimes, that gets stretched a little bit. How do you plan on, mitigating this risk? And also if you could tell us the ROIC for your core business, I think it's 20-25%. You've been mentioning that as well, that you want to hold it around 25%. Now the acquired business is at around 14%. So how do you see this pan out for the company on the whole?
So the business is very similar in nature to our current business, and the current working capital cycle is around 80 to 90 days and would not have any adverse impact on our existing working capital cycle. Going forward, we see some improvements on account of better capacity utilization, as I mentioned, and the ROIC also, which is currently at around 14%, because of the same reasons of improved capacity utilization and the growth opportunity that is there to optimize the overall capacities, and not to mention the benefits that will come out of backward integration when we start recycling gears. As I mentioned, that they use part of recycled products, but it's not optimized yet. So all these will, we are very confident, lead us to that 25% ROIC from this acquisition also, once everything stabilizes.
Okay, 25% ROIC is what you're saying that will come in even from this acquisition. Post that also you will be able to see that. Yogesh, could you help us maybe with the outlook for your core lead business in terms of volumes as well as EBITDA per ton? What are we watching out?
So lead business would continue to grow at around 18 to 20%, and the EBITDA numbers would also stay stable at around 19 to 20 rupees per kg. We have some capacity increases lined up at our Mundra and Phagi plant, which is expected very soon. So overall, I think we are well on course to achieve our 2029 targets of around 35% growth on bottom line numbers and 25% growth on the revenue numbers from lead as well as other verticals that we are having right now.
1,000 crores of EBITDA by FY29, should that be possible?
So it all depends actually, but we are on course to achieve what we mentioned that we would do. Exact numbers would probably not be right now, would not be possible for me to just tell you right now whether it will be in 29 or 2030. But we are very on course to achieve our targets of 25% revenue growth going forward.
No, sir, the reason I tell you that is, see, on a quarterly run rate, you're doing 130 crores. Now, that means you're doing already 520 crores of annual EBITDA, right? Then you're talking about growing by close to 20% at least, for the next few years. Add to that, this asset will contribute close to under 100 crores. So 1,000 crores of EBITDA is possible by 2029, 2030?
So definitely possible, and probably could come a little sooner also if we go and acquire some better asset going forward. So it's only, so what we are doing is, what we are planning to do is whatever we are doing, let us focus on that. Let us focus on growth. And the numbers are just the byproduct of all of
And you're hinting at another acquisition?
No, not right now. But there are opportunities. We are looking for these opportunities. as I mentioned that, the growth of 25% would come from both brownfield projects, greenfield projects, and acquisitions. So these things are interchangeable. You can't expect exact numbers from all these things. So there definitely are possibilities. If we get something at the right value, we would definitely go and acquire those assets also going forward. But not right now. So we are targeting quite a few acquisitions, both in India and overseas. But whether those will materialize or not, all depends on how it goes.
Okay, all depends on how it goes. But Yogesh, thank you so much for joining us this morning, talking to us about the new acquisition that you've made. EBITDA, we'll hope for the 1,000 crore, FY29, FY30, and synergies will start coming in from FY27 for this new acquisition as well. On that note, we're going to step into a very short break. We'll be joined by Yash Sharma of Ganesh Ecosphere to discuss their earnings as well. So stay tuned in. Welcome back to Chartbusters on CNBC TV 18. Let's bring on board the next management for today. We have Ganesh Ecosphere's Yash Sharma, who is the director at the company, to talk to us about the outlook of the company going forward, Q3 was a bit of a turnaround quarter that came in, especially in terms of profitability for the company. Revenue was a bit muted. There were a few challenges that came in from the company due to some regulatory issues. What will that mean for the company going forward? We'll discuss all of that, as well as the outlook in FY27, as well as end of Q4 FY26. What's the expectation there? Thank you so much, Mrs. Sharma, for joining us on the show. Let's start by talking about the regulatory issues. Those are the specific challenges, which is leading to a bit of a problem for the company in the last few quarters. Could you update us on what is the recent notifications that have come in here from the Ministry of Environment, Forest and Climate Change, and what does it mean for the company? Will it start easing off in Q4 and onwards?
Yeah, thanks. So, yes, the regulation to start using recycled content in all rigid applications is already there. What happened really last year is that on June 3, 2025, due to shortage in the capacity to produce food-grade recycled PET material was there, so the government came out with a draft notification saying that, okay, we understand there is a capacity shortfall, so you can carry forward the shortfall over the next 3 years. But what really happened as an aftermath of this draft notification is that the industry started reducing and started postponing their usage of recycled materials for the future. This really led to reduction in the volumes, reduction in the market size, and at the same time, a lot of capacity got added and got implemented in India. As of today, the draft notification has not been converted into a final notification, and we are still awaiting the final notification from the government side. It's very important to understand that the regulation is already there. It's already live. And as per our feedback and interaction, very soon we will be hearing the final notification from the government, which will be mandating the use of recycled content. And definitely for the next year, the target stays still the same and strong at 40% of recycled content.
Yash, this mandate, there's also a thing that is coming in that brands will face a 40% recycled content mandate, right? From FY27, I believe. Is that right?
That's right.
So then what does it mean in terms of visibility for you, long-term agreements? What are the talks that you're having with brands as well then?
So definitely we are in talks with all the global brands and as well as the national brands in India to supply high-quality food-grade RPD to them. A lot of long-term agreements are already under discussions. Everyone is just awaiting for the final notification to come out with the revised targets. But
then will you start seeing a growth? Sorry, because right now Q3 was muted. So in FY27, could we expect growth to come back?
Yeah, definitely. We are expecting that from FY27 onwards, the industry should come to very good utilization levels because now there is ample capacity to meet the regulatory demand. And the brands will be starting to use the material in a very big volume way.
All right. Hi, Yash. Good to see you. When sometimes that happens, right? You brace yourself for a good time and unfortunately the regulation doesn't come through, which puts the business into a bit of a tailspin. Give me a couple of details. Your legacy business seems to have done pretty well in the last quarter. So tell me, what is the capacity utilization levels, both in the legacy business as well as the new business, the RPET business?
So in the legacy business, we are running at almost north of 100% utilization levels. We are producing at the very optimum and maximum possible capacities, and even the sales are doing quite well.
Okay.
And offtake is also doing quite well. In terms of subsidiaries, we are currently at around 50 to 55%, which we are expecting to improve.
Okay, improve to what level?
So going forward, I think immediate improvement we see around 70%, but going forward, I think in FY27, once the new year starts and the brands start to implement the 40% regulation, it will be much better.
Okay, that's the hope that you have out there. Got it. So you're saying that implementation, but is there any risk to that implementation FY27? And then there'll be a risk to you moving to 70% also?
See, I don't think there should be any risk to the FY27 targets because the reason for which the FY25-26 got rolled back was at the start of the year there was a capacity shortfall, and that was the basis of the industry getting leeway from the government to postpone the targets. At present, the situation of India is that we have ample capacity to meet the 40% targets. The capacity which is already approved by FSSAI and which is under already approvals. If you take the total number, we are on way to reach the 40% capacity number of the demand of the market. So there's the grounds for them right now to change any regulatory.
Okay, all right. Yash, and you believe that the realizations as well have bottomed out, which were under pressure?
Realizations really depend on the raw material prices, Nigel. What happens is our finished goods prices are a cost plus to the raw material prices. Now, since the demand of recycled content crashed, the raw material prices has also crashed as well, which obviously led to low realizations. So for us, it's like a cost plus mechanism for the finished products.
Okay, Yash, final question before we let you go. You used to do an EBITDA of around 50-55 crores. That came down to around 20-25 crores. Now we have seen an improvement on a sequential basis. That's why the street is excited. Do you believe the EBITDA margin and the EBITDA number in Q4 will be better than Q3? And do you see an improving trajectory from here on? And you had put money as well at around 1,035 rupees. What do you have to say to your shareholders? The stock has come down by nearly around a third from the top.
So Nigel, yes, our EBITDAs are improving. This quarter, we've done an EBITDA console level at 30.73 crores, and definitely we are expecting improvement in the overall performance in the coming quarter as well, albeit a marginal one probably in this quarter we're expecting. But going forward, definitely as the subsidiary businesses ramp up and the utilizations improve to around 85 to 90% levels, we'll definitely see a big jump in the overall financial performances, which we are very, very hopeful for in the coming in FY27. Now coming to the valuation and yes, the promoter had infused about 150 crores on warrants in January 2024 at a price of 1,035, which was the SEBI price mechanism at the time. We think that after that, a lot of value creation has happened in the organizations. We have created massive capacity to supply RPG to the industry, filament yarns. We have created a very strong brand in the country, which has been very, very successful till so far in the industry to cater to the regulatory demand, which is going to come up, if not today, tomorrow. And I think there has been a lot of value creation, just that we are waiting for that market to be created to encash that value. So I definitely think that there's going to be a massive value creation going forward.
And all those warrants have got converted, right?
Yes, that's correct.
Okay, all right. Thanks a lot for joining in, Yash. We'll have to watch delivery because, the last quarter was a little better than the previous one. But as you're saying that things should improve from here on, we'll have to track that on that front. Appreciate you joining in and giving us all of those details. For the time being, slip in a short break, come back, more on the markets and stock-specific action.
Fly Emirates, fly better.
Welcome back to Chartbusters on CNBC TV 18 with the Nifty in the green, but the mid-cap that's given up some gains and trading in the red. So broader and the market seems like some bit of pressure, at least for the Nifty mid-cap. Banks still managing to hold on to that slight bit of a green there, but we are absolutely out of time on this edition of Chartbusters. Thank you so much for tuning in. Up next, your Trading Hour.
Hello and welcome to Trading Hour, live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra, and with me today is Ritu Singh, joining from the Bangalore studio. Ritu, good morning, and we're somewhere in the middle right now. We are off 50 points from the highs of the day, but up 50 points from the lows of the day as well. But yes, below that 26,000 mark, which we did cross today. Mid-caps are lagging, and there are select names which are not doing so well. But the auto index, that is the one which is the top gainer as we speak. It's been quite volatile so far. but nevertheless, mid-caps continue to be on our radar on the back of earnings reactions. Yesterday, this index was one of the top gainers, but today there seems to be some profit booking. It did recover from the lows after falling from opening highs. So again, not a definitive move on mid-caps for now. But Ritu, we are very close to the end of earnings season, so a lot of numbers trickling in, and how?
Well, we are in the last lap, hi Sonal, of that earnings season, but that doesn't mean there's very few numbers to look at. A whole host of earnings lined up today that the markets will be reacting to. Yeah, the broader market pain continues, but look at the market breadth. It started well, but now those lines have crossed, and now more stocks are declining than they are advancing. You talked about the auto sector, but look at some of the PSU names, for instance. SBI is one such name. Pull that up. It's surged in just the last half hour of trade. In fact, it's one of the only PSUs that is in the green. Apart from that, auto, pharma, PSU, these are some of the indices that are doing well. IT, energy, metals on the downside. But let's also get you a quick check of where the macros for the day are. The rupee, now that was a star performer yesterday after that sustained pressure that we've seen. It gained, in fact, almost 0.25% because of the inflows, and it was one of the better performing currencies across the emerging markets. Today, again, we're seeing the rupee appreciate further in trade, now trading at 90.5 to the dollar on the back of a softer dollar as well. The 10-year yield, though, it got some support from the favorable liquidity conditions, the higher foreign inflows that have been coming in the debt segment as well. You have the 10-year, the benchmark yield, slightly higher today, 6.73 is where it currently is trading. And crude prices, of course, they continue to track all those developments in the US-Iran peace talks. Now higher, Brent higher by about 0.5%. That's at 69.2. So that's where the setup is today. But, a whole host of numbers that we've been focusing on. Let's start with Eicher Motors. Now, that is one stock that's trading higher in trade today after posting a very good set of third quarter numbers. Sudarshan is joining in to do all the number crunching for us and what stood out from their earnings. Sudarshan.
So it's a top Nifty gainer, up currently more than 6%. Till last quarter for Eicher Motors, there was one concern related to the margin, because margin was under pressure till Q2 FY26. Company was finding difficult to cross the level of 24 or say 24.5%. But this quarter, because of the operating leverage, better mix, and the company taking the price increase, now company has delivered margin of 25.5%. This is the highest that we have seen in the last 5 quarters. And also, company is saying that EBITDA has outperformed both revenue and volume growth after several quarters. On the volume front, both commercial vehicle as well as Royal Enfield continue to see healthy volume growth. In Q3 FY26, Royal Enfield volumes had increased by 21%. Commercial vehicle volume was up 24%. And because of this, in Q3 FY26, revenue has seen an increase of 23%. EBITDA has moved higher by 30%. And margin, as I've told you, it has come at 25.5% versus 24.2% in the same quarter last year. What about the outlook? Even outlook remains strong. For Q4, company is saying the strong momentum that has started post the GST rate cut and during the festive season, it will continue even in Q4 FY26, and even in FY27, company is saying that industry, that is motorcycle industry, may see high single-digit growth. So overall, because of the strong earnings and the positive outlook, you are seeing a big gain in Eicher shares.
Big gain, 6.5% as we speak, the top Nifty gainer. But you have another stock on your radar, Sudarshan, BHEL. It is slipping in trade today. The government has announced an offer for sale. Tell us more details. What does it mean and what kind of shareholders can subscribe to this right now?
So that was expected. It was about when does government announce that. Finally, government has come out and announced that it's going to sell up to 5% stake via offer for sale. So base size is 3%, and the green shoe option, if government decides to exercise that, for that it would be 3%. And the floor price is rupees 254 per share, which was 8% discount to yesterday's closing price. And today also you can see that share price is hovering around 260 rupees per share, and total size, if you calculate as per 5% and at the floor price of rupees 254, total size comes around 4,420 crore. Now, of OFS for non-retail portion has opened today, and for retail portion, it will open tomorrow. And because of the discount that government has given, you are seeing a big downtick and currently down almost 6%.
Currently down almost 6%. Sudarshan, thanks very much for bringing us that update. We have to slip into a short break, but don't go anywhere. We're back with the bond market action with Manisha Gupta in just a bit.
India Bonds presents Bond Street.
Welcome back. As promised, let's shift focus to the bond market. Manisha Gupta joins in as always. Manisha, over to you.
Thank you so much for that. On Bond Street today, I'm talking about various bond issues which is likely to hit the Indian private placement market for you to take a look at. Some very interesting names coming up though. The first one on my list is Tata Capital Housing Finance Limited. They are looking to raise 7.5 billion and they are trying to do this via the 2-year bonds therein. There's also Bajaj Finance looking to raise 10 billion rupees and they're also doing it through 2-year bonds. Both of these companies are inviting bids today itself. IFL Samasta Finance Limited is also looking to raise 2.75 billion. There is also Finca Financial Services looking to raise 600 million. They're doing this via 12th November 2027 bonds therein. And then there is also Adani Ports Holdings Limited. They are looking to raise 15 billion through 3-year bonds there. Take a look at also at the Aptus Value Housing Finance India. They're looking to raise $1 billion via 5-year bonds. You have Small Industries Development Bank of India. They're looking to raise nearly 80 billion. This is through the April 9, 2029 bonds therein. You have National Bank of Finance Infrastructure and Development looking to raise 40 billion. They are doing this via 10-year bonds. And on the list also is Power Finance Corporation Limited. 40 billion is what they're looking to raise via 2 bonds. There is Immensity Office Parks Limited looking to raise 3 billion via 16th August 2030 bonds. There also is board approvals which have come in for REC Limited. They are looking to raise a big 1.5 trillion. This is via NCDs in 1 or more tranches therein. And then there is Prestige Estates looking to raise 20 billion. JSW is looking at 50 billion. Torrent Power Board also has approved nearly 30 billion via NCDs. And there are also approvals coming for Axis Bank, which is looking to raise 350 billion via debt. Bank of Maharashtra is looking at 100 billion via infra bonds. This is for FY26. So a long list, big list. Much of that is inviting bids in this week itself, something that you can go through.
Okay, interesting list there. Thank you so much for joining us, Manisha, with those updates. With that, we'll slip into a break. When we come back, we'll be joined by the manager of IndiCube Spaces to discuss their Q3 results and the way forward.
CNBC TV 18 and India Bonds presents Bond Street.
We have carefully reviewed your performance and promoting you to branch manager.
Sir.
37% revenue growth. EBITDA is up almost 80%.
Yeah. So thank you so much for giving us the opportunity to talk on this. And we are very confident that whatever we have achieved in the 9-month period, I think when we close the year, we should be pretty much on similar numbers. And as you talked about the guidance for the next year, I must highlight that as of now, if you look at our total area that we have, which is occupied, is about 6.3 to 6.5 million square feet. And our total AUM is about 9.5 million. So we have a headroom of almost 3.2 million square feet, which will get leased out pretty much over this quarter or the next year. So we have a lot of headroom for growth, and we are very hopeful that we should be north of 30% growth in FY27 as well.
To say
Okay.
headroom.
30% growth for FY27. Rishi, hi, this is Ritu. Your area under management, your center seats, they've all grown by about 19%. Over the previous year, occupancy has also improved to more than 80%. But as you expand, you add more cities and more centers. How will you ensure that this occupancy level doesn't get diluted? I mean, so to speak, what is the red line between growth and utilization?
So we are very focused on the occupancy along with the growth, and at the same time we maintain a good headroom for growth. So our philosophy has been that when we look at the entire country, we have classified the whole country into different micro markets. So there are about close to 50 micro markets which we believe are good performing micro markets. And when I say good performing micro markets, their occupancy levels in these micro markets are between 85 to 95%. So these are the good micro markets which we continuously track, and we look at basically deepening our presence in those micro markets to a newer supply additions. And if we choose our markets well, I think that is the first and the most important thing. And then we look at other factors like proximity to metro stations, the location advantage, picking up full buildings most of the time, unless until they happen to be grade A tech park kind of spaces, so that the assets needs to have a lot of defensibility in terms of its quality as well as in terms of its location. And then the last but most important is the quality of services. So as a result of that, our retention of clients has been very, very high. Okay. And that has ensured that occupancy levels are continuously high.
So around 84%, that's the occupancy.
Yes.
How much of it has come in from mature centers? What is the occupancy for new centers? How long before you break even? And just coming back to my first point, you said you'll be able to maintain the 9-month growth in FY27 as well, right?
Yes, yeah. Yes, that's true. And we have the classification that centers which are more than 12 months old, we classify them as steady state centers. And our occupancy in steady state centers is about 91%. At an overall portfolio level, we are at 84%. And if you look at less than 12 months centers, which is the other classification, will be about 81-82%. So that's the broad mix. Plus, from the time we start paying rent to our landlords for any property, we typically take 5 to 6 months to reach 50 to 60% occupancy. And that is our operational break-even. And in less than 12 months, we are able to reach 90% plus occupancy in most of our steady state centers.
So to assume within 5 months you achieve break even in these new centers, yeah. But Rishi, your net debt has become quite low. You also have some capital you're sitting on. Where would you be deploying that? I mean, are you looking at more expansion? What are the areas you're looking to enter, say, in the next 1 or 2 years? And what will be the highest drivers of growth? I mean, is it the top metro cities, the emerging markets? Give us a breakup of that.
Yeah, so basically, like as you are aware, we last year raised about 650 crores of capital. And a large part of that capital is already available with us. We used a part of it to repay our debt. And that is where you see our debt has extremely low over there. And the bulk of the money that we raised is going towards the capital expenditure for our expansion into fit outs and other stuff. And our lot of growth, I must say, in terms of area at least, is going to be in tier 1 cities, typically Bangalore, or look at other Mumbai, or for that matter, even NCR, Hyderabad, Chennai, all these major metros. And we will continue to grow into the tier 2 cities. Like, for example, if you see in the last year, we have added 3 new cities. And the last quarter, Q3, we added Bhubaneswar. So we see that city addition will continue to happen, even though the tier 2 cities are small in terms of their footprint. But yes, we see a lot of promising growth. So bulk of our growth in area will come from tier 1 with a lot of footprint expansion in tier 2.
Okay. Rishi, you mentioned that you have an AUM of 9.5 million square feet, out of which around 6.5 you're able to use. So there's some leeway for growth. So does that mean you'll not do more addition in your assets under management until you reach a level of utilization, or you will continue to add and that will get added by seat additions as well?
Yeah. So absolutely right. So AUM will continue to get added. If you look at, like, we have been adding 1.5 to 2 million every year, and we see that FY27 will be no different from that. And we have a good pipeline. And a lot of buildings which we take up, we mostly go when the buildings are getting constructed at the greenfield stage or under construction building. So as a result of that, we have a 12 to 18 month lag from the time any asset is signed up and by the time we occupy that asset. So the point I was highlighting was that this 3.2 million that we have immediately available, which will now start becoming available, large part of it in FY27. So that gives you an idea that from 6.3, if I have to go to 9.5 and I have to manage an occupancy level of 85% odd, there is a lot of growth that we are looking at happening due to this AUM. Plus AUM addition will continue to happen.
Okay. All right, Rishi, it was a pleasure speaking with you. Thank you so much for joining in today with your thoughts and the outlook on the business going forward. That's the word coming in from IndiCube. They expect the growth to continue, and this will be driven by additions across micro markets, be it tier 2 cities, but majority growth will come in from the tier 1 cities. Slip into a short break. When we come back, we'll discuss market fundamentals with Shiv Diwan, MD and head of Nuvama Institutional Equities, from the sidelines of the 21st Nuvama India Conference.
Welcome back. The frontline index now trading with gains of about 25 points, holding on to that 25,950 odd mark, still above the 26,000 level that we're watching out for. SBI, Eminem, Eicher Motors, some of the names supporting, the markets in trade today, while HDFC Bank, and then you have some IT names like Infosys and TCS dragging the markets lower. But let's get in Shiv Diwan, the MD and head of Nuvama Institutional Equities, who is joining us now from the sidelines of the 21st Nuvama India Conference for his views. Shiv, thanks very much for being with us here on CNBC TV 18. To begin with, what's the mood like at the conference? You've been speaking to a whole host of companies and investors. What's your one big takeaway?
First of all, thank you so much for getting me on the show. It's been a great couple of days. Today we're on day 3, so hope this is the final day. And I think it's been a mix. We've had a huge number of domestics and international clients coming in. I think we're talking about almost 1,000 individual investors over these days. And I think the mood is interesting. On the one hand, we have quite a few people who are now starting to look at India from thinking that it's now becoming much better. Earnings are starting to sort of gradually come back. We are seeing some green shoots of recovery on that front. Initially last year around, we had some of these companies that had sort of gone up very high in terms of valuations, and earnings were yet to play catch up. We're starting to now see that slowly and steadily. I mean, you've seen some of the large names like Titan, L&T, SBI, etc., that have come up with good numbers. So the expectation is that from here on, things should start getting better.
All right. Shiv, most of last year, we saw these domestic flows being the big shock absorber for the markets. But now, the past few sessions, we've seen foreign investors come back. There's been some net buying that we're seeing on a day-to-day basis. What's your sense from, your FII clients you've been speaking to? More of a tactical trade, or structurally, are you seeing a shift that is underway with the trade deal that we have and some of the earnings improvement that you yourself spoke of as well? And where is this incremental money from the FIIs really getting allocated to?
No, it's interesting you mentioned that. Yes, we've had 7 months of negative flows from FPIs, and we've started off this month pretty well. We've had a few days of positive flows, so we're hoping that continues. But yes, based on obviously on the sidelines of this investor conference, we have been having multiple conversations. People are keenly watching this space in terms of where the pockets of growth are, where things are starting to look more interesting. There are, of course, a few sectors which I can get into later, but there is definitely an undercurrent that people do want to start looking at India, and I think to start off with the large caps, and then maybe a quarter or two out, I think you should start to see the same sort of excitement developing in mid caps and small caps as their earnings start to play catch up. So yeah, that's the way we're looking at it. Of course, I should also add the caveat that while valuations have become better on a relative basis to other emerging markets, I mean, at the start of last year, our premium to other emerging markets was at probably 70%. We're now at about 55%. So it has definitely come back to its long-term averages, and which is sort of got people to start looking back at India. But when you look at certain stock-specific or sector-specific action, there are names in India that are still a little more expensive than people would like, especially on the FII side. And the fact that we've been seeing strong domestic flows, for the last 48 months at a stretch, that gives us the feeling that you won't find the Indian markets becoming too cheap ever. So people will have to start to take that call sooner rather than later.
Okay, so when we talk about sector-specific calls that some of these investors will be taking, Shiv, what do the conversations suggest? Where are they finding comfort now? And what still looks very highly expensive to them? Or I would say they wouldn't want to put their money there.
So from an FPI perspective, I think banks obviously still take center stage. They still believe, most of these banks are looking good, and with the government's consumption push, with the recent rate cuts, banks are still in a good position. And I mean, we saw that with SBI's numbers as well. And like I said, I think this is a space that offers the kind of size and liquidity that FPIs would like. So that is definitely center stage. Autos, as a sector, has done really well, but people are still quite enthused about it. bit. We're also starting to see some sort of excitement building up on chemicals after they come back from a longish capex cycle. So there are some green shoots of recovery there. And then healthcare and pharma is another space people like. I personally believe that, while tech has had a brunt of the pain over the last few months for various reasons, and the most recent one being AI, which has, taken up a lot of conversations over the last few weeks and especially over the last 2-3 days. Numbers and have seemed to have sort of come off quite a bit there. And so that could be an interesting play over the next few quarters if they sort of are able to pivot from, being a service-oriented play to a sort of solution-oriented play.
Shiv,
those are some of the sectors that we've had multiple discussions.
So, Shiv, when FPIs were taking money out of Indian markets, the conversation was that maybe it's because of uncertainty around US-India trade deal. That's what the impact we saw on rupee as well. The other was there's not enough earnings recovery that is coming by. Some of it is getting reversed, right? We are seeing earnings recovery in select mid-caps. Now we have some finality on US-India trade deal as well. What are the other risk factors now that market participants should be aware of, or they are talking about it in the conference?
So I think you're absolutely right. The Europe trade agreement, the US trade agreement, all this is a step in the right direction. Government's consumption push, the rate cuts, all of this has, has been a very big positive from an India standpoint. The one concern which is common across a lot of the FPIs we speak to is still, like I said, the valuations. Not everything is still, very cheap. And despite the fact that you've seen, countries like Taiwan, Korea, China, Japan do extremely well, you still have a fair amount of pockets of stocks there that are still trading cheaper. And this is what most FPIs tend to highlight. Discounts or rather the premium at which some of these Indian good quality names trade at is still anywhere between 30 to 50%. So that's the only concern that people have. And like I mentioned earlier, that because of the domestic flows, I'm not sure whether that premium is going to change anytime soon. So people will have to take a call at some point as to whether they are starting to see that growth and earnings recovery and want to start getting in early.
Shiv, just a couple of things. I wanted to dwell a little more on the IT space, because the markets seem to be trading those companies more on this global AI news flow and what's happening every day with new models and the disruption that may cause than the company fundamentals. We've seen a bit of a decent quarter from some of the big heavyweight IT names here, and yet you're seeing the kind of route you're seeing in the IT space. What will trigger a re-rating from here? Any view also, secondly, on the mid-cap space?
Sure. No, I think on the IT pack, look, I think today, of course, there was some news around the H-1B visas, etc. This keeps coming every now and then. I don't think there's too much to read into that. But even over the last week, 10 days after what Anthropic and Palantir have been saying, there has been concern around, what happens to, employment on the IT side. But if you talk to some of the larger companies and in fact some of the good quality, high quality mid-cap IT names, they've been categorically saying that, look, IT is going through a little bit of a shift. We've seen this time and again, in the past many years, that every 5, 7, 8 years, you see some sort of a shift that takes place in this sector, and then most of these companies tend to come back. This time around, it's just slightly different because there is a little bit of risk in terms of, how employment is going to play out. But having said that, I think it's going to eventually have a positive impact on margins for these IT companies, and someone who can pivot extremely fast towards being solution-oriented rather than service-oriented, as I mentioned earlier, is probably going to be the prime beneficiary here. So it may not be as easy for every single IT company to come out of it, but at least those that can showcase this movement, I think should do extremely well over the next few quarters. And sorry, on your question on mid-caps, look, typically, when this kind of a cycle is playing out in the markets, it is the large caps that start to bring about the whole recovery process, and then the mid caps and small caps soon follow. I don't think this year is going to be any different. So for the first few quarters, it'll be a little bit more bottom up with large caps leading the way, and then as you go across this calendar year, you should start to see the small and mid caps also take part in this rally. But of course, it is not going to be extremely broad-based. It is definitely going to be far more of a stock-specific year than it was maybe 2 years ago.
All right, should we leave it at that? Thanks very much for taking time out and joining us from your conference, and we wish you the best with it. Thanks very much. Okay, we'll slip into a short break, but up next, we're going to be joined by the management of JN Resources to discuss their third quarter numbers and more.
Welcome back. You're still tuned into Trading Hour. JN Resource recycling in the stock on our radar. It is declining in trade today despite reporting good set of Q3 numbers. Managing Director Kamlesh Jain joins in to discuss the company's outlook and the way forward. Mr. Jain, good afternoon. Thank you. Good morning. Thank you so much for joining in. Well, you know, you are doing revenues of around 2,700 crore rupees per quarter. What kind of capacity utilization are you sitting at currently, and what kind of direction can you give? What number will you end the year with, and the outlook for FY27 as well?
So the capacity utilization is maximum for lead. We utilize almost like I think above 90%, and we are going to further enhance the capacity. And for copper, we are doing almost like 60%. We already have bigger infrastructure. And now we are getting more and more raw material. So the capacity will be very high in the years to come, in the months to come. And I don't think there's any problem to increase our production in copper.
Okay, so that's about capacity and capacity utilization. So once that capacity does come in, what kind of revenue numbers will you be doing it? If you can give us the quarterly run rate or the yearly number, because we're almost done with FY26 as well.
Yes. So if you see our historical growth, we've been growing at 40-50% year on year from last 10 years. And that's what the companies like a startup say, it's a unicorn. In 10 years, we have grown to this level. And we were growing 40-50%. And I strongly believe that we will be growing for the next year at same growth rate. I cannot tell exact number, but I'm sure about that. The historical growth of the company will be maintained because we are coming with 4 new other facilities. So this growth will be maintained for sure. And as we have told today in our earnings call also today, that the 4 new facilities of Ahmedabad plant, our antimony recycling plant, and our copper cathode plant, and one more capacity is going to be added for the copper. So this will help us to maintain the CAGR of the historical growth.
Well, Mr. Jain, even though you've had a margin expansion at 7% plus kind of levels in the quarter, it's still lower than some of your peers that we can compare to. Is there a structural difference that's causing this in the product mix, etc.? And realistically, how much of the gap do you think you can bridge in the near term?
So we are a multi-product recycling company. We are not alone to stick to lead. We do copper, we do aluminium, we do tin, we are doing plastics, and we are also going to add 2-3 more metals. So our margins at different segments are at different level, and I cannot comment on others. But as we are going for the new value-added product from next year, which is our cathode plant and wire rod and our bus bar plant, that will definitely boost the EBITDA margin. Maybe around, I expect around 2% to boost our EBITDA margin bottom line, which will happen from next year. And rest, if you compare with the peers, we are okay in the lead segment.
Okay, Mr. Jain, very quickly on your debt as well. I think after your IPO, when you did an interview with us, you had given us a guidance that your net debt will fall to about 500 crores. Where does it currently stand? And, when do you expect to reduce it? What kind of trajectory should we expect going ahead?
So there are 2 reasons for the debt growth. Because one is we have taken one big tender, which is the temporary jump in the inventory. And for that, we have financed that temporary jump in the tender, which is a big quantity of copper has come together. That is one. And I already said today in earnings call that this inventory will go down in next 3 months and will come down to the realistic terms. And it will reduce the debt to extent of almost, 300-400 crores. And the copper price also doubled when the last interview we had with me. And from that time, the price of copper has gone double. So the working cycle and working capital requirement also gone up to next level. That reason, the debt has gone up, but I am very sure. These are non-fund debts. Actually, these are not fund-based debts. Are non-fund debts which we open the LC to a supplier, and these materials are on the way. So this you cannot call actually in terms of debt, but it's a non-fund debts which will get reduced in the next quarter.
This is right now because of high copper prices that you had to take on. You needed more working capital basically, and that is the reason there hasn't been a reduction immediately. But that is something that you're promising could happen in the near future, the reduction in debt.
Yes, you're right.
Okay. Mr. Jain, I wanted your take on the EBITDA per ton as well, because it's highest for copper, followed by aluminium, and then you have lead. Do you maintain those levels, which is around 42,000 for copper, 18,000 for lead, and around 21,000 for aluminium? What is the chance of doing it better than that? And as you're saying, copper prices are rising. Does that impact your margins in any way? It's just for an understanding purpose that I wanted to understand.
Yeah, if you see the average of the whole year, copper EBITDA per ton is around, I think, 48 rupees approximately. I'm not the exact figure, but approximately 48 rupees for the whole year average. And I expect this EBITDA to go up to a very good level because of the value-added product what we are manufacturing, and from next year. Next year, our 4 new products are going to come, which is a copper anode, cathodes, wire rods, and bus bar. And in that 4 product, our definitely our value EBITDA of copper is going to go up to a great level. I can share the exact numbers later, but I know it is going to go up from next year.
Great levels. We would have liked that number, but you specifically said you'll share that later. Will it be around that 50,000 mark when you said, say, great level? What is that number?
Of course, above 50,000.
Above 50,000. By when would that happen?
If I want to give more confidence, it must be above 55.
Okay, by when would that happen?
We are going to start our production by next month for copper cathodes. So next financial quarter, the first quarter of the next financial year, you will see the numbers.
So will it only be for copper, or will it happen for lead and aluminium as well?
It is mainly for copper, and other, I think, will be maintained or a little bit up, but mainly for copper, there is a sharp jump.
All right, take that point. Thank you, Mr. Jain, for joining in today and giving us the outlook on the business, the capacity addition, and EBITDA per ton for different products as well. With that, we'll do one thing. We'll slip into a short break. When we come back, we'll get you more on the markets on the other side.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back. The frontline index, Nifty, still up about 17 points, giving up some gains, but the Sensex has slipped into the red. It's now down about 13 to 15 points as we speak. But let's again get you a check on the macro signal because we have some latest data coming in from RBI. Now, the latest data from RBI shows that credit card spends are growing, but the pace is actually cooling down. So the spends, they rose about 8.9% year on year to 2.05 lakh crores for the month of December, which is sharply slower than the near 14% growth that we saw a year ago. Now, on a month-on-month basis, though, credit card spends overall have jumped about 8.4%, and that is because of year-end discretionary demand picking up and steady e-commerce activity, which has continued throughout. But overall, the per-card spending has also risen to about 17,712 rupees for the month of December, which is up 8% month-on-month, which means per card, people are spending more. Again, you have your year-end promotions, e-commerce sales, a lot of travel, which could have led to that kind of a growth, although year-on-year, it was again modest at just 2%. Now, credit card penetration, it is rising because the outstanding credit cards have also increased to about 11.6 crores in December. That's up from 10.8 crore a year ago. But the credit card market itself, it is structurally concentrated, as we've been telling you, the top 5 to 8 players accounting for more than 80% of the total spends. And that shows you the dominance of some of these large PSUs and larger private banks with their wider distribution networks. Private sector banks, they do remain dominant in the network, accounting for 72.5% of the total spends in December, though that is importantly a reduction of 375 basis points over the previous year. Public sector banks, on the other hand, continue to gain some of the market share, with their spending share rising to about 22.2% from 17.7% in the last year. In terms of the top players in the market, no surprises there. HDFC Bank continues to maintain its lead both in number of cards and the spend. And then you have SBI Card, ICICI Bank, Axis Bank, Kotak, RBL, etc. Finally, digital, which is online e-commerce, that continues to dominate the usage of credit cards, with 61% of all the transactions that are done being done online. So, the bottom line is the spending on credit cards is going up. Digital is remaining strong, but the growth, it is starting to normalize, perhaps also because of some of the RBI rules kicking in on unsecured lending over the course of last year. We're seeing some of that reflect on account of asset quality as well. So that's the big, macro cue to take note of on that
Ritu,
note.
Ritu, I would like, we have Eminem's earnings, which are flashing for you on the screen. Margins have come in absolutely in line with expectations at 14.7%. They have actually, for the labor code, they have accounted for an expense of 98 crore rupees in the quarter gone by. They do have taxes. There is a tax write-off that they've taken, which is higher on a YOY basis, but revenues, they are slightly lower than the expectations, which are 300 crores lower than the expectations, coming in at 38,500 crore rupees. The EBITDA number, that should flash for you because the margins are largely in line at 14.7%. The EBITDA at 5,668 crore rupees is largely in line with estimates. The estimate was 5,715 crore rupees. If you look at the breakup in terms of what the segments have done, the EBIT for automotive business has gone up to 2,625 crore rupees, which is an uptick both on a quarter-on-quarter and on a YOY basis. So in the automotive business, the EBIT has been quite strong. The farm equipment business, on the other hand, has seen a decline both on a quarter-on-quarter and on a YOY basis, and that is where that miss is coming in from. So the farm equipment business is the one where we have seen some decline. In fact, let's get in Sudarshan. He's joining in with the analysis on this one. Sudarshan, over to you.
Numbers are largely looking in line with our expectations. If you talk about the profit, is coming at 3,931 crore versus our expectation of 3,900 crore. And revenue too, it's a slight miss against our expectation. It has come at 38,517 crore versus 38,843 crore. And EBITDA too has come at below 5,700 crore. But margin though has come in largely in line with our expectations of 14.7%. And revenue growth that you are seeing is largely led by volume growth. Both auto and agri segment have seen healthy volume growth, and company continues to gain the market share in the tractor segment. For the last few quarters, that company has been gaining in the market share. And we have to look at the internals of the auto and the farm segment. The margin, I'm yet to look at that. But overall, numbers are not looking that bad. And talking about the outlook also, if you would have seen, most of the OEMs have increased the outlook for FY26 and also for Q4 FY26. But so far, numbers are looking largely in line.
In line with estimates, let's actually do one thing. Let's get in Gurmeet Chadda, Managing Partner and CIO, Complete Circle, with his analysis on the numbers. Gurmeet, what did you make of the numbers? Largely in line with what the street was suggesting, but if you also look at the internals, the farm equipment business has seen a bit decline. The automotive business continues to do well. What do you make of the set? Gurmeet, can you hear me? Okay, all right. We'll get back to Gurmeet in just a bit. With the news that Eminem's numbers just hit the exchanges, largely in-line set of numbers, margins at 14.7%, in line with expectations of 14.7%. The stock, though, has come off from the highs. We'll get in management commentary in just a bit, but with that, we'll wrap on this edition of Trading Hour. Stay tuned. Halftime report is up next.
Even as index heavyweights hold steady, Midcap sees some selling pressure. Auto and healthcare are the prominent gainers, while IT and industrials drag.
Eicher Motors revs up on healthy Q3 volumes, market share gains and strong margin improvement on better mix and price increases, while a mega 70,000 unit Indonesian order powers up Tata Motors. Eminem reports an inline set of numbers.
Apollo Hospitals injects optimism into healthcare stocks after a strong Q3 show on resolution of issues with insurers. The healthcare major adds that discussions with the Delhi government on the joint venture Indraprastha Medical Care are on.
Britannia recovers from the GSE disruption in October to note strong growth in November and December in biscuits as well as adjacent categories. It also makes the best of the stable commodity prices to extract higher margins.
The government launches an offer for sale for up to 5% of BHEL's equity. The floor price of 254 rupees per share is at a sharp 8% discount to the previous close, exerting pressure on the stock in trade.
Hello, good afternoon. You've tuned into Halftime Report, coming live from the CNBC TV 18 Motilal Oswal studios. I'm Vinny Motiwala. With me is my colleague Ekta Batra as well. Good afternoon, Ekta. And we have Eminem that just reported their numbers a short while ago. Inline set of numbers that has come in from the company. Expectations were higher as well. So inline is good for the company. 1% growth uptick is what Eminem is managing to hold on to, not growth. Net profits up by 47% nonetheless, but it's off the day's highest point. And markets today also are, just managing to hold on to green, resilient. Not much of a sharp up move or a downside.
Hi, Vinny. Yes, absolutely. As of now, we have Eminem, which is just about holding with a gain of around 1% and we're going to get more details from Sudarshan possibly in a bit on Eminem. But just want to touch base on the markets. There is some amount of resistance which is coming through on that 26,000 mark for the Nifty. So currently just about higher by around 17 odd points. We have the broader markets which are just about flattish at this point. So around 100 points lower currently for the Midcap Index, with the Bank Nifty just about holding with its head above the water. It's really very flat and quiet for the indices, but the underlying trend is a lot about specific stocks. So if you want to talk about BHEL, if you want to talk about Lakshmi Dental, if you want to talk about Eicher Motors, Apollo Hospitals, SBI, that's really where the action is. Specific stocks are seen buying and selling at this point in time in terms of the trend that we're seeing in the markets at this point. But let's get to our first stock that we're tracking. Eicher Motors is in fact in focus. It's trading higher after posting what was a good set of Q3 numbers. Let's go across to Sudarshan, who's doing all of the number crunching for us. Sudarshan, over to you.
Eicher Motors is top Nifty gainer today after company has reported a strong set of earnings for Q3 FY26. Till the last quarter, there was one concern related to Eicher Motors. That was the margin. Company was failing to cross the margin level of around 24 or say 24.5%. But this quarter, on that front, also company has outperformed and has done much better than estimates. In Q3 FY26, margin has come in at 25.5%. That is at 5-quarter high. And also, it's after several quarters that company has seen EBITDA outperforming both volume and revenue growth. So because of the strong volume growth that company is seeing for both Royal Enfield as well as commercial vehicle, it has seen an increase of 23% revenue in Q3 FY26. And EBITDA too has seen a jump of 30%. Margin, as I've told you, has increased to 25.5% on the back of positive operating leverage, better mix, and the price increase that company had taken last year and also this year in the month of January 2026. What about going forward? In Q4 also company is expecting a strong momentum that started post GST rate cut and during the festive season will continue in Q4 FY26, and even in FY27 company is expecting high single-digit growth for motorcycle business for the entire industry. So strong earnings for Q3 FY26 and the positive outlook are helping stock to move higher.
Okay, so but also Samvardhana Motherson, that also is buzzing away in trade today. Take us through the numbers for that as well.
Samvardhana Motherson shares are buzzing in their trade after company has reported a strong set of earnings for Q3 FY26. Earnings though had come during market hours yesterday, but after that company had held analyst call, and in that it has maintained positive outlook going forward, and also it's saying that it's on the track to achieve the target that it has given in Vision 2030. And in Q3 FY26, the revenue was highest ever quarterly, and on the margin front also for the second straight quarter margin has been above 9%. So profit in Q3 FY26 has increased by 24%, revenue was higher by 4%, EBITDA has increased by 6%, and margin has increased to 9.7% versus 9.5% in the same quarter last year. Gross debt though has increased both sequentially as well as YOY. In Q3 FY26, gross debt was 17,670 crore versus 16,830 crore last quarter and versus 16,354 crore in the same quarter last year. Raw material costs have seen a significant increase in the last few months, but in Q3 FY26 we did not see the full impact, but companies also saying that it's going to pass through the entire raw material cost, and it happens with a lag. So in Q4 there might be a minor impact, but if company manages to pass on the entire cost, then there might be a minimal impact. So overall, it was a strong set of Q3 FY26 earnings, and also company maintains positive outlook, and in all probability margin may remain about 9.5% going forward as well.
Okay, all right, Sudarshan, thanks very much for that. In fact, it's a lot about the auto stocks today, and Eminem should come up for you because it's off the day's highs, just about higher by around 0.4%. So it's cooled off a little bit from the highs post numbers. So do watch out for that. But the other stocks which are in focus from the auto space include something like a Maruti, which is managing to hold up with gains of around 1.3%. So really revving ahead for the entire auto space at this point, barring Eminem, which is now seeing a bit of a downtake. We'll take a short break on that note, but we'll focus on our What's Trending segment, which is hospital stocks in today's trading session. That conversation coming up next. Stay tuned.
Fly Emirates, fly better.
Welcome back to Halftime Report on CNBC TV 18. Now let's refocus and put the spotlight on the healthcare space. And that's in our What Trending segment, where we are looking at hospital stocks specifically today, with Apollo Hospitals, Max Healthcare, Narayana and others seeing strong traction. The trigger, a combination of earnings momentum, clarity on insurance agreements after recent cashless disruptions, and the CGHS rate revision that could boost the margins. Ekta, take us through what's going to be driving this rally, either valuations, the earnings, everything that has come in here.
Well, yes, the entire hospital space is buzzing, and that's what we're looking at on Halftime Report under our What's Trending segment. So I'm going to start with what's really driving this rally today. First is the earnings. If you look at Apollo Hospitals, it's come out with a good set of numbers. Average revenue per patient is up 11% this quarter. Apollo Hospitals Health core company, which is basically Apollo 24/7, as well as the pharmacy business, has reported its lowest ever digital cash loss of around 29 crores. Now, triggers for the hospital companies going forward. There is an agreement which is reached with the insurance companies after there was that disruption on cashless services that took place. So Apollo Hospital says that the insurance contracts are now tied up for 2 years. They've seen 8% of volumes come in from insurance this quarter. And Max Hospital, we spoke to them earlier yesterday or down the week. They said that they hope that there is this new mechanism which is adopted with the insurance companies, which won't have issues reoccurring going forward. So that seems to be one of the key triggers playing out at this point. The other one is the CGHS revision. The rate revision was announced in October with around 2,000 medical procedures under CGHS with an average of around 25 to 30% rate increase. So that is going to really aid hospitals. Max Health, in fact, said that the revision will probably add around 200 crores positively to their EBITDA, but there is a GST impact of around 60 odd crores, which one needs to factor in. The other thing is that the budget has proposed a scheme to support states in establishing 5 regional medical hubs for medical tourism. Remember that medical health value is something that the street is looking at in terms of positioning for companies. And that would be one of the key triggers going forward in terms of international patient revenue revving up. CapEx, Max has announced 3,000 bed addition from FY26 to FY28. Apollo Hospitals plans to add 4,400 beds going forward. In terms of valuations, what we are seeing is Apollo Hospitals, it is down around 7% from its 52-week high. Max, Fortis, Jupiter Lifeline, all of these stocks have corrected and are trading anywhere between around 23 to even 20 times in terms of FY27 EV to EBITDA, with analysts saying that there is room to increase or to get to the peak valuations that these hospitals were trading at. In fact, let's listen in to the management of Apollo Hospitals. We spoke to them earlier this morning.
So there was an extra 8% volume increase from insurance with a 20% revenue increase. So this will continue, and with this, we should be able to get higher occupancy metrics. Insurance enabling patients to enter the Apollo system for robotics, for transplants, improvement in cardiac work by 20%, onco work by 18%, orthopedic 17%, and gastro 17%. This has all led to a higher ARPP. Insurance improvement is about 5% total volumes. If moving up from 43 to 48% now come from insurance. Can we continue with the ARPP of 11%? I think, we started from a little bit of a low base effect, and we've moved to this number, therefore showing 11%. Will this continue? I think it could probably continue in the range of 5 to 6%. But what will improve is volumes. And when volumes improve, operating leverage and therefore absolute EBITDA and profitability will continue to improve.
All right, so that's on Apollo Hospitals, but we also spoke to the management of Max Healthcare, who added that they see lower seasonality and higher average revenue per occupied bed due to more complex cases that they saw in Q3. Listen in.
I think we need to look at it apples to apples. That means the erstwhile hospitals as a separate bucket and perhaps the new hospitals as a separate bucket. because the newer hospitals, if they're in tier 2 cities, the ARPOBs and the EBITDA per bed may be lower, but I think the way to look at it is on the basis of ROCEs that they're generating, because eventually we are in the business of putting the incremental rupee that we generate at attractive ROCEs, not necessarily at higher ARPOBs and EBITDA per beds. Having said that, the complex cases on a quarter-on-quarter basis are also basis seasonality. The second quarter typically a vector bond season, so you have higher occupancy but lower ARPOBs, whereas the third quarter on its own, you'll have lower vector bond diseases and perhaps higher ARPOB because you're doing more complex cases.
Okay. On that note, we're going to slip into a very short break. We're going to continue with the focus on hospital stocks with Aditya Khemka of InCred Asset Management. Stay tuned in for that conversation.
Welcome back. Well, quiet for the market. So let's continue talking about what's trending today in on halftime report, and that's hospital stocks. We spoke about the valuations, we spoke about the triggers, but to discuss more, we have Aditya Khemka, who's the fund manager in Cred Asset Management, who's with us this afternoon. Aditya, hi, welcome to the show, and good to see you in. A lot of the hospital stocks are buzzing today. Just give us a sense in terms of what you made of the earnings this time.
Good afternoon, and thanks for having me on the show. So I think, look, hospital stocks had reported in line to slightly better than expected earnings, and actually, I couldn't really understand why hospital stocks were down for the past 2 months, because generally, stocks fall in anticipation of a poor quarter or poor earning growth, but that was just not the case. And now that the hospital stocks all have delivered decent earnings, I think the stocks are just reverting to their mean valuations. So I didn't find anything extraordinarily good or bad in the current quarter.
Okay, Aditya, you didn't find anything extraordinary in terms of good or bad during the quarter. But then, what is your view now from here on? What is your pecking order when it comes to these hospital stocks then?
So we don't really comment on each and every hospital stock that's listed, but I can comment on the 3 stocks we own in the PMS that I run. So at the Incred Healthcare PMS, we own our largest weight is a hospital company called Healthcare Global. That's a super specialty oncology hospital chain. Our second largest holding is a hospital based out of Gurgaon, Delhi NCR, that's Artemis. And our third position within hospitals is Rainbow Hospitals. They do maternity and mother care.
Okay. Well, you're not looking at multi-speciality as much as you're looking at specific, genres of hospitals. Is that correct?
Yeah, that's actually correct. If you look at the global hospital ecosystem, or if you look at the global markets, each and every market, when they begin their healthcare journey, they begin with multi-specialties. But as the markets mature, as the markets actually start gaining more traction in terms of ARPOBs, in terms of patient footfalls, the market eventually evolves into super specialties, where super specialties are looked at as better quality of care, more high tech, more advanced care, basically. And patients are willing to pay a premium for better quality of care. So we think India is at that point where multi-specialty hospitals are there for most of us to access, at least in the urban areas, and hence the demand for super specialty is growing faster. And hence, our presence is more in super specialty than in multi-specialty.
Okay. Well, interestingly, Aditya, a couple of the companies, Apollo, Max, mentioned that they've reached an agreement with the insurance companies because they had seen that disruption with regards to cashless services. So that seems to be settled now. How much of a trigger do you think that is for hospital companies? Was that an overhang?
Maybe in terms of narrative and rhetoric, yes. But in terms of patient footfall, no. Because remember, while cashless insurance was cancelled, insurance was still paying if you submitted the bills for reimbursement, right? So if you think of it from a patient perspective, just because I'm not getting cashless was not a good enough reason for me to avoid a surgery. So I will still go for the surgery, pay the bill out of pocket, and then apply for insurance reimbursement. So I don't think it caused any disruption in financials or footfalls. But yes, the narrative and the rhetoric had sort of gone against the hospital stocks. People were feeling that there will be price corrections, there will be negotiations with packages, with insurance companies, which is anyways an ongoing business practice. Insurance companies keep renegotiating package prices with hospitals on a one-on-one basis. So that had no operational impact, but a narrative impact, yes.
Sure. Aditya, there's another important trigger that comes in for the sector is that CGHS, the rate revision, which happened in October, around 2,000 medical procedures, we saw this revision, right? And Max even spoke about that, saying that rate revision has actually added around 200 crores positively to their EBITDA. With these revisions, could we expect this to continue for hospitals, more benefits coming here now?
I don't know about more benefits, but obviously the CGHS revision is positive. Look, CGHS rates were last revised in 2015, and then they got revised now in 2026. So you can see that over a 10-year period, they have been revised by like 60-70%, and that too, not all procedures, some procedures. So you can understand, how much behind the rates were as they were, before this revision, and that obviously is helping the companies that have a significant sort of patient pool which comes with CGHS cards. And that is where, your Delhi NCR hospitals actually have more CGHS, ECHS patients compared to other hospital chains, which are maybe not so focused on out of Delhi NCR. So if you look at how we are positioned in our portfolio, we have Artemis Medicare, which is a completely Delhi NCR based play. And this is one of the reasons, the CGHS is one of the reasons why we believe the company will do well in the near future.
Okay, interesting. Well, Aditya, we need to leave it on that note, but always interesting to get your thoughts in on the healthcare as well as the pharmaceutical space. Thanks very much for joining in and talking to us. So that's the view coming in on healthcare stocks, which are really buzzing in today's trading session. We'll do one thing. We'll take a short break. But up next, Jay Thakkar of ICICI Securities will join in with some of his trading calls. So full tilt back on the market. Stay tuned.
Fly Emirates, fly better.
Welcome back to Halftime Report on CNBC TV 18. Manisha Gupta is joining in now. Okay. Before we go to Manisha, let's go across to Sudarshan actually, because Eminem had reported its numbers, largely inline set of numbers. For more details, Sud, what's happening here? What are the finer details that you have now coming in?
So it's in line and a good set of earnings that Mahindra & Mahindra has reported for Q3 FY26. On the consolidated basis, Mahindra Group has reported revenue of more than 50,000 crore for the first time ever. That's the consolidated revenue. Now for the auto company, any auto company, two important metrics that we track. One is the volume and another is the margin. On the volume front, both for the tractor and for the auto segment, it has been seeing healthy volume growth in Q3 FY26. For both these segments, volume was higher by 23%. On the margin front also, despite the challenging environment, company has reported margin of almost 14.7%. That is in line with our expectations. And on the market share front also, in the auto business, company continues to gain market share both in the SUV, in the revenue, as per revenue, company remains the number one player. In the LCV, that is higher than 3.5 tons, company remains the market leader and continues to gain the market share. In the tractor segment, due to seasonal impact, it has lost market share by just 20 basis points in Q3 FY26. And considering all these factors, you can see revenue in Q3 FY26 has increased by 26%. There was an increase in EBITDA by 27%. It has come at almost 5,700 crore. And margin, as I told you, it was in line with our expectations. It has come at 14.7% versus 14.6% in the same quarter last year. Realization, overall realization has increased by 2.5% year-on-year, but on a sequential basis, there was a fall of around 2%, and that's mainly on the back of the sharp increase in the raw material cost we have seen. You can take a look at aluminium, copper, price of all these commodities have seen a sharp increase. For the auto business, EBIT was up 26%. Margin here also was almost flat. It has come at 9.5%. And for auto business, realization was up almost 3%. And for the tractor segment, again, volume was up 23%. And here also, company continues to improve the realization, and the increase was almost 2% year-on-year. Commentary remains positive. Company saying that new launches of XUV9S and XUV7XO received positive response, and going forward also company believes that strong outlook that it had given earlier for SUV segment and for the tractor segment, it continues to hold that outlook.
Okay, all right, Sudarshan, thanks very much for that. So the stock is back up around 1.3%. A little choppy post reporting its Q3 numbers there. But Jay Thakkar of ICICI Securities now joins in to discuss what he's tracking technically for us this afternoon. Jay, hi, welcome to the show. Well, let's start with auto stocks. In fact, all of them are buzzing today. We have Eminem, which just reported its numbers. Sudarshan just spoke about it. Technically, what are you liking there?
Good afternoon to you, Ekta and Vinny as well. I would say that, overall auto, in the recent past had seen a good, move overall. We see post the, August series. We have seen, or probably I would say since August series, we had seen a good run up, long build up out there in auto stocks. The overall index performed quite well, I would say, Ekta. And lately, in the last few weeks, we have seen some profit booking coming there on account of long unwinding only. Otherwise, I would say that the overall auto sector or the auto index is looking positive. I think that again, it's likely to inch towards the index targets of around 30,000 plus levels. And out there, we believe that yes, Eminem, which has been a good performer and outperformer as well in the past, is likely to inch higher again. I mean, post this profit booking on account of long unwinding. So I think that Eminem is likely to see the levels of around 4,000 plus again. Maruti, I think after a sharp correction, I think from here on it should witness good up move again. That's among the four-wheelers. Ashok Leyland has been already doing good and has been trading around the life highs itself. So I think Ashok Leyland continues to be the outperformer, followed by Eminem and Maruti as well. I think these are the few stocks from the four-wheelers, trade be passenger or the heavy vehicles, I would say, are looking positive. But then among the two-wheelers, I think that Bajaj Auto is one stock which has not yet seen much of the short covering, although we have seen some short covering happening there again. So there is a good chance that we might see 10,000 plus levels out there in Bajaj Auto as well. Eicher has already done good. The results have been really positive. The stock is trading quite well. But then Bajaj Auto is also one stock which can be looked at post Eicher Motors.
Okay, Jay, thank you so much for joining us today and, speaking with us in terms of the auto sector and individual stock names in the auto sector as well. Thanks so much for that. But on that note, we're going to step into a very short break. After the break, Manisha Gupta will join us, and with her will be Siddharth Srivastava of Mirai Asset Investment Managers. Stay tuned for that conversation.
You want to talk business? Meet me in the Onboard Lounge.
Welcome back. Joining us now is Siddharth Srivastava. He's head ETF product and fund manager at Mirai Assets. Siddharth, hi, thank you so much for joining in. And what a number that we've seen January throw at us when it comes to buying in sense of gold and silver on the funds there, much higher than what equities done as well. I do understand that January also would have seen some redemptions, but the net inflows clearly have been on the higher side. How are you looking at this trend continuing from here, given the fact that the prices seem to be stabilizing a bit now?
So overall, I expect the trend to continue. People investing more in gold and silver ETFs. Gold more so because we have positive view of gold going forward. Silver probably we are a bit more cautious on, but it's not just this year and this month. Gold we are seeing inflow of almost 64,000 crores in last 1 year. Silver we have seen inflows of almost 33,000 crores in last 1 year. So this trend has been there since quite a while. Even on a trading basis, Manisha, last year, average trading of both these precious metals on exchange was around 1,100 crores on a daily basis. That has shot up to almost 8,000 crores on a daily basis this year. Some bit of it that is return chasing, but I think precious metal as a part of portfolio will start getting more and more importance going forward.
Siddharth, I was looking at numbers on when you want to import silver. Even today, it is at a premium of $1.5 to almost $2 therein. And we do understand the volatility that there is in silver, and that the basic nature of ETFs is that it has to be backed by physical silver as well. How are you looking at the volatility in the physical markets and the fact that we've seen higher volatility in the ETF prices than what the physical market at some days put out?
Yeah, so basically, even if we look right now, gold is down 10% from its all-time high. Silver is more than 30% down from its all-time high. But that doesn't change the fact that even now on a YTD basis, silver is up around 13%, gold is up around 17% on a 12-month, up by 165% for silver and 80% for gold. So I think retail segment is obviously looking at this recent returns and let's say piling on more to gold and silver investments. Yes, volatility will continue. See, ultimately what ETFs do is mirror what is happening in the physical spot market. Yes, there has to be some comparison with what is going on in international, but we have seen in last 1-2 months that premium and discount in physical market at times are creating more divergence than what is happening in silver or gold market internationally. So people have to be cautious that ultimately these ETFs will replicate and give returns which are corresponding to domestic spot and not international spot or MCX futures.
Sure. So now the other thing is that it can't just be retail driving all of those numbers. The expectation also is that we've seen HNIs, family houses, institutions, big money come into ETF.
Absolutely. I'm like most of the conversations which we are having right now, even if we are trying to pitch equities, is turning out to be towards gold and silver, and it's all across the board. Like I mentioned, that we continue to remain bullish on gold per se, even at these levels, and that is what you're seeing. I think trend a bit while back was that in silver we were seeing more inflows, but now I think that has sort of stabilized a bit. We are seeing more traction in the gold ETFs than per se in silver, but I think both commodities will continue to get traction at least in coming months.
Siddharth, what is the sense, if you can share with us, on new folios, the kind of ticket size perhaps that we saw in the month of Jan to give out those numbers?
So yeah, so correspondingly, folios have also significantly increased, but from a ticket size point of view, I think what we are seeing is like I mentioned, that not only retail, but we are seeing bullion traders and commodity traders also participating significantly in both gold and silver market as well. While what is happening on AUM and net flows is very interesting in terms of the increased share size of these two precious metals in inflows. But I think also what you just pointed out, that volatility and movement in terms of what is happening on the exchange in terms of volumes increasing 8 times simply highlights that it's just not only AUM where the things are moving, but also trading, intraday trades, hedging, etc., where we are seeing uptick in both gold and silver ETF.
Okay, all right, Manisha. Thanks very much for taking us through that conversation. So yes, the discussion around gold and silver ETFs and the interest there continues. But just wanted to point out that the Divi's Labs numbers came out. It looks largely like an inline set of numbers. The margins look better than expectations. So the revenue growth is around 12% this quarter, and we were working with a growth of around 16%. So it's missed that in terms of the growth on the top line. But overall, the margins have come in better than expectations at 34% versus 31%. So that's Divi's Labs, just about a little volatile post numbers. The conference call will be held at 3 p.m. this afternoon. Some more details from the management at that point as well. We'll take a short break, but lots more on the markets once we're back. Stay tuned.
You want to talk business? Meet me in the onboard lounge.
Welcome back to Halftime Report on CNBC TV 18. As of now, the Nifty is back in the red. It's down almost 10 points. So from when we started the show, it's come off from the green. It's moved to the red, down 30 odd points from 12 noon when we started the show. Broader end of the market also is seeing a bit of a muted day coming in, especially the small cap is seeing a bit of an underperformance. Advance decline ratio clearly in the favor of declines versus advances in the trading session as well. So that is something that you should watch out for and where that is going to be headed. There was a crisscross in the morning, and after that the declines were more than the advances. Stocks in the last 1 hour which have seen a fall coming in: Eicher Energy 361 WAM, as well as Lemon Tree is something that should be on your radar in the second half of the trading session as well. But with that, we're absolutely out of time on this edition of Halftime Report. Thank you so much for tuning in. Up next, your Business Lunch.
Even as index heavyweights hold steady, Midcap see some selling pressure. Auto and healthcare are the prominent gainers, while IT and industrials drag. Eicher Motors revs up on healthy Q3 volumes, market share gains and strong margin improvement on better mix and price increases, while a mega 70,000 units Indonesian order powers up Tata Motors. Eminem reports an inline set of numbers. Apollo Hospitals injects optimism into healthcare stocks after a strong third quarter show on resolution of issues with insurers. The healthcare major adds that discussions with the Delhi government on JV Indraprastha Medical are on. Britannia recovers from the GST disruption in October to notch strong growth in November and December in biscuits and adjacent categories. It also makes the best of stable commodity prices to extract higher margins. The government launches an offer for sale for up to 5% of BHEL's equity. The floor price of 254 rupees per share is at a sharp 8% discount to the previous close, exerting pressure on the stock in trade. Hello and welcome to Business Lunch, live from the CNBC TV 18 Motilal Oswal studio. I'm Arundhati Ramnan. Good afternoon, guys. Let's take a look at how the markets are doing, right? The Nifty hit over 26,000 at the start of trade, but is now trading well below that mark. And if you take a look at the index, it's now in the red, flat, but mildly in the red. It's at 25,912 at this current point. If you bring up that Midcap index for you, that's also in the red, feeling some pressure, 0.2% lower. And if you take a look at the bank Nifty, that's the only index managing to keep its head above water. So if you can see the Nifty bank, it's about 24 points in the green as we speak. But if we take a look at the sectors, it's that auto pack that's leading the up move, right? We've got Eicher Motors hitting record highs, gaining 6% in trade after a strong third quarter number. You've got Samvardhana Motherson Sumi, also 3% in the green. Eminem also trading with gains after an inline set in the third quarter. Healthcare stocks, those are the other big gainers, and they are being led higher by Apollo Hospitals, which is soaring post its Q3 numbers. Loris Labs, Max Healthcare, all of them in the green, over 3% higher. And on the downside, it's those IT stocks, all of the stocks in the red. Infosys, Persistent, L&T, Tech Services, all of them down over 2% in trade. But as I pointed out, autos are the top sectoral gainers today, led by multiple triggers, including order wins and strong earnings. Sudarshan Kumar is here with all of those details. Sudarshan, a good day for that auto pack.
That's correct, and it's on the back of the strong set of earnings mostly that these companies have reported. So on top of the list, Mahindra & Mahindra just a few minutes ago has come out with its earnings for Q3 FY26, and earnings are looking largely in line with estimates. And good part is on the consolidated basis in Q3 FY26, company has reported revenue of more than rupees 50,000 crore for the first time. It continues to gain market share as far as the SUV or say auto segment is concerned. In the tractor segment, there was a minor dip in the market share in Q3 FY26, and that was by 20 basis points. But overall, if you take a look at the profit, it is increased by 33%. Revenue has seen a jump of 26%. EBITDA 2 has seen an increase of 27%, and margin has come in line with estimates at 14.7%. Volumes for both auto and tractor segment have seen an increase of 23% YOY. Even realization front, auto segment, there was an increase of 2.5%, and for the tractor segment, there was an increase of almost 2%. Coming to Eicher, it was a strong set of earnings after several quarters. Company has reported margin of more than 25%. It was at a 5-quarter high of 25.5%. If you talk about the headline numbers here, revenue has increased by 23%. EBITDA has seen a jump of 30%, and margin has increased or expanded to 25.5% versus 24.2%. And revenue was led by the volume for both Royal Enfield and commercial vehicle volumes were healthy in Q3 FY26. Motherson, it was the highest ever quarterly revenue that company has reported. Margin has come in at above 9% for the second straight quarter, and companies saying that going forward, organic growth will accelerate further, especially in the consumer electronics business. Revenue in Q3 was up 4%. EBITDA has seen a jump of 6%. Apart from the earnings, one stock that has been in the focus on the back of order win is Tata Motors commercial vehicle. Its Indonesian arm has bagged orders to supply 70,000 vehicles to Indonesian government company, and these would be for Yodha pickup and Ultra T.7. Now, I've just done a rough calculation. It suggests that order can be somewhere in the range of rupees 7,000 to 9,000 crore.
All right, Sudarshan, thank you for taking us through all those triggers that have helped the auto pack rise in trade today. But hospital stocks are in focus today with Apollo Hospitals, Max Healthcare, Narayana and others seeing strong traction. Ekta joins us now for a quick take on what's driving this rally and the valuations. Ekta.
Well, a couple of reasons why all these hospital stocks are doing well. So I'll start with earnings because Apollo Hospitals reported its numbers and it was a good set of numbers, and that's possibly, helped in terms of sentiment across the board. So the average revenue per patient for them was up around 11% in the hospital business this quarter. Their digital business, which is basically Apollo Health Core, reported its lowest ever digital cash loss of around 29 crores. Now, going forward, one of the key triggers is that there is an agreement which is reached with the insurance companies after the disruption on cashless services. So Apollo Hospital, for example, says insurance contracts have been tied up for 2 years and 8% of their volumes this quarter came in from insurance. Max Hospital has said that they hope the new mechanism, which is adopted with insurance companies, won't have issues going forward. Now, in terms of other triggers, is the CGHS rate revision, which was announced in October, for around 2,000 medical procedures with an average of 25 to 30% rate increase. Now, the CGHS rate revision is expected to aid hospitals in terms of revenue as well as EBITDA going forward. Max Health says that the rate revision will add around 200 crores positively to their EBITDA. The other thing is that the budget has proposed a scheme to support states in establishing 5 regional medical hubs for medical tourism. So that too should be a longer term trigger for these hospital companies. CapEx continues. So Max is going to add around 3,000 odd beds. Apollo Hospitals is planning to add around 4,400 odd beds in the next couple of years. Valuation wise, all of these stocks have corrected from their fresh 52-week highs. So there is some space, according to analysts, where there could be a valuation catch up that could take place.
All right, Ekta, many thanks for taking us through those details. We also spoke to the management of Apollo Hospitals earlier today, and here's what they had to say. Take a look.
So there was an extra 8% volume increase from insurance with a 20% revenue increase. So this will continue, and with this, we should be able to get higher occupancy metrics. Insurance enabling patients to enter the Apollo system for robotics, for transplants, improvement in cardiac work by 20%, onco work by 18%, orthopedic 17%, and gastro 17%. This has all led to a higher ARPP. Insurance improvement is about 5% total volumes, if moving up from 43 to 48% now come from insurance. Can we continue with the ARPP of 11%? I think, we started from a little bit of a low base effect, and we've moved to this number, therefore showing 11%. Will this continue? I think it could probably continue in the range of 5 to 6%. But what will improve is volumes. And when volumes improve, operating leverage and therefore absolute EBITDA and profitability will continue to improve.
Ekta also spoke to the management of Max Healthcare, who added that they see lower seasonality and higher average revenues per bed due to more complex cases in Q3.
I think we need to look at it apples to apples. That means the erstwhile hospitals as a separate bucket and perhaps the new hospitals as a separate bucket. Because the new hospitals, if they're in tier 2 cities, the RPOBs and the EBITDA per bed may be lower. But I think the way to look at it is on the basis of ROCEs that they're generating. Because, eventually we end the business of putting the incremental rupee that we generate at attractive ROCEs, not necessarily at higher RPOBs and EBITDA per beds. Having said that, the complex cases on a quarter-on-quarter basis are also basis seasonality. The second quarter typically a vector bond season, so you have higher occupancy but lower RPOBs, whereas the third quarter on its own, you'll have lower vector bond diseases and perhaps higher RPOB because you're doing more complex cases.
The changes in the MSCI Index rejig have been announced, and Sudarshan is back with us to take us through the details on the additions as well as the exclusions. Sudarshan?
So early in the morning today, MSCI has announced rejig to its indexes mainly to to its MSCI Standard Index and MSCI Small Cap Index, and these changes would be effective 27th of February 2026. In the Standard Index, they have added 2 stocks and they have excluded 1 stock. But following the recent correction we have seen in the broader market, there have been several changes in the Small Cap Index, and because of that, number of stocks in the MSCI Small Cap Index has will reduce to 480 from 508. And following these changes, India's weightage in MSCI Standard Index will remain steady around 14.1%. So talking first about MSCI Standard Index, inclusions, AB Capital will be included, and because of that, likely inflows can be seen of $257 million. L&T Fin can be included, and inflows can be of $238 million. And IRCTC can be excluded from MSCI Standard Index, and because of that, outflows can be of $142 million. Coming to MSCI Small Cap Index, inclusions, some of the inclusions are Premier Energies, NSTL, MQ Pharma, JSW Cement, Ashapura Minechem, Canada HSBC Life, and Thyroid Technologies. And in the list of exclusions, Gokaldas Exports, Sterlite Technologies, KNR, J Kumar Infra, VRL Logistics are some of the major names which will be excluded. But analysts say that most of the changes that have been announced by MSCI are largely in line with estimates.
All right, Sudarshan, many thanks for those details. But on that note, it is time for us to head into a short break. More news and updates coming up on the other side. Stay tuned.
आंधी आए तो पर्वत बन जाऊंगा,
आग लगे तो दरिया बन जाऊंगा,
भूख लगे तो रोटी बन जाऊंगी।
ये कर पाएंगे क्या? इनका तो पता नहीं, और उसने तो कर दिखाया। कोटक फ्लेक्सी कैप फंड 15 सालों से मार्केट के अप्स एंड डाउन्स में फ्लेक्सिबिलिटी के साथ लार्ज, मिड और स्मॉल कैप में इन्वेस्ट कर रहा है, जिससे इन्वेस्टर्स को लॉन्ग टर्म इन्वेस्टेड रहने का हौसला भी मिलता है।
म्यूचुअल फंड निवेश बाजार के जोखिमों के अधीन है। योजना से जुड़े सभी दस्तावेजों को ध्यान से पढ़ें।
In the heart of the jungle roams the finest creature, and through the chaos of the sparkling city lights, I am reminded of the timeless valor of the majestic tiger. In life's wild journey, we have one shot to thrill. And when done flawlessly, we unwind and allow our spirits to rejuvenate. Royal Ranthambore, India's finest, yet.
Look, this investment Guru's tips will double your money. Just claim the offer.
Double your money from any random group. Pay attention. Promising double returns, they'll lure you in tight. Unverified groups will send fake tips overnight, emptying your pockets before you can fight.
Well said, well said, well said.
SEBI and NSE advise consult only SEBI registered advisors and make payments only to verified accounts or UPI IDs. An investor awareness initiative by SEBI and NSE.
In this world where every second counts and every decision is crucial, I discovered what truly drives me. Racing. And now, from a fanboy to the proud owner of the Hyderabad Blackbirds at the Indian Racing Festival, it's time to fulfill my dreams. Chase the rush and take on the competition. To all the other teams, get ready. The Hyderabad Blackbirds are going for the win.
तेरा ये बिजनेस एक मास्टर स्ट्रोक है यार, है ना? पर मुझे लोन कौन देगा यार?
बैंक ऑफ बड़ौदा देगा तुम्हें MSME लोन। बॉब डिजी उद्यम के साथ 100% डिजिटल प्रोसेस, अप्रूवल इन मिनट्स। बैंक ऑफ बड़ौदा से MSME लोन लेना भी एक मास्टर स्ट्रोक है।
माँ के पैरों की धूल माथे पर लगाऊं, चांद तारों को भी हासिल कर लूं, फिर घर आना चाहूं।
Right here, right now, हर कोई कुछ नया करना चाहता है। कोई उड़ना, कोई दुनिया बदलना, तो कोई नॉन स्टॉप बढ़ना। बच्चों के बिंदास सपनों को प्रोटेक्ट करने के लिए बड़ा सोचो। चाइल्ड प्लान्स बाय जनरली सेंट्रल लाइफ इंश्योरेंस, आपका लाइफ टाइम पार्टनर।
In the future, AI will use massive amounts of energy. So what is the future of energy?
Infinite clean energy. Avada, always clean, always on.
We have carefully reviewed your performance
and promoting you to branch manager.
Sir. Hello, Motilal Oswal.
When life goes to the next level, download Rise by Motilal Oswal. Investments and securities market are subject to market risks. Read all the related documents carefully before investing.
Welcome back. You're still with us on Business Lunch. The US will release its monthly jobs report later in the evening today. Ahead of that report, White House senior trade advisor Peter Navarro cautioned the public to lower expectations, citing the Trump administration's deportations of immigrants working in the country illegally. In an interview to Fox News, he said, and I quote, "The jobs report comes out tomorrow. We have to revise our expectations down significantly for what a monthly job number should look like. Wall Street has to adjust for the fact that we're deporting millions of illegals out of the job market." And while the White House is telling Americans to lower job expectations, it's also quietly lowering the bar on its bigger trade promises. The White House has updated its India-US trade fact sheet, changing committed to intense for India's purchases and clarifying on agricultural imports. The fact sheet now states that India intends to buy more American products and purchase over $500 billion of US energy, information and communication technology, coal and other products. Versus the earlier used term committed, the updated version also introduces more specific language around agricultural trade. It has dropped the mention of pulses from the fact sheet and has included a wide range of US food and agricultural products. And in an interview to Fox News, US Trade Representative Jameson Greer delivered a blunt message on India's Russian oil trade, saying New Delhi significantly ramped up purchases only after the Ukraine war began, taking advantage of discounted crude. He went further, arguing that India refined oil and exported fuel to Europe, effectively helping underwrite Russia's war effort. On the India-US trade deal, Greer struck a far more positive note, saying India has already begun expanding purchase commitments, rolling back its digital services, tax on American firms, and reducing tariffs. He called the agreement a long-term strategic partnership that will reverberate for many years to come. On that note, it's time for us to take another short break, but more news and updates on the other side. Stay tuned.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
iFinance Limited launches an initial public offer of equity shares of face value of 2 rupees each in the price band of 122 rupees to 129 rupees per equity share. Bid offer opens on Monday, February 9, 2026. Closes on Wednesday, February 11, 2026. For risk factors and other details, please refer to the red herring prospectus dated February 3, 2026. Available on the websites of the SEBI, the stock exchanges, the book running lead managers and the company.
The best investment one can make in life is finding the right life partner. That's why we created VIPshadi.com. Register now.
AU करंट अकाउंट के साथ मिलता है फ्री UPI QR ओवरड्राफ्ट फैसिलिटी और एक ही ऐप से बैंक के सारे काम। AU
सोच बदलो और बैंक भी।
यारा ओ यारा शुक्राना तुम्हारा सपने हम आपके वास्ते हर कहीं है ओ यार दिल कहे सब तू है रे बस चाहिए हमें तू खुश रहे फिक्रे हो
25 साल से आपने आईसीआईसीआई लॉम्बार्ड पे भरोसा रखा और आपके सपनों को सुरक्षित रखने का मौका दिया। शुक्रिया इंडिया। आईसीआईसीआई लॉम्बार्ड, निभाए वादे।
Fractal Analytics Limited, India's leading pure-play enterprise data analytics and AI company, recognized globally with capabilities across the DA/AI value chain, now makes a public offering of equity shares of face value of ₹1 each for cash at a premium. The 100% book-built offer being offered in a price band of ₹857 to ₹900 per equity share. Opens February 9th, 2026 and closes February 11th, 2026. For risk factors and details, refer to the red herring prospectus.
Dadu, do you want to upgrade to business class?
Why not? Great flying, Captain.
Get an assured buyback value of up to 60%. Drive India's #1 EV, MG Windsor. Live business class.
Looking for attractive savings options? LIC presents Nav Jeevan Shri Single Premium Plan. Deposit lump sum premium amount. Enjoy life insurance cover. Get guaranteed fixed amount on maturity. Liquidity options also available. Buy now. Attractive rebates for existing policy holders. Terms and conditions apply.
आंधी आए तो पर्वत बन जाऊंगा,
आग लगे तो दरिया बन जाऊंगा,
भूख लगे तो रोटी बन जाऊंगी।
ये कर पाएंगे क्या? इनका तो पता नहीं, पर उसने तो कर दिखाया। कोटक फ्लेक्सी कैप फंड 15 सालों से मार्केट के अप्स एंड डाउन्स में फ्लेक्सिबिलिटी के साथ लार्ज, मिड और स्मॉल कैप में इन्वेस्ट कर रहा है,
जिससे इन्वेस्टर्स को लॉन्ग टर्म इन्वेस्टेड रहने का हौसला भी मिलता है।
म्यूचुअल फंड निवेश बाजार के जोखिमों के अधीन है। योजना से जुड़े सभी दस्तावेजों को ध्यान से पढ़ें।
Welcome back. You're still with us on Business Lunch. Let's take a look at where the markets are trading currently. It's no different from when we started the show. If you take a look at the Nifty, it's absolutely flat right now with a slight positive bias, but it's at 25,937. It's below that 25,950 mark, which will be key to watch. But it had crossed 26,000 in the early trade, but obviously could not sustain that momentum. So flitting between red and green, absolutely flat. The Sensex also 91 points in the red. The Midcap Index, 0.1% lower, doing slightly worse than the Sensex and Nifty. But the only one of the key indices that's managing to keep its head above water is the Nifty Bank, currently about 54 points in the green. But we'll take a look at the markets and we'll take a check again later on in the show. But let's shift our focus now to the latest developments between the United States and Iran. Donald Trump, speaking to Fox News yesterday, said that he believed that Iran wanted to make a deal with the United States over its nuclear and ballistic missile programs, and that it would be foolish if Iran to not make a deal. The comments come after talks between the two countries last week in Oman were described to be a promising start by Iran's representatives. Listen in to what the US president had to say.
As you know, we have a massive flotilla right now going over to Iran. We'll see what happens. I think they want to make a deal. I think they'd be foolish if they didn't. We took out their nuclear power last time, and we'll have to see if we take out more this time. They want to make a deal. They wouldn't talk to anybody else, but they're talking to me. But, you know, it's a good question. A lot of people say no. And I would say that I'd rather make a deal. It's got to be a good deal. No nuclear weapons, no missiles, no this, no that, all the different things that you want. But some people worry that they've been very dishonest with us over the years, right?
Meanwhile, Israel's Prime Minister Benjamin Netanyahu is in Washington, where he will be meeting US President Donald Trump later today to hold wide-ranging discussions on Iran and the broader regional situation. Netanyahu is expected to push for any future US-Iran agreement to include clear limitations on Tehran's missile program, and as Israel continues to highlight security concerns tied to the issue. And before we end the show, let's take a look at what's leading the market higher. That's the auto pack and the healthcare pack. If you take a look at the top Nifty gainer, it is Eicher Motors. That stock is about 6% in the green, and that's on account of its strong Q3 numbers. Other auto stocks as well, whether it's Samvardhana Motherson Sumi, Maruti Suzuki, all of them doing well in trade as well. But if you bring up Eminem on the charts for you, Eminem was also doing well, but gave up some gains after its earnings came out, and that stock is now absolutely flat, slightly in the red. It was gaining in early trade, but then sort of fell after its earnings came out. The other pack that's doing really well are those healthcare stocks. That's also on account of Q3 earnings. Apollo Hospital leading the charge there. 4% in the green, and it's leading all of those other healthcare stocks higher as well. Max Healthcare, also one of the top gainers on the Nifty. If you take a look at individual stocks, we've got SBI that's doing really well on account of its strong earnings as well. But on the downside, we've got those IT pack. So if you take a look at those IT stocks, whether it's TCS, whether it's Infosys, all of those stocks, that index about 1.3% in the red, and those stocks not doing too well either. All of those stocks in the IT pack, all of them in the red at this point in time. HCLTech lower by 1%, TCS lower by nearly 2%. But we'll have to wait and watch what happens to the markets later on in the day. But with that, it is a wrap on this edition of Business Lunch. Midcap Radar takes all of that action forward.
Co-powered by SBI, the banker to every Indian, truly. In association with GeoBP, fuel with active technology.
नहीं भाई, कोई कूल बैंक बताओ ना जिसके लिए हर कस्टमर इंपॉर्टेंट हो।
SBI, कूलेस्ट है। What?
किसान से NRIs तक, Gen A से Gen Z तक, SBI सबके लिए है।
Very good.
SBI, the banker to every Indian, truly.
अरे टेंशन किस बात की? सेंचुरी प्रोवुड का प्रीमियम प्लस है ना, लो एमिशन है, हाई डेंसिटी है, वाटर रेजिस्टेंट भी, टर्माइट एंड बोरो रेजिस्टेंट भी है। यानी ये है जहां नो टेंशन वहां।
प्रीमियम प्लस by Century ProWood.
A tall cappuccino with caramel syrup and cardamom.
Sure. A tall cappuccino with caramel syrup and cardamom. Sure.
Tall alfacino with camel ka soup and काटी देगी मॉम। अदरक वाली चाय पिलाओ ना, कड़क।
सर, मलाई मार के देती हूँ।
लाइफ हो या इन्वेस्टिंग, भीड़ के पीछे मत भागो। म्यूचुअल फंड अपनाओ और खुद के हिसाब से इन्वेस्ट करो।
म्यूचुअल फंड निवेश बाजार जोखिमों के अधीन है। योजना से संबंधित सभी दस्तावेजों को ध्यान से पढ़ें।
Bittu and Kittu. Tattoo Vattu. Summer vacations. Houses, cars.
But mileage not same. But how does yours give so much more mileage? Ask this question not just to your car but also to your fuel. Good fuel means better mileage. Petrol at GeoBP with international active technology increases mileage up to 100 kilometers per year. And diesel gives up to 4.3% more mileage at no extra cost.
Now their mileage.
Same. आंधी आए तो पर्वत बन जाऊंगा, आग लगे तो दरिया बन जाऊंगा,
भूख लगे तो रोटी बन जाऊंगी।
ये कर पाएंगे क्या? इनका तो पता नहीं, और उसने तो कर दिखाया। कोटक फ्लेक्सी कैप फंड 15 सालों से मार्केट के अप्स एंड डाउन्स में फ्लेक्सिबिलिटी के साथ लार्ज, मिड और स्मॉल कैप में इन्वेस्ट कर रहा है,
जिससे इन्वेस्टर्स को लॉन्ग टर्म इन्वेस्टेड रहने का हौसला भी मिलता है।
म्यूचुअल फंड निवेश बाजार के जोखिमों के अधीन है। योजना से जुड़े सभी दस्तावेजों को ध्यान से पढ़ें।
We plan for targets, but do we plan for time?
Today's workforce dreams fast, but peace of mind doesn't come from paychecks.
It comes from a plan to invest in your retirement.
The National Pension System, a trusted, flexible, and fully digital retirement solution. It's simple to adopt and delivers high returns, helping employees grow their retirement corpus steadily. Smart companies adopt NPS Corporate. Smarter employees ask for it.
NPS जरूरी है.
Future security is teamwork. That's why.
NPS जरूरी है.
iFinance Limited launches an initial public offer of equity shares of face value of 2 rupees each in the price band of 122 rupees to 129 rupees per equity share. Bid offer opens on Monday, February 9, 2026. Closes on Wednesday, February 11, 2026. For risk factors and other details, please refer to the red herring prospectus dated February 3, 2026. Available on the websites of the SEBI, the stock exchanges, the book running lead managers and the company.
Co-powered by SBI, the banker to every Indian, truly. And Century HDF Premium Plus. In association with Skoda, you never drive alone.
Good afternoon. Welcome to Midcap Radar live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me today is Ekta Batra. Good afternoon, Ekta. Absolutely flat on the markets as we speak. At a point in time, we had seen highs of 26,009, but now we are way below that mark, almost a 60-point cut from the highs of the day. The mid-caps are sulking, though they have recovered a tad bit, but again, there are more stocks on the declining side versus advancing side, so that continues to be the flavor of the market. Autos continue to do well. We have Pharma Index, which is doing well as well. But all in all, it's quite volatile so far.
Yes, absolutely. It's a quiet day, you'd have to say, just about consolidating at this point in time. Resistance at the 26,000 mark currently for the Nifty. And we have the mid-caps, which are just a little choppy today. A lot of stocks in focus on account of earnings. We do have rate-sensitive, such as banks as well as autos, which are managing to gain in today's trading session. So Eicher Motors is now revving ahead with a 6% gain. We have Apollo Hospitals, which is up around 4.8% at this point in time. And a couple of other stocks, such as State Bank of India, which is managing to hold up with a gain of around 2.8%. So lively market in terms of stocks, but the frontline indices seem to be absolutely flat and consolidatory. But let's get to our segment with mid-cap movers. We have Gaurav with us to take us through the mid-caps that are moving around this afternoon. Gaurav, over to you.
Well, as if you look at the mid-cap index, we are seeing some kind of pressure building up, and let's start our segment with the losers of the day. First, let's talk about HCLTech. A very sharp fall, and at the same time, volumes are also very high in this company. When we look at Safari Industries, yesterday only we saw the company reported that they are going with 500 crores of QIP, and today we are seeing some sell-off in this counter. Let's also not forget about P&G, Premier Energies, Poly Medicure. All of these companies are currently under pressure and also seeing some kind of volume-led losing in the trade today. Apart from that, let's also not forget about stocks like BHEL. Remember, government is going to offload around 3% stake with additional 2% stake, which they can offload further at a floor price of 254, which is actually affecting the stock right now. Torrent Power.
Okay, all right, Gaurav. We're just going to have to interrupt you for a second there, because we do have the management of Eminem, which is addressing the media on their Q3 numbers. Let's cut across to Anisha.
Corner words to start describing performance. But that aside, let me just say all our businesses have done exceedingly well. And I want to start by thanking all our teams for the efforts that they've put in what has been a very, very good quarter. Key messages for us: a continued strong performance across our businesses. Operating profit after tax is up 66% across the group. And reported profits are up 47%, and we'll talk about where the differences are between operating and reported. Volume and margin growth continues to be very strong for both auto and farm. 23% volume growth for both of these businesses. A 90 basis point margin growth for auto, a 240 basis point margin growth for farm. Farm did have some impairments for international, and that has caused the overall results for farm to be slightly lower, but domestic performance has been just amazingly strong. And there are three businesses I want to highlight as breakthrough performance. One is Mahindra Finance, and you would have seen those results for all of these companies, in fact, declared by those businesses over the past couple of weeks. But Mahindra Finance is up 97% from an operating standpoint, excluding a previous year provision release. Our life spaces business profits are up 5x, but more than the numbers, just the trajectory the business is on and the focus on residential, what we are seeing in pre-sales, what we are seeing in completions, in profitability is very strong. And our logistics business has the first profitable quarter after 11 quarters, but again, beyond the numbers there, the focus on execution is very strong right now and putting that business on a very, very good track. So not just a great quarter in terms of numbers, but also in terms of the underlying momentum that we are seeing across our businesses. Here are some details by business on the operating profit after tax. And what you see here is the operating PAT on the left-hand side, the one-timers in the center, and then the net result of the operating PAT on the right-hand side. What I will start with is three numbers at the bottom of the page, where you see 66% for operating PAT, 54% for profit excluding the labor code only, and 47% growth from a reported standpoint. So those are the three numbers that we're focused on. As you look across all of these, life spaces a 5x growth in operating, logistics 2x, Mahindra Finance 97%, auto 42%, tech and 35%. You just see amazing numbers across the page here. And the one-timers are essentially the labor code impact across each business and the provision release for prior year for Mahindra Finance. These are the two specific one-timer. In addition, there are two aspects to operating income that we point out on the notes section on the right. One is the impairment for our international farm businesses, and the second is the gain on sale from CIE, both of which are in our operating numbers, but we could just call them out separately. On a consolidated basis, revenue up 26% and profits up, reported 47%, excluding labor code 54%, and as I said earlier, from an operating standpoint, 66%. Let's look at some of these drivers. Auto and farm continue to capitalize on their market leadership. Profits up 42%, SUV volume up 26%. Continue to be the number one SUV player. Strong execution driving our margins, and our new product launches having done extremely well and positions us well for the future also. In addition to the revenue market share for SUVs, we also have gained market share from LCVs, and that continues to be a strong business at a 51.9% market share.
Okay, all right. Those are the comments coming in from Anish Shah of Eminem. That stock is off the highs of the day, but the numbers were largely in line with estimates. We'll sip into a short break. When we come back, we'll be joined by Samvid Gupta, Joint Managing Director of Gateway Distriparks.
Fractal Analytics Limited, India's leading pure-play enterprise data, analytics and AI company, recognized globally with capabilities across the DA/AI value chain, now makes a public offering of equity shares of face value of ₹1 each for cash at a premium. The 100% book-built offer being offered in a price band of 857 to 900 rupees per equity share. Opens February 9th, 2026 and closes February 11th, 2026. For risk factors and details, refer to the red herring prospectus.
अरे टेंशन किस बात की? सेंचुरी प्रोवुड का प्रीमियम प्लस है ना, लो एमिशन है, हाई डेंसिटी है, वाटर रेजिस्टेंट भी, टर्माइट एंड बोरो रेजिस्टेंट भी है। यानी ये है जहां नो टेंशन वहां।
प्रीमियम प्लस बाय सेंचुरी प्रोवुड।
जब से दुकान खोली है मैंने, तब से बैंक का ही तो काम कर रहा हूँ। लो बन गया ना चपरासी।
नॉट बैंकिंग विद एयू।
एयू करंट अकाउंट के साथ मिलता है फ्री यूपीआई क्यूआर, ओवरड्राफ्ट फैसिलिटी और एक ही ऐप से बैंक के सारे काम।
एयू। हाँ जी शुक्ला जी, सोच बदलो और बैंक भी।
लखनऊ में ब्रह्मोस एरोस्पेस यूनिट की स्थापना के साथ सुपरसोनिक ब्रह्मोस मिसाइल के लिए टाइटेनियम धातु का निर्माण किया जा रहा है। साथ ही एक भारतीय कंपनी एयरक्राफ्ट और राफेल जैसे फाइटर जेट्स के लिए कंपोनेंट्स और मटेरियल तैयार करेगी।
आज के दिन में जो सारे डिफेंस के ऑर्डर्स भी प्लेस हो रहे हैं, वो सारे इंडियन मैन्युफैक्चरर्स को प्लेस हो रहे हैं।
योगी आदित्यनाथ जी के नेतृत्व में एक बहुत अच्छा अनुकूल वातावरण इंडस्ट्री के लिए अब पैदा हुआ है।
ब्रह्मोस एकीकरण एवं परीक्षण सुविधा केंद्र से उत्तर प्रदेश में उच्च कौशल वाले युवाओं के लिए रोजगार के नए अवसर सृजित हुए हैं। लखनऊ में हर साल लगभग 100 मिसाइल प्रणालियों के उत्पादन से प्रधानमंत्री नरेंद्र मोदी और मुख्यमंत्री योगी आदित्यनाथ ने युवाओं के भविष्य को नई दिशा दे दी है। डिफेंस सेक्टर में लखनऊ की ऊंची उड़ान, हुनर को मिला मौका, सपनों को मिला आसमान।
Come.
Riya.
Come. My daughter Riya is gonna be a pilot, right?
My little girl will be a fashion designer for sure.
Oh.
Whatever Ria becomes, LIC's Amrit Bal Children Policy will always be there for her. बड़े सपनों का रखे ख्याल.
Air India Premium Economy boarding now.
I don't walk. I cruise. I don't sit. I lounge. I feel fresh. Hot meals bring a smile. Warm care every mile. I've found my place in the sky.
आंधी आए तो पर्वत बन जाऊंगा, आग लगे तो दरिया बन जाऊंगा,
भूख लगे तो रोटी बन जाऊंगी।
ये कर पाएंगे क्या? इनका तो पता नहीं, और उसने तो कर दिखाया। कोटक फ्लेक्सी कैप फंड 15 सालों से मार्केट के अप्स एंड डाउन्स में फ्लेक्सिबिलिटी के साथ लार्ज, मिड और स्मॉल कैप में इन्वेस्ट कर रहा है, जिससे इन्वेस्टर्स को लॉन्ग टर्म इन्वेस्टेड रहने का हौसला भी मिलता है।
म्यूचुअल फंड निवेश बाजार के जोखिमों के अधीन है। योजना से जुड़े सभी दस्तावेजों को ध्यान से पढ़ें।
Welcome back. You're still tuned into Midcap Radar. Let's welcome Samvid Gupta, who's the Joint Managing Director at Gateway Distriparks, to decode their Q3 numbers. This time around, their revenues were up 40%, EBITDA went up by 27%, leading to a profit growth of 85%. And this despite the fact there was an exceptional component in the quarter gone by. Mr. Gupta, good afternoon. Thank you so much for joining in. It's been a good set. There has been an EBITDA growth which the street liked. Can you give us a sense of what was the EBITDA per unit for your rail and CFS business in Q3, and what are you targeting for the entire year and FY27 as well?
Yeah, hi, thank you for having me on the show. So we've stopped giving vertical-wise split between rail and CFS now. Overall, we're looking at about a 25% margin, which can fluctuate slightly depending on how much more domestic business we continue to add next year. But this is the broad range that we want to be in. This is mainly due to some competition sensitivity and customers also finding out the data. So now we reported on a company-wide level. Even allocating costs is a bit of a challenge. And since post-merger, it's all one team now. So generally, it's about 5,500 EBITDA per TU on a company-wide level.
Okay. Samvid, hi. Welcome to the show. This is Ekta. So just reiterate, what your volume targets for FY27 would be across rail and CFS. And if you could also just touch upon what the double stacking target would be for, say, FY26 and going into FY27?
Yeah, so on the rail side, we've seen about 11% growth this year, which we're looking forward to continuing next year. This will be because of increase in domestic business as well as Ankleshwar ICD also starting up. So at least 10 to 15% is the target on the rail side. On the CFS side, we'll continue to look at about a 5 to 6% growth. On the double stacking, we've seen a growth of, we've gone up to about 41% for the 9 months this year. And our target is once JNPT connects all the way, which is expected by March end, that we should go up to closer to 44, 45%.
And would you extrapolate that, or what would your guidance be going into FY27 for, say, double stacking, considering it's been so strong?
So it'll stay around probably 44, 45, I was saying, for next year only. But our maximum, the way we calculate it, is 50%. That's how much on the lower stack and how much on the upper stack. Because of the imbalance in import and export, which is skewed in favor of imports, we don't expect to touch 50%, but maybe high 40s is a possibility 2-3 years on.
You have acquired 25 acres of land near Pithampur for development of new ICD. It's a 150 crore capex. When does that come on stream? Is most of the capex done here? Give us some timeline and the kind of projections that you will see from here.
So when we've done the land acquisition, it takes about 18 to 24 months to become fully operational with all the licenses in place and permissions in place. But we will try to expedite that as much as we can. This facility can handle about 120,000 TUs per year, but that will be in a phased-wise manner. Initially, right now, the market size is anywhere around 10 to 12,000 TUs. Which is being catered by one ICD primarily, that is rail linked, and some road-based ICDs as well. So we expect to take a good amount of market share once we're operational here.
What do you mean by good amount of market share? Are there any initial estimates? And you're saying 18 to 24 months from now, or some of the time must have already passed from that?
So 18 to 24 months from now, post land acquisition, because there's time for conversion, there's customs permission, railways work related has to come. There's a new rail line coming in, so that's also going to coincide with our operations commencing. So after that, then the ramp up of volume starts. Initial 1 or 2 years, it takes some time, but say over time, when there'll be 3 rail-linked ICDs in this region, we'd expect to have at least a third of the market share.
Okay, all right. Just hold that thought because we have the Ashok Leyland numbers. The margins look okay. So the margins are at around 13.3%, but there's a downtake in terms of the profit as compared to at least what the street was anticipating of around 978 odd crores. That was our poll. It's coming at around 796 odd crores. So we'll just wait by for more details, at least on the bottom line. The top line as well as the margins look okay for Ashok Leyland. Samit, any impact, formidable impact from, say, the India-US tariff, trade deal or the India-Europe trade announcement?
Yeah, so India-US is going to be a big boost. We saw some volumes we saw a dip in the last 6 months, particularly in exports, in textiles, garments, home furnishings. So this is a segment we cater to out of one of our terminals in NCR heavily. So we should see those volumes bounce back much faster. With EU, it'll probably take some more time as it'll take over a year to ratify the agreement. But long term, we're positive of both US, EU, UK, and other trade deals that India is going for.
And how much did your exports or how much did your volumes say dip because in the last 6 months?
So there was an impact of anywhere from 5 to 10% depending on facility to facility. So we should see that come back, plus further growth come in as India becomes more competitive to other countries in the region for this type of cargo.
And last question before we let you go, Samvit, what's the update on starting of your Western DFC? That could also be another booster, right?
Yeah, so we're hopeful that it comes in by March end. We're already taking double stack trains all the way up to Ankleshwar. So the last leg, which will allow us to run direct trains from north to JNPT, will allow us faster trains and even more double stacking, which will improve both margins and volumes. So I think March end is the correct estimate.
Was it going to start in Jan? Because some reports suggested that. So has there been a delay or the reports were incorrect?
I'm not sure exactly, but March was the initial target that was given about 12 months ago. Then they said they might prepone it to February end, but I think now March end looks more likely.
Okay. All right, Samvit. We're going to let you go on that note. Thanks very much for joining in and speaking with us. So that's Gateway Industry Parks. That's stock in focus, but we do have Ashok Leyland, more details which will be filtering in soon. It seems as though there is a little bit of a dip which has taken place in terms of the bottom line. Lot of auto stocks in focus on account of numbers. Remember, we just heard the Eminem management speak as well. We'll take a short break, but a lot more on markets, lot of stocks in focus. Stay tuned.
Fly Emirates, fly better.
Welcome back. Well, quiet for the markets, but do watch out for a couple of stocks. Lakshmi Dental is the one that should come up for you. That stock is actually down 9%. It's a very steep reaction to its Q3 performance. The revenue was up around 7%, but operationally it's been very weak. The margins have come in just about at around 10.5%, and it's a decline sequentially as well as Q-on-Q, as well as year-on-year by around 500 basis points. We have the profits also, which have seen a downtick on a sharp note for Lakshmi Dental. So that's the reason why you're seeing the stock down around 9%. Just want to point out, Ashok Leyland, the profit has been impacted by the labor code. So there is a provision on account of the labor code, which is to the tune of around 300 crores. And that's the reason why it missed estimates that the street was projecting. But nonetheless, the other stock in focus is BHEL, which has slipped in trade today. The government's announced an offer for sale of up to 5%. Vinny is here with more details on this. Vinny, over to you.
Hi, so yes, the offer price is at a discount of 8%. First, I want to highlight that. So that is why we're seeing the fall in the stock price as well. Now, government is looking to sell around 5% stake in BHEL. The base size is going to be 3% equity and a green show option of further 2%. So all in all, 5% that comes in there. The floor price for that is going to be at 254 rupees per share. And the total size, obviously, if you see in terms of value, at the floor price, it would come in at around 4,400 crores approximately. Offer for sale for non-retailers is opening today. For retailers, it opens tomorrow as well. So BHEL is a bit under pressure today.
Okay, all right. Lower in trade, 6% on that one. But let's talk about HEG now. It is tanking in trade even as Q3 margins are at a multi-quarter high. Nigel, tell us more what's happening here. It's down 5%.
Well, I'll have to attribute it just to profit taking, because otherwise the numbers look quite good. And the stock opened up 5-6% up. But from the top, in fact, it's corrected close to around 10%. We're going to be trying to get the management here on CNBC TV 18. They normally speak only to us. And we'll try to get some clarification with regard to what's the way ahead. But otherwise, it appears a routine case of profit taking because the revenue number is up by more than 35%. And the management has been telling us that realizations really will not move up at a very brisk pace. So it could be that capacity utilization actually has gone up. The EBITDA number as well has come in high by close to around 75%. And the margins that you were talking about came in more than 20% for the first time all the way since the June 2023 quarter. So that's a big move that you're seeing out there. They've got some benefit of power and fuel costs because that is up by only around 9% when you have top line growth of close to around 35%, telling you some operating leverage has played out. The net profit got a bit of a boost shot because you have the share of profits. In all probability, it's the Heidel asset, which has reported a big profit in comparison to a loss. Even on a sequential basis, it's better. So net, these numbers look good. They're on the way to increase capacity. However, the stock is coming for about a profit taking in today's session. Back to you guys.
Okay, all right, Nigel, thanks very much for that. So that's on HEG, that's stock down around 5%. That's all the time that we have on the show. We leave you with the markets absolutely quiet at this point in time. The Nifty is just about flat with the mid-caps marginally underperforming. Nothing really to write home about. Your stocks once we're back. Stay tuned.
Hello and welcome to Your Stocks live from the CNBC TV 18 Motilal Oswal studio. I'm Arundhati Ramanan. But before we get into all the stocks and the queries that we have today, let's take a check on what the markets are doing currently. Absolutely flat. The Sensex and the Nifty completely flat with a slight negative bias. You know, the Nifty opened the day touching 26,000, but ever since then failed to hold that momentum. It's now below the 25,950 mark. It's just in the red. If you take a look at that Midcap index, it's also 0.1% lower. It's underperforming those benchmark indices by a slight bit. But the Nifty Bank over there doing slightly better, managing to keep its head above water the whole day. It's about 0.1% in the green. But that's how the markets are doing. The auto stocks are doing well. That's what's leading the pack higher. And we've got those hospital stocks as well doing well. But joining us today to answer all of your queries are Ruchit Jain of Motilal Oswal Financial Services and Parthiv Shah of Tracom Stock Brokers. Gentlemen, thank you so much for taking time out and being here with us on the show today. You know, let's get straight into it. Our first query for the day, Deepak Keshan writes to us from Mumbai. He holds 8 shares of DCM Shriram at an average price of 201. His question is, should he continue to hold the shares for the long term or should he sell them? Parthiv, we can start with you. What do you make of this query?
Very good afternoon to you all. Yes, we are very upbeat on DCM Shriram as a company. I think it's a very well managed company. They have different divisions starting with sugar production. They are almost 42,400 TCDs in terms of capacity with 550 KLD in terms of distilleries as well. And it's been run pretty efficiently of late. They're not putting in new capex there. So that's a very prudent move. Even if I look into the other divisions, especially the chlorovinyl, there they have products like caustic soda, chlorine, related chemicals like hydrochloric acid. And more importantly, I think of late, they've done a lot of downstream capex where they've increased the capacity for a lot of products like PVC resins, calcium carbide, epichlorohydrin, and epoxy resins. So all of this will contribute going ahead. We believe the valuations are extremely cheap because of a very downtrending chemical cycle. And it looks like, I think, the prices have stabilized. So going ahead, we expect a better run rate in terms of quarterly results as well. So I think this is certainly a company to hold on to. And the investor has invested at a very nascent stage. So definitely, even the dividend yield from here would look very attractive. So certainly hold on for the long term.
So definitely must hold on to the long term. I've got Vinny in the studio as well. Vinny, our first query on DCM Shriram, and the call here is to hold that stock.
At least on the fundamental front. Yeah. So let's get the technical view now as well. DCM Shriram, Deepak is holding 8 shares of this one, right? Ruchit, what's your view for DCM Shriram? Should they continue to hold on the technicals as well?
Yeah, very good afternoon, Vinny. Very good afternoon to everyone. Well, the longer-term trend definitely remains positive for DCM Shriram. Now, one observation that I was doing on the longer-term charts is that since post-COVID, since November or October 2020, the stock has not breached its weekly 200 EMA. And whenever there have been corrective phases in this last 5 years period, whenever there are corrections, the weekly 200 EMA acts as a support and the stock resumes uptrend from that. Now, that average support now is around 1,000 rupees. So I think from here on, even from a longer term perspective, the price-wise downside seems to be limited. 1,000 being a good long-term support for the stock. So till that is intact, I think the structure remains intact. So one can continue to hold on to the positions.
Okay, continue to hold on to the positions. That's the word even on the technical front. Let's move on then to the next query. We have Santosh, who is writing to us from Ghaziabad. He wants to know if he can invest in Paytm for the long term. Clearly, this is an investment query. Fundamentally, Paytm, what's your view on this one? Parthiv?
Frankly, I think we are not very comfortable with the current entry points and the current valuation. This is despite the fact that if I look into the internals of the last reported quarter, their gross merchandise value grew by 23%. Their net take rate moderated to 8.4 basis points from a very high of 9.1 basis points. Lending business continued to show stellar growth, of almost 10% quarter on quarter. And going ahead, I think the government-related subsidy in the PIDF scheme will not be replicated. But the management was very confident that going ahead, in terms of the monitorables, their merchant subscription growth should look good. Loan disbursement trends are looking very good for them. And the take rate should also improve. But our sense is, I think the valuations are elevated and the investors should wait for levels of 950, 1,000 for making an entry in a stock like Paytm.
So you think the valuations are elevated, but Ruchit, if I can come to you, any levels that look good for this person to, sort of buy into Paytm at this point in time?
The stock has good medium-term support around 1050 range. So I think if we get any dip towards that 1000 level, then the risk-reward ratio would become favorable to take any kind of contra trades for mid to long term. So I think one can keep a buy and dip strategy, and any declines towards that 1050 can be used as a buying opportunity then.
All right. Okay, so let's move on to our next query then. Saloni writes to us from Goa. She wants to know the short-term view on UPL. So, Partha, from a fundamental point of view, what do you make of this stock? Is it a good stock to sort of bet on?
Yes, I think the fortunes for this company seem to be turning around. One, I think the management is now razor focused to try and reduce the elevated debt on a consolidated balance sheet. And I think they've made attempts in terms of getting a subsidiary listed and raising funds, which will help them to deleverage quite a lot, which is, I think, a positive sign. Second, I think the agrochemical cycle globally is looking better in terms of what it has witnessed in the past many years. And a lot of data points from the Chinese in terms of the intermediaries which goes into the global agrochemical manufacturer, the prices have reduced and probably the end product prices are looking up. So we expect the spreads to improve. Valuation wise, I think it is available very, very attractive as compared to a lot of the other listed agrochemical peers in the country. And in terms of the exports, I think it has very good market. So we believe the valuations are cheap here and not only short, but we believe medium to long term, I think this looks really good.
Medium to long term, it looks good. Richard, what's your view for this one as well? Given that, every time UPL, you see it reach 800 in the last 5 years, then again it comes down. Now it touched 800 around that level and it's come down again. Obviously, not significant decline, but on the technicals, what should the viewer keep an eye on? Because it's a short-term view that they want.
I think a short-term pullback move towards that 800, 820 can be expected again. We did see some gap up opening, a few days ago. The stock is managing to hold its 20-day MA and the 50-day MA support zone. So I think overall, the broader trend for the stock is still range bound only, but 800 being the higher end of the resistance. And as you mentioned, I think that can be tested, which can be seen as an opportunity to book profits or exit over there. So at current levels, I would recommend to continue to hold in the position for possible up move towards 800.
Okay, possible move towards 800 is what you could watch out for. But let's move on. The next query from for today is coming in from Braja Abandhu Behera, who is writing to us from Bhubaneswar. Now, he wants to know why Heidelberg Cement, the stock price, despite decent numbers, has not managed to do much. Fundamentally, what is the view on Heidelberg Cement? Despite earnings being decent, not managing to see a good up move. Parthiv, what's your view?
Vinny, it's very clear that any cement player, what is the key ingredient for re-rating in terms of getting very good shareholder returns is the capital allocation and continuous organic and inorganic growth. Heidelberg Cement, I think, no doubt, it's a very efficiently run company. It was an acquisition by the German Heidelberg Group to Mysore Cements, and after which they've done a lot of debottlenecking and tried to do their best in terms of improving the operational efficiencies. But beyond that, probably the parent has refrained from further allocating new capital or going for any expansion plans, and their capacity and their market share has really shrunk. And probably always Heidelberg Cement has been considered as an inorganic acquisition play, which has also not materialized since quite long. And that is the key reason that despite a lot of other well-run frontline cement players have done extremely well, Heidelberg Cement has really struggled. Our sense is, I think, the investors better off looking into other well-run names like, say, Ultratech Cement, Ambuja Cement, or for that matter, even Ramco Cement. I think these are the type of stocks you should look at who are eyeing a lot of growth organically as well as inorganic.
All right. So you're saying there are other stocks to look at. But Ruchit, if you could tell us, this stock has seen like an 18% fall in the last 1 year. If you could sort of say, are there any levels you think that this person can enter this stock? Or do you feel that he should altogether look at another cement stock itself?
I think you should altogether look at some other stock because, when a sector moves positively and if there is any stock that is not performing or showing a relative underperformance within the sector, that clearly indicates a lack of buying interest in the stock. So Heidelberg has been forming that low top, low bottom structure, 180, 185 technically was an important support, which has recently been breached. So I think 145, 150 is where the next major support lies in the stock. Comparatively, I think shifting to large cap stocks such as Ultratech, Cement or Grasim would make more sense, where overall price structures looks much positive. And we can see that whenever there is a rally in the sector, the leadership comes from the stocks such as Ultratech or Grasim. So better to stay with the leaders rather than laggards.
All right, better to stay with the leaders rather than the laggards. So definitely to look at another cement stock and not Heidelberg Cement. But gentlemen, on that note, we have to take a quick break, but we'll answer more stock queries on the other side. Stay tuned.
Sorry, Pop.
Welcome back to your stocks on CNBC TV 18. Like you can see the headline indices for y'all. Nifty 50 managing to hold on to slight bit of a gain. This is what the trend has been this morning. Very range bound. But Sensex, that's trading in the red. The bank side, that is trading with mild gains, while mid cap and small cap, that continues to be under pressure in the trading session. A bit more of an underperformance there. But let's keep it going with your stock related queries. And we still have with us Richard Jain as well as Parthiv Shah. to answer all those doubts. Let's move on to the next one then, and this next query is coming in from Venkatesh, who's writing to us from Chennai. He's holding 80 shares of Afcons, and this is at a price of 456 rupees per share. Wants to know whether to hold or book his losses. Parthiv, Afcons reported their numbers also yesterday. It was not anything exciting there. Today also the stock is down 2%. They're already making a loss on this one. What is your view now?
Vinny, absolutely. I think only looking at the order book is not the best way to study an infrastructure company. Afcon, despite the fact that it comes from pedigree of Shapoorji Pallonji Group, kind of has struggled ever since it IPO'd, and post which it did get some decent orders, because in terms of size and capacity, I think it has substantial capacity, especially in the marine and port facilities, and also in the transportation segment, transmission line segment. But when you look at the execution, I think the ROEs are below lower single digits, and even I think the margins also are pretty volatile. And probably that has been the key reason why the stock has languished at a point in time when a lot of other such infra players who have better execution, better working capital cycles, I think have done extremely well. So I would suggest the investor to look into a company like Larsen and Toubro, which is currently sitting at an order book of upwards of 7 lakh crores. Their execution ability has improved a lot. The management is razor focused to look at net working capital cycle as a percentage to the sales, and it has improved constantly. The cash flows have improved. So certainly look into L&T as compared to Afcon.
All right. And, you know, Ruchit, he holds 80 shares of Afcons at 456, right? That stock has fallen more than 24% over the last year. So at what level should he sort of book his losses if you think that's what he needs to do?
There's a clear low top, low bottom structure indicating that the stock is still in a downtrend. Any kind of pullback moves towards the 50 DMA, I think that should be taken as an opportunity to exit, since the trend is not positive. The DMA resistance will come around 360, 365 kind of range. So any pullback towards 360, 365 can be used to exit.
All right, so that's what he needs to use to exit that stock. All right, but our next query is coming from Raghavendra Rao, who writes to us from Hyderabad. He holds 300 shares of BSE at an average price of 217 rupees. He wants to know if he can dispose the stock at the current price and book profits, or should he keep it? So let's start by getting the fundamental view, Parthiv.
Certainly, I would suggest the gentleman to hold, because one, his entry point is extremely low, is sitting on very, very good returns. And also, I think these are fantastic free cash flow generating machines, and especially BSC in terms of its execution ability since the last 3-5 years has been doing extremely well. You look at the transactional charges growth, I think that has been stellar. And it has dwarfed, no, this comes from a small base, but it has definitely dwarfed what NSE has been reporting. Plus, I think the services to the company income has also gone up a lot. So if you look at the internals, the sales growth has happened to the tune of almost 56%. And there is a classic case of operating leverage kicking in because the profit growth has grown at 70%. Going ahead, no doubt, we do expect some sort of moderation with the languishing market right now. But our sense is it's quoting at a trade multiple of 58 and a forward multiple of around 45 times. It's not prohibitively expensive. So I would certainly suggest to hold on to BSE.
Okay. And, Ruchit, what's your view coming in for BSE as well? What should the viewer do? Average price is 217. Should they continue to hold this or book profits?
Yeah, overall, the sectoral outlook looks quite bullish. If we look at the Nifty Capital Market Index itself has given a breakout from a consolidation, and hinting that the segment should continue its uptrend. And the stock has been an outperformer. That high top, high bottom structure still continues. So no signs of trend reversals. Looking at it by his buying price, I think he does not need to worry much about the short-term consolidations if happen. But since the outperformance could continue, it's better to hold on to position and ride this trend.
Okay. Let's move on then to the next query. We have Jayakumar, who's writing to us from Kerala, holding 1,000 shares of Piramal Pharma. Price is 208 rupees. They're making a loss on this one. Should they continue to hold this or exit? He can wait till 2027 March, so one more year time period where he can hold on to. Piramal Pharma, Parthiv, is that a bet you would be looking at? Because they've spoken a lot about CDMO side, this coming in as a beneficiary of play for CDMO. But we've not seen that coming in the stock or that great in terms of numbers as well.
Oh, yes, 2026 was a difficult year for PPL Pharma, and the management did acknowledge the fact that there was a major inventory destocking in one of their large on-patent commercial products. That is kind of easing out right now, and slower early-stage CDMO orders in H1. They believe that H2 should be a lot stronger because there was some inconsistency in terms of US biopharma recovery in terms of the funding. And there were some regulatory delays in the inhalation anesthesia. I think all these multiple reasons kind of plagued the growth for 2026. But on an FY27 basis, I think the management is a lot more upbeat. They're looking at early cycle green shoots in CDMO. There's been pickup in RFPs and order inflows. So especially because the gentleman is willing to wait for 1 year, we believe this will be the year of turnaround for Piramal Pharma. And I think definitely a lot of other segments are also doing reasonably well. So I would suggest to hold on for at least 1 year. Try and cut your losses as far as possible, but at least hold on for 1 year.
So you suggest holding on for 1 year. But Ruchit, what would your view be? Is there a level at which he should exit? Because he's got 1 year to hold the stock and he has time to see whether he wants to exit or hold. So would you say there's a level at which he should exit or continue to hold the stock?
Recently, the stock has seen a decent price raise correction from the highs. But what we can observe a positive divergence where the prices are making new low, but RSI is making higher low. And generally, such situations lead to a pullback move, at least in short to medium term. So, pullback move towards 200 EMA can be expected in this, which is placed around 185 to 190. So, I think around 190, he can take a review again whether he should exit there or not. But at current levels, I would recommend to hold and take a review around 185, 190.
All right. So you would recommend to hold right now. But let's go on to our next query then. AY Sakaria writes to us from Kerala. He holds 2,000 shares of Kitex Garments at 220 rupees and wants to know the view on the stock. He can hold it for another 6 months. So let's start with the fundamental view. Parthiv, what do you make of this stock? Do you think he should continue to hold it?
Not really. We don't like Kitex Garments, despite it being the world's second largest manufacturer of cotton and organic cotton ready-to-wear garments for infants and children's aged between 0 and 24 months. Somehow, I think the performance has been languishing, and no doubt, I think the stock was under pressure, especially post the additional tariff duties that were levied. And after the duties are kind of now removed, and now we are sitting at 18%. The US geography, from where it generates almost 65% of its business, I think should do well, but we are not very comfortable in terms of the current entry level valuations for this company. As a matter of fact, in the textile space, we are more upbeat on the home textile theme. And in that, I think players like, say, Indocount, we believe should have an upper hand and should do better in the long run.
Okay. Home textile players is a better bet in the long term. That's the view from Parthiv. But that was the last query for today. Ruchit as well as Parthiv, thank you so much as always for joining us on the show, helping our viewers get those answers which they are stuck on for a while in terms of stocks. Thanks so much for that. But with that, we're absolutely out of time on this edition of Your Stocks. Remember, you can always email us your queries or WhatsApp us on the number that's at the bottom of the screen for you all as well. Thank you so much for tuning in. Up next, we have Closing Bell to take you to the last hour of trade.
Co-powered.
market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Some bit of a modest gain, and then seems like Hang Seng has given up those modest gains as well.
Charles Schwab, of course, is the leader there, and that was down about 8% or so.
Royal Enfield volumes are up 21% year-on-year. Even commercial volumes have increased by 24%.
25,970, so it's up, but not holding straight away.
But a broader point here being, since this sector is regulated, there are multiple aspects of risk to be taken into consideration.
There was an extra 8% volume increase from insurance with a 20% revenue increase.
In the rising gold price scenario, margins of jewelry business do see a little bit pressure.
Definitely, we had highest ever quarterly revenues and good profitability.
Today again, we're seeing the rupee appreciate further in trade, now trading at 90.5 to the dollar.
Base size is 3%, and the green shoe option, if government decides to exercise that, for that it would be 3%. Mahindra Group has reported revenue of more than 50,000 crore for the first time ever. That's the consolidated revenue.
A 60-point cut from the highs of the day. The mid-caps are sulking, though they have recovered a tad bit, but again, there are more stocks on the declining side versus advancing side.
Okay, it's quietened down after 2 days of a decent move. This Wednesday, things are not on the back foot, but 18 points, 25,950, almost exactly where we left off yesterday, which basically means that if we end here, it's not going to be a bad outcome, but 26,020 is the level we want to get above. We'll see if that happens. This is Closing Bell. We're coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Prashant, Rima and Nigel with me. Guys, good afternoon.
Hi, good afternoon. Facing a bit of a hurdle around that 26,000 mark. So we've slipped a bit from the high point of the day, close to about 70 odd points, but flat now. The Nifty IT is the problem. Nifty IT Index is down nearly 1.5%. So while the Nasdaq has recovered globally, the Indian IT, the selling pressure here continues. So at the low point now.
Well, that's right. Some kind of consolidation. We have had a good run. Par for the course, I would say, right? Some quietening down. Only today the number of stocks declining is more than the number of stocks advancing. But I think that's fine. We've had quite a few days of outperformance. So pretty okay.
And mid-cap, small caps also, even though we're consolidating, it's just consolidation. It's not that it's losing ground or seeing.
Your tech stocks, Rima, there's
tech is the problem.
Every now and then there's tech stocks. Anyway, hopefully you get your act together, Rima.
Such disdain, Nigel.
Look at my metal.
Directed at me,
Just look at the metal stocks. I mean, they have had such a good run. There was a period when metals, they were down. And the tech stocks were up.
Sabka number aayega na.
Sabka number aa jaya, and like right now, Rima's done with the results a long time ago. I'm the only one who's waiting.
Oh, your numbers are.
Yeah, Rima
Tata Steel came. Some are left.
Yeah, Hindalco and Coal India. And
tomorrow.
And this Friday evening, ready to celebrate Valentine's Day.
Okay, well, it's an action-packed day. Let's just quickly run you through what's lined up here. Markets, of course, gyrating a bit. Key indices are witnessing a choppy session. Mixed move across sectors and tech counters under pressure. PSU banks and autos are trading firm. Mahindra, of course, numbers came through just now. Ashok Leyland has sold off from the highs. Eicher in the spotlight. Solid third quarter numbers. Some fine print here. Jubilant Food, of course, is down despite a strong showing in the December quarter. Britannia is higher on the back of a 450 basis point margin expansion in the quarter. So it's earnings, and more earnings. Why is Motilal bullish on Premier Energies? We'll tell you the rationale behind that. So that's coming up here all in the next 1 hour on Closing Bell. How should you position yourself is the question in the last hour of trade. Mitesh is with us. Mitesh, good afternoon. Good to have you here. So it's almost 3 points left now. And, the yesterday's close kind of sort of, in a way, open and close around the same levels. A bit of exhaustion setting in, Mitesh?
Yeah, quite possible that, some tiredness is coming. We're not getting past 26,000 convincingly. Talked about that as an important level. Not only there's some options data would suggest that, but it's a round number, and as well as it's an earlier pivot on the intraday charts. So maybe, as I said, take some profits over here. wait for a dip to come in. Otherwise, in case we start capturing 26,000, then we have a chance of getting towards 26,250, 300. But for the time being, the initial feeling is that taking part profits will not hurt and it will be a smart strategy. For the time being, the stock calls that I have, and after a long time, I have a sell call as well. I have a sell on IDFC First Bank with the stock at about 84.25 for targets of 79, and Exide is a buy with the stock at 335 for targets of 352.
Got that. Just put the spotlight on the frontline IT names. TCS down 2.5%. Infosys sliding 1.5%. Over a 1% decline coming through on HCLTech, while Wipro, LTI, Mindtree, Tech Mahindra also in the red. So it's a very disappointing session. And it started flat at an index level and it continued to gravitate lower and finally now at the day's low. But let's talk about the good part of today's trading session, and that's the auto stocks. Particularly a stock like Eicher Motors, which is the top Nifty gain, a 6.5% on that. It's a fresh 52-week high. Sudarshan joins in with Eicher Motors and the other auto sales numbers, auto earnings that are out today.
So it's largely been a good day for majority of the auto companies which have reported earnings so far. So three major names, Mahindra & Mahindra, Eicher Motors and Ashok Leyland, are in the focus on the back of the earnings of Q3 FY26. And all these companies either have reported earnings which are largely in line or say better than expectations. So we'll start with Mahindra & Mahindra. An Argo company has come out with Q3 FY26 earnings. Both the segments, auto and farm segment, have been seeing healthy volume growth. It was up 23% YY in Q3 FY26. That has helped company to report a double-digit revenue growth. On the consolidated basis, Mahindra Group has reported revenue of more than 50,000 crore for the first time ever. Now, on the standalone basis, profit was up 33%. Revenue has increased by 26%. EBITDA too has seen a jump of 27%, and margin was in line with expectations and has come at 14.7%. Going forward in FY26, companies expecting tractor industry to see a growth in the range of 20 to 24%. Even SUV is going to see a healthy growth because the demand for the recently launched vehicles remains strong. Coming to the Eicher Motors, top Nifty gainer, up more than 6%. On the volume front, company has been doing good, but on the margin front, there was a concern till Q2 FY26. But in Q3 FY26, margin 2 has come in at 25.5%. That's at a 5-quarter high. And after several quarters for Eicher Motors, EBITDA growth has outperformed both volume growth and revenue growth. And on the back of strong volumes for both Royal Enfield and commercial vehicle, revenue for the company has increased by 23%. EBITDA has seen a jump of 30%, and margin, as I told you, it has come at 25.5% versus 24.2%. And going forward in Q4 FY26, companies expecting strong demand to sustain, and even in FY27, motorcycle industry is expected to see a high single-digit growth. Coming to Ashok Leyland, it has come out with its earnings. CV volumes have been strong, and majority of the companies have been saying that the CV is in up cycle, and in Q3 FY26, Ashok Leyland has seen volume uptick of 24% YY. Even on a sequential basis, there was an increase of 17%. And despite a sharp increase in the raw material cost, company has reported an increase in the gross margin if you compare YY. But on the back of strong volumes, revenue has increased by 22%. EBITDA has seen a jump of 27%, and margin has come in at 13.3% versus 12.8%. Stock has seen a downtick after the earnings, but remember, after Q2 FY26, in the last 3 months, stock has seen an up move of more than 50%.
Thank you very much for that. Siddharth Khemka, Head of Research, Wealth Management, Motilal Oswal Financial Services, is now joining in. Siddharth, what are you recommending in the auto pack? Post the numbers.
Yeah, definitely. Hi, good afternoon, Rima. So if you look at, I think Mahindra & Mahindra came out with good set of numbers that has been among our top picks in the auto sector for quite some time. In terms of overall earnings, revenue grew about 26%, in line with our expectation. Overall, EBITDA margins was up 100 basis points, and adjusted PAT grew 35%. What we believe is that while the tractor volumes continue to remain pretty strong, the company is also showing good traction in the passenger vehicle segment with its EV business picking up. Valuations remain pretty good, and I think even at these levels, we see at least 15-20% upside for a strong rural play in Eminem.
Okay, so Eminem is the preferred pick. What about Titan? Titan seen some profit booking after hitting record levels. Numbers were strong, 40% plus jewelry revenue growth. Stock was up 5% yesterday, so today it's cooled off a tad bit. But is it on account of valuation or the fact that if prices continue to remain at this level, volumes are anyway on the flatter side? The buyer growth has been flat. So where will the top line come if gold prices don't surge?
Yeah, I think on the headline numbers, pretty strong numbers from across jewelry names, including Titan. So stellar growth. Profitability was pretty strong. Volume growth is something, as you rightly pointed out. I think once we see some cool off or at least stabilization in the gold prices, volume growth will come back, because a bulk of business is driven by marriages, and that we see that is a continuous structural uptrend in India. We believe that within the jewelry segment, Titan continues to be the market leader among the with the large nationalized presence, and they continue to gain market share. The other than jewelry business, also the eyewear and the other segments, that is also seeing good growth, 20% plus growth in terms of business revenue. I think all round super performance, a bit of profit booking, but we remain positive on the entire jewelry segment, and Titan being a preferred pick there. We continue to maintain a buy on dip strategy on Titan with a target price of 5,000 rupees.
Yeah, no, absolutely. I just want to talk about Apollo Hospitals, right? The stock, of course, is one of the big gainers, has been from the word go. And we spoke with the management earlier today. They sounded bullish, and of course, the prospects. Just want to play out a quick soundbite in. Listen in.
So there was an extra 8% volume increase from insurance with a 20% revenue increase. So this will continue, and with this, we should be able to get higher occupancy metrics. Insurance enabling patients to enter the Apollo system for robotics, for transplants, improvement in cardiac work by 20%, onco work by 18%, orthopedic 17%, and gastro 17%. This has all led to a higher ARPP. Insurance improvement is about 5% total volumes, if moving up from 43 to 48% now come from insurance. Can we continue with the ARPP of 11%? I think, we started from a little bit of a low base effect, and we've moved to this number, therefore showing 11%. Will this continue? I think it could probably continue in the range of 5 to 6%. But what will improve is volumes. And when volumes improve, operating leverage and therefore absolute EBITDA and profitability will continue to improve.
This was, of course, about Apollo Hospitals, but let's just pull up the Indraprastha medical stock up, right? I think it perked up almost at the time that the management was on air, the Apollo management was on air, and it's still holding with gains, about 5%. The surge that you see came through when we asked the Apollo management about what their plans are. They own 26% in Indraprastha Medical. The Delhi government owns another 26%. The buzz for a while has been that Apollo essentially wants to increase its stake in Indraprastha Medical, and perhaps eventually down the road, consolidate Indraprastha earnings, and it's a well-functioning, highly profitable, debt-free company into the Apollo accounts. So that question to the Apollo management, and this is essentially what Sunita Reddy told us. She said, and I quote, "We continue to have a very collaborative dialogue with the Delhi government. Bit early to comment, but we are both hopeful of a very positive outcome. We do feel that we would like to do more in Indraprastha." Let me just end with that. And very soon we would probably be able to talk about how the contours will look like. So that is very specifically about the Indraprastha medical situation. Rima.
Okay, all right. Got that. Sid, wanted to ask you about a couple of other names then. HEG, have you had a look at that? The numbers look quite good, but the stock has fallen off the cliff after starting up 5%. It's down 5% right now. You had a look?
Hi, Nigel. So we had a look at HEG numbers, pretty strong numbers. Unfortunately, not under coverage, so did not have a detailed analysis. But I think some bit of profit booking after this rally that we have seen in both HEG Graphite in anticipation of the strong numbers. I think as you were discussing earlier, metals as a pack has been doing well, and this is an ancillary to that space. So I think the outlook also remains pretty strong for both HEG as well as graphite.
Got it. All right. What about any of these other stocks? Have you had a look at them? TVS Supply Chain stock is now up close to 16%. Big move is what we're seeing on that particular name. Any view?
So again, another name we don't have coverage on, so we'll not be able to give a view.
Vodafone Idea? Mr. Bidla has been buying quite a few shares in the last 10 trading sessions. Even an update that's come yesterday on the exchange is saying that he's interested. Are you interested though, Sid?
So yeah, if you look at Vodafone, we have been a bit negative while there has been some relief that has been given by the government. I think a lot of things need to be done on the debt side before one can turn very constructively positive on that. I think valuation wise pretty good. It needs to be now seen in terms of how well they are able to manage their market share. They have been consistently losing active subscriber base. The debt burden that is pretty strong. And the latest relief that has been given, I think the clarity in terms of how the AGR dues can get capitalized over the next few years, that needs to be seen. Bharti Airtel is our top pick, preferred pick there. We upgraded Bharti Hexacom after the results from a neutral to a buy. We believe valuations are now attractive. They were earlier trading at a premium to Bharti Airtel, and hence we are downgraded. Post-out downgrade, the stock underperformed by almost 18%. And now valuations looking attractive. We believe both Bharti Airtel and Bharti Hexacom could be the preferred picks in the telecom space.
Okay, all right. Sid, I wanted to ask you about these recyclers. I think you'll have coverage on Gravita, if I'm not wrong. And today we had a recycling segment, from around 10:30 a.m. to around 11:30 a.m. We had Gravita detailing their foray into the copper segment, the recycling segment out there. The street was looking at aluminium and other products, but they went for copper. They've given us their rationale. The stock has recovered from the recent low, though it's a far cry away from the recent high. Any view on that name? Ganesha Ecosphere, the stock is up more than 20% in this week, but it's a third of what it was at its peak. And also we had Gen Resources, the newly listed company. All of them are saying that there's a longer pathway ahead, but are you interested in any of these three?
Yes, we do have coverage on Gravita among the three names where we have a positive view. I think overall recycling business, that looks pretty good and attractive. Some of them, for example, Gravita is now also getting into the copper recycling business, which should be an added growth trigger for them. But you have to look at these kind of companies from a long-term perspective, given that they are largely dependent on the government policies, and you have someone like a Trump sitting in US where he's not that focused on in terms of the renewable energy, recycling, carbon, green energy. So I think that kinds of puts a bit of an overhang on the space. But structurally, we believe that this is a space that should the entire ESG theme, both renewable energy as well as recycling business, that should do well, which is where we have also released a new report or idea on Premier Energy, which is at the foremost renewable energy business company in India, fully integrated, doing a lot of capacity expansion and also valuations being attractive, and hence we believe it's a good opportunity to add something like a premium energy at the current market.
Siddharth, I know towards the end of November, Motilal Oswal had upgraded Indian IT sector to an overweight. And again, you all had cited, the index had underperformed, valuations are now attractive. Global AI hyperscalers are experiencing diminishing marginal utility from infrastructure build-out, which means there will be a shift towards application and services layer. But now that entire thesis is getting, questioned, whether the application services revenue will be as much, the integration maintenance will be as much as what the analysts were expecting, and IT stocks have taken a big beating. At Motilal Oswal, are you rethinking this overweight call on IT services now?
So yeah, Rima, so thanks for pointing out that was a good report. I think it's too, again, from a futuristic perspective, we are looking into the ahead, and trying to evaluate whether Indian IT companies can play the role of providing the application services for AI, which is where some of the Indian IT companies, for example, Infosys, HCLTech, Tech Mahindra, they have built on the AI suits as well as started delivering services on that front. We believe, yes, there is definitely a scope for Indian companies to start delivering on that front, but this is a developing technology. We need to continuously keep evaluating how things are changing, especially in the AI front, where growth is not linear but more exponential. Right now, we definitely have that view, but more from a next, you can say 1 year, 2 year perspective, we believe that Indian IT companies, they have shown that resilience in the past as well, trying to redevelop their product services to suit the latest in terms of the requirement. And hence, we believe that the Indian IT companies would be able to provide those services, applications where IT infrastructure, so AI infrastructure investments has happened, but the service applications would require some help. Definitely, AI will help in improving the efficiency. Maybe the job requirement may not be that much, but in terms of delivery, we believe some of these names, for example, Infosys, HCLTech, could do well over the next 2-3 years.
All right, Sid, we have a common interest with regard to two-wheelers. That's the Royal Enfield. I think you've been thumping for the last many years, and me too as well. That's the only bike I ever owned. That's that discussion for another day. But what about the stock? It was expensive. It is expensive. It continues to remain expensive, though the street likes the numbers, and now they're showing confidence. They're going ahead and adding capacity as well. What's your view on Eicher Motors from here on?
So yes, I think we do share that passion for riding and thumping the Royal Enfield, and hopefully we should ride some day together. With regards to numbers, pretty strong numbers. Outlook, I think management commentary sounded pretty strong, positive. Margins continues to remain pretty strong. But however, we believe that going forward, that growth could get a little bit under pressure, especially if you see after this initial surge, especially in the pent-up demand now. That even the government has allowed the FTA agreements, the trade agreement with US, Europe, some of these imports from Harleys that could impact in terms of volumes. So overall, we believe valuations are on the higher side, and hence we have an underweight view on Eicher. Nonetheless, the company continues to outperform, but purely on terms of valuation and in terms of growth declining going forward, our growth estimates, especially for FY 27-28, is in the range of 10 to 12%, based on which we believe that valuations could be attractive. It is a good time for booking profits in Eicher and moving into some other IT names, including TVS Motors, Ashok Leyland, and Eminem.
Thank you very much for that. Let's talk about Jubilant Food and Britannia. So Britannia held their conference call earlier today. It started at 11 o'clock. So let's find out what they said and more about Jubilant Food as well. Vinny joins in with the details.
Hi, so absolutely both these stocks are in focus today. Let's not forget, firstly, Britannia, the CEO, this is his first call that's come in as well. He took charge on 15th of December. That's Rakshit. So that is the first, a new CEO, his first call that came in. Now, in terms of numbers, obviously it was a good set of numbers. We've spoken about that through the day. Con call highlights. What did they say in terms of commodity prices? They said that the commodity prices have been largely stable for the company. So in terms of margins, if the commodity prices are stable, that means margins also likely will not see a major impact coming in. Now, they said that they've upped their investments in terms of brands, and they continue to expect this number to keep going up going forward as well. So investments in different brands, that's what their new focus and strategy is. Sales growth, they said that obviously we've spoken about this, that 12% sales growth that came in November and December, both the months which saw better growth than October, which was disrupted by GST. That was only not any channel filling or, stocking up, not 12% growth. It didn't include that. It was a pure normal business growth. So demand was good for them in November and December. Regional players, regional competition, they said that is a concern that comes in. They've spoken about it in the past as well. Regional competition has been increasing, but it's not specific to Eastern region. Eastern region, higher competition is there, but across the regions and regional players, they are seeing an increase there. Though in terms of national competition, national player competition, they have still managed to see a market share gain in the last couple of years. So they're not too worried about that. They have new strategies that are coming into place as well, which they are focusing on to, fight with the competition in terms of the regional as well as national players. Jubilant Foodwork, a good set of numbers obviously from the company that have come in. Now they've reiterated their outlook, 5 to 7% like-for-like growth for Domino's and 15% standalone growth with 15% pre-Ind AS growth they're talking about in terms of EBITDA margins. Now what the company has also said that the company does not see any headwinds for this like-for-like growth. They're not worried about like-for-like growth moderating due to the high base that one may see coming in as well, and not worried about the margin guidance. So they're holding on to their guidance as well. And post that, brokerages like Jefferies are maintaining their buy call. Target price is 850 rupees. CLSA continues to maintain its hold call, as well as HSBC also continues to maintain their buy call. So everyone's been steady in terms of their call for Jubilant Foodwork. No change in terms of target price as well.
Thank you very much for that. We will slip into a very short break. On the other side, we'll invite Jigar Mistry of Buoyant Capital. Stay tuned.
Okay, well, I mean, absolutely flat. 15 points higher on the Nifty, 25,950. By the way, Poly Medicure, if you can pull the stock up, we had the management with us in the morning. Stock's down 6%. Actually, the big fall happened right after the word go. And it just kept going. And just look at, the high was late last actually November of 2024 was the high, about 3,300, 3,400, and about 1,400 now, under 1,400 as far as the price is concerned. This is, you know, in terms of medical equipment, etc., fits one of the only players which kind of fits the import substitution theme in that space, listed space. But it's gone one way. Nigel?
Yeah, you know, the problem is that these Chinese imports are coming in there. That's what's hampering the domestic market. In the UK market, there's a lot of inventory in the system as well, which is hurting them. And this year, obviously, the guidance has been scaled back numerous times. So, you know, you put all of that together, number of dialysis machines as well, they have scaled down by close to around 100. So, all those pockets where there was supposed to be big growth, that's not coming about. In addition to that, there is inventory in the system as well. So that's why a lot of uncertainty. That's why the street is not very, very excited. I think from the day of their numbers, in fact, the stock is now down. I think in the last week or so, 10 days, I think it's down close to 20%. Yeah. And that's one of the only plays actually you have with regard to medical equipment, and yet it's getting sold into. Has been a big wealth creator over a longer term.
Have they, Nigel, we spoke with them. Have they said they've asked for Chinese imports to stop?
So they
have made an appeal.
They told us yesterday on CNBC.
So they said that China has been dumping in India in the renal products business below the import price also. So that is a problem. Therefore, they've scaled down the business, but they have formally reached out to the government and for some sort of a protection. Yeah. But I think that will be the big trigger.
And you know, though we had the management, they were guiding for better times in 27. But for the time being, the street is saying it's too uncertain because the guidance was very strong. For the next year in FY27, they're talking about 25% growth. On the exports front, they're talking about 12 to around 15% growth. But the street is not buying it because they're saying too much inventory in the system. There's a problem
US is also nothing for them.
Well.
I think some 5%.
It's a very small proportion, but they believe there's a bigger runway out there. But clearly, one of those darlings, you know, if you take a look at it from around 2020, 2021 till around 2024, it did very, very well. And now, in fact, it's coming for some selling.
Basically 1/3 now in terms of the price from the top. Jigar Mistry is with us, co-founder Buoyant Capital. Jigar, good afternoon. Good to have you here. I mean, you can get the theme right and the stock wrong. I don't know. I mean, maybe it's the wrong paraphrasing of the situation in this one. But what's your sense? I mean, with something like this?
Yep, Prashant, we used to often say the operation is successful, but the patient is no more. Not obviously in this context, but sorry, we don't really track this stock or own it for that matter. So no views on the stock per se.
What have you been doing, Jigar? Give us a flavor, a micro flavor, not a top-down, but a bottom-up flavor of where you've been active, what you've been doing, what has Buoyant been doing?
So one, you know, largely we are a top-down fund, Prashant. So a large part of what we do stems from how we see things from a top-down perspective. But over the past, I would say 3 odd months, we have increased some exposure to small cap, which in November was, you know, at the absolute low since the inception of our fund in 2016. So obviously the corrections we have used a little bit to dial some risk up. The way we see things, frankly, you know, there were two broad issues, right? One, the rupee was not helping, which was a circular loop, because the more FII sold, the more rupee worsened, and the more rupee worsened, the returns when denominated in their home currency became even worse, and then they sold more. So hopefully the deals put a stop to that. Rupee sort of improved a little bit. It was oversold, but again, it's sort of inching closer to you know, those highs again. The other part is that the phenomenal wealth transfer that has happened, you know, we counted it to almost close to 6 lakh crores, which is 1.7% of GDP. And from that standpoint, you know, people were waiting and are still waiting, I guess, as to when that starts showing up in the listed equities volume growth numbers, right? Because on the one hand, the capex from state and center has slowed down. The money has been given in the hands of people. And if they are not spending either, which is sort of what is apparent from 3Q numbers, which is all single-digit growth, then people have started wondering on where this is essentially going. So I think once the market solves that conundrum, and I think 4Q can be a reasonably good guide when the volume growth returns back, then I think we'll move out of this very tight range where, you know, like a action-packed week is then followed by a very mundane one.
Okay, all right. Hi, Jigar. Good afternoon. Good to see you in. Jigar, give one stock. One stock with due disclosures. Something new that you'll have got into or something that you'll had that you'll have topped up. All disclosures, regulators will be happy to hear as well.
No, Nigel. So frankly, all that I would want to, stocks is something we don't really discuss about. Themes, obviously, we can talk now. Themes, clearly, the one big theme getting into this was the fact that commodities became a very large sort of play for us in between. But we have substantially pruned down exposure there, sort of over the last month or so.
Commodities, so ferrous and non-ferrous, you'll have taken some money off the table, is what you're telling me.
Yes, substantially taken it over, lowered the exposure there.
The conglomerate, which is a tricky one, on that one as well, that worked very well. I recall you were telling us that you'll have exposure to this commodity play, which has exposure to a lot of commodities. That only can be Vedanta. Mr. Agarwal has done things in the past that sometimes give investors nightmares. But this time around, it's made plenty of money. So you'll have taken money off the table from there as well?
So see, essentially, continues to remain an anti-dollar play, right? But at the end of things, Nigel, the fact is that if you look at the price in which gold and silver sort of oscillated, that essentially is a very big move from a behavioral standpoint. Now, fundamentally, you can't put a number to what that fair value of a gold and silver is, right? Copper, you have a cost curve, you have demand supply. You have some fair value where, say, 70-80% of the production cost curve will make money, and you can create a long-term picture there. With precious metals, parabolic moves, make them less as a store of value, increases anxiety. So once that starts happening, you are finally feeding it into a belief system where, stocks start reflecting spot prices. And when that happens, that has traditionally been a source for us to reduce exposures there.
Okay, all right. By the way, the T20 World Cup is on, and it's quite interesting. South Africa and Afghanistan, they played out. They tied 187 each. You had a super over, and both of them scored 17 runs each. So now we're having another super over at play. Just thought we'll update our viewers on that front as well. Interesting times with regard to the T20 World Cup. Jigar, what about this India-US trade deal that's been announced? Any opportunity? Textiles has rallied, but they've come out drastically from the top. Now you have a bit of a worry with regard to what's going on in Bangladesh. They as well managed to get a deal going. Textiles, chemicals, auto ancillaries, some of them could be potential beneficiaries. Some theme you'll have picked out from this deal?
One big sort of theme, Nigel, is basically how that, as we discussed, how that stems the fall of rupee. Now, over the past, I would say a year, a little more than a year, rupee has depreciated against a depreciating dollar. So that is sort of very tricky situation for a country to be in. And if that stems, then I think that's a big win out of the situation. With regards to specific, we used to export like 2% of GDP, 1% of that was impacted. And therefore, from a GDP standpoint, it was not such a big deal really. But what it does to a few micro industries, textiles, gems and jewelry, carpets, it's a big deal for a few of those sectors. Our understanding of what happens with Bangladesh still is that eventually, they might have to get into the US sort of cotton and yarns for them to effectively get a lower import duty. But when you adjust it for the fact that the prices are a lot more expensive than India, plus there is logistics involved, the net benefit essentially is not that large. So we don't really own a lot of textiles or gems and jewelry or carpet, but I don't really see that big of a challenge for the Indian counterparts should somebody be holding.
Got it. Okay. All right. Thanks a lot, Jigar, for joining in and giving us your view. We look forward to chatting up with you rather soon. Well, the markets have taken a bit of a leg up actually in the last few minutes because the Nifty Bank has stood up and said, it's time to party. The Nifty has moved gradually up, but the Nifty Bank that was trading in the red, that's now moved to the high point of the day, and that will have to really lead the way from here on. Let's tell you what's going on in the F&O market. The PCR, that's holding at around 1, par for the course, one would say. Options data, 26,000 call, that's fairly active. That's a bit of a resistance zone, 26,050, 26,100. That's going to be the level that the bears want to defend. 26,100 is the level that the bears will come to fight. On the downside, though, the 25,900 put, that's seen a good amount of addition. And there is writing being seen on both those two strikes. So in the near term, since the 25,900 put, the premium was around 150 rupees just a few days ago. that 25,750 becomes important. That means 25,900 minus the 150 rupees you're getting for writing that particular strike. So that's why that's an important mark, and the 50 DMA as well comes in that vicinity. SBI came out with a very good set of numbers, but the stock already had ran up a little bit. Now today you're seeing genuine buying, both in the cash market as well as the F&O market. So fresh long addition being seen out there. Vodafone Idea, the stock is seeing a bit of a short covering bounce in trade today. The promoter entity coming in there and creeping in. The street likes that. PG Electro Plus, another stock that's seen a big correction from the top. But it seems to be getting its act together. At least that's what Mr. Gupta told us, that the PAT number should be around 300 crores and FY27 should be more promising. So a bit of a squeeze being seen out there. And Federal Bank, the street waited by to hear about that fundraise. That fundraise came about, and from there, the stock has actually given you close to around 20% return. Fresh buying being seen on that counter as well. For the time being, you go into that break, come back. Nimish is waiting for you on the other side. He'll tell you what's going on in dealing rooms. And we'll also get you some technical calls. Don't go anywhere.
माही भाई कोई कूल बैंक बताओ ना जो कस्टमर के साथ हर कंडीशन में हो।
फिर तो SBI कूलेस्ट है। हाँ? 50 डिग्री में, -40 डिग्री में, घने जंगलों में।
Chatter. Nimesh, what's up?
And as you know, another quiet day today, but the momentum in the broader markets continues. So again, a day when the mid small cap index is up another 1.5%. And in general, there is a momentum which is playing out in the broader market stocks. From a flow perspective, another day of positive flows is my sense. In fact, there is a small MOC basket as well at a FI desk. Two themes are emerging of late, Nigel. One, a strong reaction to earnings on either sides. And two, now that the earnings season is getting over, the block season is going to start, and you're going to hear a lot of blocks in the days to come. So that's clearly playing out and will emerge further as we go ahead. The only index which is under pressure today is the IT index on back of selling pressure. The index is down nearly 1.5%, and there is genuine selling in the IT names is my sense. So again, a day of consolidation on the Nifty, but the momentum in broader markets continue, and looks like there is a bit of chase now happening in the small and mid cap names.
IT index now was 1.5% lower, now 1.8% down. Just continues to grind down.
Nimesh, in terms of chatter, what are you picking up?
So the first name is Keynes Technologies. For second day running, that's buzzing in trade, up almost 10% in last 2 days. And I understand some large HN investors have bought after the clarification from the management. So that's the reason why it's been buzzing in the last couple of days. The second name is NetWeb. I spoke about in the last couple of days. I highlighted Bharti Airtel, highlighted Nuvama as well. I understand there's going to be a large block in NetWeb as well in the days to come. The promoter entity could be a potential seller in NetWeb, so watch out for that. The third name is Anupam Rasayan. Again, it's buzzing in trade today on large volumes. We were the first to highlight that they're going to acquire a company overseas. That's been done. Now the buzz is that maybe they're looking for a domestic acquisition as well. So that's the buzz as far as Anupam Rasayan is concerned. And the last is Stylum. While there is an open offer going on, but I understand a leading AIF is an active buyer in Stylum at current level. So that's the last name on my list today.
Yeah, no, absolutely. On Keynes, Nimesh, are you picking up? I mean, what's the numbers came? We had the management with us as well, right?
Yeah.
But anything, you said there's a active HNI who's buying, but reasons? Anything you're picking up?
So I guess suppose the call, there is a bit of comfort that in Q4 there would be some sort of comfort in terms of the working capital as well as in terms of orders as well. So I guess the management actually was part of some of the conferences as well. So they've met a lot of investors off late, and especially a couple of large HNIs have bought is my sense as far as Keynes Technology is concerned.
And NetWeb, Nimesh, it's another name, right? Which is this.
Yeah.
Next week, by the way, NetWeb will be in focus. The AI summit in Delhi, and NetWeb is one of those AI players in India. So, right, nicely timed. If that is even on the bankers' minds, but yeah, go on.
Looks like, Prashant. And see, again, as I said, now that the earnings season is over, the window is opening up for a lot of the promoters to come out and sell. That's the case going to be with Bharti as well. Singtel is a likely seller there, which the block can come any day. Highlighted Nuvama as well. Again, the private equity investor is likely to sell a large chunk there. I guess it's more to do with the fact that now that the earnings season is over, the cool-off period is done, which the promoters can come and sell some stakes. So that's the reason why you're hearing a lot of block deals of late, Bharti, whether it's NetWeb now, or for that matter, Nuvama as well.
Just one more last thing, Amish. On Anupam Rasayan, Rachna, our colleague, had reported that FMC India is on the FMC Global is a US company, and the India business is being sold, and the companies like Dhanuka, etc., are in the fray. I mean, the domestic acquisition by Anupam, I mean, is that the name? Are they also throwing in there or no?
I am not too sure whether they're throwing their hat for this particular company, but there is one domestic player which they've been eyeing for a while now. Looks like that could be around the corner, and they may announce something.
Listed, not listed?
It's listed entity.
Okay, all right. We'll leave it there.
Thanks.
If
you ask me anything more, maybe I'll mention the name as well. So let's leave it there.
Okay. All right, Nimesh, thanks very much for that. So that's Keynes, NetWeb, Anupam, Stylum, some of the names which Nimesh has got on his chatter list today. So keep an eye out on these names. Well, Mitesh is with us with what he wanted to do as far as trades go. Mitesh, good afternoon. What are the trades?
Yeah, good afternoon. So my sense is that I think, the market is slightly off the day's high, mild weakness, but the stock-specific action remains on the positive side. So we'll take BTST calls. LIC Housing Finance is BTST with a stop at 521. And would look for targets of around 535 here. And the other one is Keynes. That was a call, I think, yesterday or day before, I don't remember, but I think yesterday. and still doing very well. The chart is looking good. So we'll take a BTST here with the stop at 41.45 for targets of 41.95.
Okay, let's talk about Premier Energies. That's under pressure despite a bullish note coming in from Motilal Oswal. Vinny tells us, what's the overhang?
Hi, absolutely. So yes, in terms of the note that came in, it's a positive note. They've initiated coverage, target price of 1,000 rupees per share. They believe that this is going to be that solar scale-up that comes in for India story, and Premier will be one of those companies that will see, and growth with that is with the solar industry going in the country as well. Now, obviously, in terms of overall, what is the overhang numbers in Q3 also? They were not that good. There was a bit of pressure that came in. They were below estimates. The management, though, has reiterated that they're going to see a quarter-on-quarter improvement in terms of revenue. When they spoke to CNBC TV 18, they expect capacity addition, but maybe concerns and delays in terms of utility scale is still a bit of a overhang for the company in the near term. Long term, like Motilal Oswal has also highlighted that, given that module cell capacity for the company is increasing, the diversifying furthermore into allied verticals as well, whether it's BESS, inverters or transformers. So they expect all this could be positive for them, but the near-term overhang seems like that the concern on utility scale side due to transmission delays and tender slowdown in the near term is something that is a concern, and they spoke to CNBC about that as well.
Thank you very much for that. Mayuresh Joshi is now joining in for the last leg of the market. Mayuresh, watching the T20 game or the markets? I heard there is a cracker of a match taking place down to the last ball between Afghanistan and South Africa. 3 consecutives, yeah.
Oh, absolutely. In fact, the laptop is on one side and the television is on the other side. So I think, yes, can't miss T20. I think it's a stunner of a match as we are speaking.
Okay. Any stocks that caught your attention in today's trade? Lots of earnings reactions. What have you particularly liked?
So saying a lot of stocks are doing well today. So again, I think in terms of the earnings season itself, I think you have to pick sectors and leadership stocks which have probably done well and then probably delivered better than estimates. My own sense is that within the entire consumer staple space, Nestle India and V-Guard, I think these 2 stocks have given results which are far better than their peers and what the street was probably expecting as well. And the commentary going into Q4 has been equally strong. At the same time, I think a lot of banks, Rima, have given outstanding set of numbers, specifically the PSU banks. I think State Bank, the behemoth, even with a large base, is doing exceptionally well in today's trade. So in my opinion, again, I think select PSU banks have delivered outstanding set of numbers and valuations still remain reasonable and rating rankings for them look reasonably strong as well. As a space, I think budget, post-budget, I think data centers, and Prashant has been speaking a lot on that as well. I think that is very much in focus. And therefore, I think a couple of stocks which probably come onto our radar. We've probably not added that now, but still onto our radar. Cummins India is one of them. I think what Cummins is probably doing is the transmission norm changes which are happening in CPCP4. I think the transition changes are obviously going to benefit significantly. And they're deriving 40% of the revenues in terms of data centers itself, which can grow significantly higher with a nice run rate in terms of revenues, ROEs, ROCs, ROEs at 25, 26%, ROCs in excess of 30%. And therefore, I think data centers, within data centers, I think ancillary plays like Cummins are probably on my radar. So I think a lot of good numbers that have probably come through across a lot of sectors where leadership stocks are probably showing strength.
All right, one more stock in the AI space is Fractal Analytics. Last day today, and that's also one of the sponsors or partners of the India AI Impact Mission, which is taking place in Delhi next week. And last day, and I think the overall subscription is close to about 2.5 times, but retail HNI so far has been tepid. The push has come through from the QIB section, but we still have about 2 hours to go before we get the final thrust of numbers. Mayuresh, stay on. We need to slip into a very short break on that note. Still flat for the market. Nifty Bank is now up 140 points.
Fly Emirates, fly better.
Well, the markets are absolutely flat, actually. Even the Midcap Index as flat as can be in today's trading session. We're still in conversation with Mayuresh Joshi. Mayuresh, what do you make of Laurus Laboratories? That's a stock, in fact, that didn't do much for many, many quarters. The management kept guiding that the next quarter is going to be better. And the stock spent a good amount of time between 300 to around 500 rupees. But from there, it just looked north. It's a 1,000 rupee stock right now. One of those outperformers. What do you like from that space?
Afternoon, so I think both Laurus and DVs, I think specifically when you're speaking about Laurus, I think the kind of underperformance that transpired over the last few quarters, you're trying to see strength come back over the last 2 quarters. And obviously, I think management commentary and what it'll be guiding to in terms of better numbers in FY27, I think they probably look on the path to recovery. Obviously, I think as a space, this will continue doing well. Margins are relatively better. And as the CAPEX component for both Laurus and DVs, even DVs has a large component in terms of their CAPEX spend at the plant expansion that they're probably doing. A large part of that expectation is that the asset sweating and utilization should start being very, very reasonable in FY27. And with better realizations and better pricing, assuming to come through, I think the expectations in terms of better numbers as the management is guided for seems to be a base case scenario. So I think strong moves, anybody holding should continue with it.
Mayuresh, earlier in the day, we were talking about Poly Medicure, how it was a darling. It was a big play on Make in India for the medtech space. But the stock has run through troubled waters. There is dumping in their renal business from China. Growth has slowed down. Have you all analyzed the company? And is it turning around, or do you expect more pressure financially?
So, Riba, no, frankly, I think out of our coverage as we speak right now. So very difficult to make a comment.
Anything in the jewelry companies across the board, led by a strong increase in the gold prices? We've seen a 40% kind of a top line growth, whether it's Kalyan, PN, Gadgil, or even a Titan Industries. Do you like any?
So to begin with, I think the base case expectations itself are very muted, Rima. And again, I think the kind of numbers that have got thrown out, Kalyan, whether it's even Titan, I think the margin performance was reasonable at 10.4%. The started share at 26% for Titan. The expectations in terms of a very strong wedding season that is underway in Q4, I think that will probably play its part as well. Even for Kalyan, I think there has been a significant tectonic shift in terms of margin performance as well. And they're reverting back to the margins that they probably enjoyed a few years back. A clear shift is probably being seen in terms of regulatory compliance changes from the unorganized market to the organized players itself. And therefore, these organized players are probably enjoying what we are seeing at this juncture. Q4 obviously will be a tad bit better because of the wedding season. At this juncture, I think Titan is something that we are holding in our global portfolios. In our swing portfolios, Rima, Thangamite Jewelers is something that we continue.
The auto comps, right, is a I don't know if this is a theme or you want to call it, but just a few very large volume-led gains today. Lumax Industries, Lumax Tech, both are up sharply. Bellrise is up very sharply. Look at JK Tyre, which is going up big time. Rico Auto, and then there is Sansera, which is also up and about. So yeah, I mean, so all in the auto component kind of space. Any thoughts here? In this space, evaluation, and what do you like? What do you own? Mayuresh.
Prashant, with autos expected to do well in terms of volume growth, the OEM part of the auto ag business probably gears up in a far better position as we speak structurally over the next few quarters. What also abets them is the replacement market, where pricing and margins both are relatively better compared to the OEM space. And therefore, I think as a space, with the kind of product diversification that a lot of ancillary companies are doing, specifically towards EV agnostic products, I think they should start gaining both in terms of the ICE market as we speak right now, the hybrid market and the expected EV market as well. With not too much debt onto their books, I think a few of these companies might actually continue doing well. Our own sense is that tire makers, JK Tyres had a good set of numbers in my opinion. I think the kind of dynamics that JK probably has as we speak, commercial still account for a large bulk of their overall revenue or product mix. Replacement complements that as well with better margins. their capacities here and outside India, Latin America, Southeast Asia, with a strong dealer distribution network. I think that should have better earnings going forward as well. Lumax had a very good show as we speak in terms of a margin performance on 9 months. Compared to last year, where there has been a significant improvement in the margin profile. And that might very well continue, going by the management comments as I read through in the press release as well. Last but not the least, I think FIAM Industries is something that we are watching out for as well. Our own sense is that the kind of product mix that FIAM has and the expectations in terms of a marginal improvement in cash flows along with margins going forward, a lot of products being introduced.
Okay. Okay, all right. Thanks a lot for that, Mayuresh. Lumax, that stock went home with strong gains. LG Balkrishna, another stock that was up and about in today's trading session. From the broader markets, there were quite a few stocks actually that did quite well. Ashana Housing, another stock that reacted to its numbers. That stock was up and about. You had Man Industries, another stock that's corrected a goodish bit from the top. Rolex Rings, that stock in fact was up close to around 10% in trade today, as was the case with LG Balkrishna. I think PCBL has been making some positive comments on at some investor conferences, and that one in fact was higher in today's trading session as well. Sharp correction from the top. JG Chemicals, a smaller counter recycling play yet again, that as well has seen a good correction from the top. Today it was up and about. And Force Motors is feeling the force, now at 25,000 rupees stock. In this month itself, the stock is up close to around 16%, so big up move is what we're seeing out there. Net, it was a day of consolidation. The Nifty goes home more or less flattish. The Midcap Index goes home more or less flattish. The Nifty Bank raises its bat and says, at least I scored a century. That's sort of a day. Individual stocks did a jig of their own. But we'll wrap up on this edition of Closing Bell. You don't go anywhere. The team of Markets Forward comes up next.
Dalal Street ends flat in a range-bound session. Nifty holds on to 25,900. Banks outperformed the blue chips. Reliance and SBI remain the top Nifty contributors.
Eicher Motors revs up on healthy Q3 volumes, market share gains and strong margin improvement on better mix and price increases, while a mega 70,000 unit Indonesian order powers up Tata Motors. Eminem reports inline set of numbers.
Apollo Hospital injects optimism into healthcare stocks after a strong Q3 show on resolution of issues with insurers. And Mix, the healthcare major, adds that the discussions with the Delhi government on the JV Indraprastha Medical Care are on.
Hello and welcome to Markets Forward, your go-to show where we aim to get you all the key data points to gear up for the next trading day. I'm Sonal Bhutra. With me is my colleague Ekta Batra. Ekta, good afternoon. Quite a quiet day, you have to say, for the Nifty. It was absolutely flat by the time we ended the trading session. Bank Nifty did outperform, so that is something which was batting for the bulls. So that index was up around 0.2%. But other than that, it's the auto index that had a lot of action. We'll discuss that in greater detail, of course. PSU banking index made a recovery. So that is the one which was on our radar. Pharma index did well as well. But the Nifty IT decline, that continues. That was the top loser as far as sectoral moves are concerned. But all in all, you have to say some volatility, but then post that a very quiet end.
Hi, Sonal. Well, yes, absolutely. You know, it was an overall very quiet day for the markets today, just about range bound. There is resistance which is coming in at the 26,000 mark currently for the Nifty. So let's see whether we manage to break through that level. But overall, it was autos, it was banks which really contributed on the upside, along with stocks such as Reliance Industries as well, which went home with gains of around 0.7%. Let's see if the mid-caps managed to see some amount of traction. It was a little bit of a choppy session for them, but extremely range bound, you'd have to say. But let's tell you all of the big news and key developments on Dalal Street today. Top corporate voices is what we have lined up for you, as well as the events to track. Let's kick off the show with the day's market action. And in fact, let's tell you what we have. We have Sudarshan joining in to tell us about all of the movers and shakers in today's trading session. So let's go across to him.
So while market was largely flat after a range-bound session, but we did see some stock-specific actions. Eicher Motors top Nifty gainer, followed by Apollo Hospitals. So first talking about Eicher Motors, posted a strong set of earnings. Margin has come at a 5-quarter high of 25.5%. On the back of that, we have seen a big move. Stock has closed with a gain of more than 6%. Apollo Hospitals insurance has helped company to report a healthy set of volumes in Q3 FY26. Even outlook is looking positive as far as the commentary that we have got from the management, and that stock too has closed with a gain of almost 4%. SBI continues to see an up move, and for the consecutively, it remains the top contributor to Nifty along with Reliance. And today, today also that stock has seen a gain of more than 3%, and it's at a record high. BHEL, though, has underperformed, closed with a cut of almost 6%, and it's on the back of government's announcement of selling up to 5% stake via OFS. And for non-retail, OFS had opened today, and for retail, it will open tomorrow. And indicative price so far is around the floor price of rupees 254 per share. Bharat Forge was very active ahead of the earnings tomorrow. The stock has closed with a gain of almost 4%, and it's at a record high. Vodafone Idea has been moving higher, and it's on the back of the buying of shares by Kumar Mangalam Birla. Since January 13, he has bought almost 7.83 crore shares. And if you take a look at the average price, it comes in the range of 11 to 11.30 rupees per share. Torrent Power has moved lower. It had seen a big move yesterday ahead of the earnings. But when the earnings came, it has come out that one-offs had impacted or basically lifted the earnings. And because of that, the stock should be Torrent Power, not Torrent Pharma. And today that stock has closed with a cut of almost 4%. AB Capital and L&T Finance have seen profit booking after MSCI announcement, and both these stocks have been added in the MSCI Standard Index and will see inflows in the range of $240 to $250 million, and these changes would be effective 27th of February. And last one is Infosys Medical. You would have heard Apollo Hospital management and saying that company is in active discussion with Delhi government. Both Apollo Hospital and Delhi government hold 26% stake each. So we'll see if Apollo Hospital goes ahead and increase the stake in Infosys Medical. That stock too was buzzing in trade.
Take that point, Sudarshan. Thank you so much for joining in. Some interesting names there. Let's take this discussion forward. We are now joined by Mayuresh Joshi from Market Smith India. Mayuresh, thank you so much for joining in. Very quiet day for the markets, but did anything stand out for you, specifically if we talk about some of the stocks that Sudarshan also mentioned, any sectoral fundamentals that you wish to speak about?
Afternoon, Sonal. Now, again, I think selective autos and auto ancillaries did stand out in today's trade as well. Specifically, auto ancillaries, I think good set of numbers that probably came through. And a base case scenario that is now getting built in is that both OEM and the replacement market are firing on all cylinders as we speak. Input costs remain benign, and therefore volume and value-led growth will probably lead to top-line expansion over the next few quarters structurally. With input cost expected to stay benign, margins should be relatively better as well. And with better cash flows and better leverage management on a lot of auto balance sheets, that has played out well. Even for autos, I think Eicher's numbers were far better than expected. Eminem in line with estimates as we speak. But generally, auto angs as a sector stood out. PSU banks, and within that, State Bank of India continues its stellar run. The risk reward still probably looks reasonably placed for the entire universe as we speak. And there is some element of expectations in terms of banking reforms, which might positively act as an enabler and a catalyst for the sector as well.
Okay, yes, absolutely. Well, Mayuresh, we're just going to come back and ask you about the auto stocks in just a second. But let's in fact get Sudarshan to tell us about the entire auto space, which was buzzing in trade today. He's joining in with a wrap on all of the auto stocks that were in focus on account of numbers. Remember, stocks such as Eicher Motors hit a record high in today's trading session. Sudarshan, over to you.
So it's largely been a good day for majority of the auto companies which have reported earnings so far. So three major names, Mahindra & Mahindra, Eicher Motors and Ashok Leyland are in the focus on the back of the earnings of Q3 FY26. And all these companies either have reported earnings which are largely in line or say better than expectations. So we'll start with Mahindra & Mahindra. An Argo company has come out with Q3 FY26 earnings. Both the segments, auto and farm segment, have been seeing healthy volume growth. It was up 23% YY in Q3 FY26. That has helped company to report a double-digit revenue growth. On the consolidated basis, Mahindra Group has reported revenue of more than 50,000 crore for the first time ever. Now, on the standalone basis, profit was up 33%, revenue has increased by 26%, EBITDA too has seen a jump of 27%, and margin was in line with expectations and has come at 14.7%. Going forward in FY26, company is expecting tractor industry to see a growth in the range of 20 to 24%. Even SUV is going to see a healthy growth because the demand for the recently launched vehicles remains strong. Coming to the Eicher Motors top Nifty gainer, up more than 6%. On the volume front, company has been doing good, but on the margin front, there was a concern till Q2 FY26, but in Q3 FY26, margin too has come in at 25.5%. That's at a 5-quarter high, and after several quarters for Eicher Motors, EBITDA growth has outperformed both volume growth and revenue growth. And on the back of strong volumes for both Royal Enfield and commercial vehicle, revenue for the company has increased by 23%. EBITDA has seen a jump of 30%, and margin, as I told you, it has come at 25.5% versus 24.2%. And going forward in Q4 FY26, company is expecting strong demand to sustain, and even in FY27, motorcycle industry is expected to see a high single-digit growth. Coming to Ashok Leyland, it has come out with its earnings. CV volumes have been strong, and majority of the companies have been saying that the CV is in up cycle, and in Q3 FY26, Ashok Leyland has seen volume uptick of 24% YY. Even on a sequential basis, there was an increase of 17%. And despite a sharp increase in the raw material cost, company has reported an increase in the gross margin if you compare YY. But on the back of strong volumes, revenue has increased by 22%. EBITDA has seen a jump of 27%, and margin has come in at 13.3% versus 12.8%. Stock has seen a downtick after the earnings, but remember, after Q2 FY26, in the last 3 months, stock has seen an up move of more than 50%.
Okay, all right. Thank you so much, Sudarshan, for joining us with all those details. Mayuresh is back with us. Mayuresh, these names on the back of earnings, there have been auto wins as well. What do you make of the auto space? And do you think you would play the auto theme by auto anchs or plain auto stocks which have been buzzing of late?
Sonal, I think honestly it will be a mix of both, and we own a mix of both in our global portfolios and our local portfolios as well. Case in point, I think Eminem, very strong set of numbers. I think the management commentary is pointing out that both the auto side of the business in terms of expectations of new SUV launches over the next few quarters, amidst competition intensity and pricing pressures as well, might continue doing well. The farm equipment segment is expected to hold on with even better growth going forward, with a better Rabi season expected and a better Kharif season in the coming year as well. The two-wheelers specifically, I think Hero MotoCorp as an example, I think we are hearing in terms of how competition intensity will play its part. But both aspects in terms of its core portfolio as well as its EV offering through VIDA, I think that should probably do well. Tier 2, Tier 3 cities, as they come back very, very strongly, I think that should abet Hero's volumes going forward. And as I mentioned earlier in my remarks as well, auto anchs as a space should benefit from the OEM and the replacement ecosystem, both in terms of volumes as well as bottom line growth, specifically in terms of margin improvement going forward.
Okay, all right, Mayuresh, that was the auto space. But I was looking at the hospital space today. A lot of the healthcare stocks did well today. And that was on account of possibly Apollo Hospitals, coming out with a good set of numbers. So that aided sentiment. So we had the average revenue per patient, which was up around 11% for them. In terms of Apollo Health Co, it reported its lowest ever digital cash loss of around 29 odd crores. Now, triggers for the hospital space, they've reached an agreement with insurance companies after the disruption of cashless services. So Apollo Hospital says the insurance contracts have now been tied up for 2 years. So that should be a positive for companies such as Max as well as Apollo going forward. Separately, the CGHS revision was announced in October. So that should take place in terms of more formidable earnings accretion going forward in FY27. So, for example, Max says that it could add around 200 crores in terms of positive EBITDA. Other triggers, the budget has proposed a scheme to support states in establishing 5 regional medical hubs for medical tourism. So that too would be something that the street would watch out for in terms of additional contribution. CapEx, they remain steady on CapEx. So, for example, Max is adding 3,000 beds. We have Apollo Hospitals, which is adding around 4,400 beds going forward. But the stocks have come off compared to their 52-week highs. But in terms of valuations, analysts are quite positive that maybe there could be some amount of upside on these healthcare stocks as compared to their earlier highs. Mayuresh, would you agree that maybe there's some amount of upside in terms of these healthcare stocks?
Absolutely, Ekta. And I think all the 3 triggers will probably benefit them going forward as well. I think the medical tourism as an aspect, I think that is going to pick up steam over the next few years. I think it's still a minuscule part in terms of overall revenues as far as major organized hospital chains are concerned. But as it gains steam and the budget impetus that has probably been given, I think that can add a significant amount of revenue stream to hospital chains. The second element in terms of bed additions that they're probably doing, I think the calibrated capex that most hospital enterprises are probably going through is a step in the right direction, because what they're probably doing in terms of bed additions and the capex that they're doing for that, example, I think Apollo 4,500 beds being added at a capex of 8,200 odd crores over the next few years, will mean that the leverage component will not shoot up significantly as we speak. And it gets spread out as the capex gets spread out. The asset light model in terms of carrying out managed hospitals or managed beds in Tier 2, Tier 3 cities also works in their favor. Obviously, the CGHS guidelines will aid and abet the overall revenue growth as well. So yeah, I think as a space, it should continue doing well.
Okay, in fact, we did talk to the Apollo Hospitals management earlier in the morning. So listen in to what Sunita Reddy had to tell us.
So there was an extra 8% volume increase from insurance with a 20% revenue increase. So this will continue, and with this, we should be able to get higher occupancy metrics. Insurance enabling patients to enter the Apollo system for robotics, for transplants, improvement in cardiac work by 20%, onco work by 18%, orthopedic 17%, and gastro 17%. This has all led to a higher ARPP.
All right, that's the word coming in from Apollo Hospital. So we've discussed a few of the top gainers on the Nifty, Nifty Auto, Nifty Pharma. Let's come back to Nifty Realty. Mayuresh, 0.6% higher on that index today. It is now down around 18% from the 52-week high levels. Last week we were talking about it being off around 30%. So there's definitely been some recovery. What's the indication now? Do you think they are at reasonable valuations, or there could be further derating of these names, considering that demand, of course, is not bad across the board, but it could see slower growth going forward?
Well, you're absolutely right, Sonal. And I think that's what is probably the pain point for most realty stocks. And therefore, you need to probably have a very stock-specific approach for the sector as a whole. I think three aspects. One, I think in terms of demand dynamics, inventory levels are inching up as we speak across metro cities, whether you take Delhi, Pune, Chennai, Bangalore. And to that extent, I think how these levels will play out in the next few months and quarters is something to be watched out for. The second element is that in terms of pre-sales, the new launches have been very, very selective by key players as well. And that is an indication in terms of both the mood and the sentiments as far as the real estate market is concerned. Now, with lesser pre-sales launches that are expected to take place, I think the analyst expectations in terms of pre-sales velocity and what to peg in terms of numbers going forward as a collection estimate for the entire year, I think that still seems to be a little bit of a circumspect angle as we speak. And third, I think leverage has been relatively stable and constrained. But for any reason whatsoever, I think if the leverage component suddenly starts going off or the cash flow suddenly become a little bit volatile, I think the valuations then probably might look a little bit more dearer as we speak. So very, very stock specific. I think Phoenix, Godrej Properties is something where, in our opinion, the rating rankings at Markets of India still look relatively stronger.
Okay, all right. Mayuresh, one stock which was in focus was BHEL on account of the UFS news. Just give us a sense in terms of what you think of that stock at current prices.
No, so obviously, I think UFS news has dragged the stock lower as we speak. But two major themes for BHEL in the power sector as a whole. I think what will probably happen in terms of the massive outlay that is expected to happen in terms of renewables over the next few years. We stand at 500 gigawatts with a mix of thermal and renewables. Renewables itself expected to be 500 gigawatts by the end of 2032. So I think a huge component of government capex is going to go behind the entire power ecosystem, and BHEL will be one of the major contributors there as well. The second element in terms of their own balance sheet, a large part of their slow-moving orders have either been written off or have probably been recognized in the balance sheet. And therefore, I think any new orders that come through are and will be at relatively better margins. Now, if BHEL executes well going forward and it keeps its working capital cycle in check, I think the kind of moves that we probably see, the momentum can probably come back very, very strongly in FY27.
Okay, all right. So that's about BHEL, and of course we keep getting the live updates in terms of subscription as well. So that is something to take note of as well. Tomorrow it will be open for other part of shareholders for BHEL. Generally, what's your take on PSU banks, Mayuresh? Because that was one big mover yesterday. Today it did recover from the lows of the day, and we were having a lot of conversations with Nuvama. They have been speaking with FPIs at their summit that they have. The indication was that they're still very bullish on banking because of various updates that have come by, plus the fact that valuations are still reasonable.
Absolutely, and both the things are working in favor of PSU Bank Sonal as a space. I think if you probably look at numbers across the pack, you start right from State Bank of India, right to the bottom of the pyramid. Leave aside a few players. I think Canara Bank probably disappointed within the mid-cap PSU names, but a large chunk of the players have probably delivered better numbers in asset quality, in terms of the CASA deterioration largely being behind them, in terms of NIMs probably being far more stable and improving going forward as well. Last but not the least, I think capital adequacy remaining extremely strong, whether it's the mid-tier names or the larger ones as well. And therefore, as a space, along with the valuation aspect compared to the larger private or the mid-private sector banks, they still look reasonably placed. The rating rankings look exceptionally strong for the space as a whole. And therefore, I think numbers have done the kind of re-rating that one looks at. If they keep on delivering these numbers going forward as well, specifically in terms of deposit growth, which is going to be a very sticky aspect for the sector as a whole, where PSU banks might actually stand out. I think they might actually outperform the BFSI space as well. Obviously, one thing to look out for, Sonal, is the banking sector reforms and what comes out of it.
Okay, absolutely. A trigger which definitely the banking stocks will watch out for, which is in terms of the reforms. Thanks, Mayuresh, for joining in and giving us all of those stocks that you are tracking today. We're going to take a short break, but we'll get you all of the top corporate voices along with key market events to watch out for just in a short bit. Stay tuned. Welcome back. You're still tuned into Markets Forward on CNBC TV 18. Time to take stock of all of the big corporate voices of the day. Titan came out with a strong set in the third quarter. Speaking to CNBC TV 18, the company's CFO, Ashok Santalia, said that gold prices saw a temporary correction in January, during which the company witnessed strong demand for studded jewelry and now expects to close Q4 on a strong note. Santalia added, while the studded ratios has come down due to rising gold prices, the number of buyers for studded jewelry continues to rise. He also said that rising gold prices were putting pressure on margins, including the diamond jewelry segment, prompting the company to focus on lightweight designs.
SAMIL's whole-time director and president Pankaj Mittal told CNBC TV 18 that the company reported its highest ever quarterly revenue in quarter 3, driven by strong performance in emerging businesses. He said the recently acquired integrated assembly segment is also seeing healthy growth and contributing meaningfully to revenue. He further said that margin improvements are structural and expected to sustain, with modules and polymer margins at 9.7% and integrated assemblies at 15.2%.
Jain Resources reported a strong Q3 performance, with management indicating that growth momentum is expected to continue. Copper capacity utilization currently stands at around 60%, but is projected to improve going forward. The company is also planning to add more copper capacity and expects better margins from its new copper product lines. Management has guided for revenue growth of 40 to 50% by FY27.
And Gravita India's top brass told CNBC TV 18 that its 1,200 to 1,300 crore rupee planned capex would increase capacity to around 7 lakh tons by FY29. The company added that it would require an additional 1,000 crore rupees for working capital. The entire funding would come from internal accruals, with no additional debt being taken on. The company is on track to achieve 35% bottom line growth target by FY29 and a possible EBITDA of 1,000 crore rupees.
All right, and before we wrap, we'll bring you some key market events to watch out for. Sudarshan is here to tell us what to look out for tomorrow. Sudarshan, over to you.
So we are expecting some major data from US market. Non-farm payrolls, unemployment rate and crude oil inventories are going to be released today evening. And BHEL stock is going to be in the focus again tomorrow, because OFS for the retail portion opens tomorrow and government is looking to sell stake up to 5%. Base size was 3%, and if government decides to exercise the green shoe option, it will sell another 2%. And as we are getting to the end of the earnings season of Q3 FY26, some of the major companies will be reporting its earnings tomorrow, and those companies are Bharat Forge, Biocon, Coal India, HCL, Hindalco, HUL, Indian Hotels, IRCTC, Muthoot Finance, ONGC, Petronet LNG and PI Industries.
Okay, all right. So we still have some earnings to cater to. Thank you so much for joining us, Sudarshan, with all those names. So with that, it's a wrap on this edition of Markets Forward. We'll be back with more news and updates on the other side.
Good evening. Thanks very much for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. Range-bound session on Dalal Street. The Nifty holds 25,900. The Sensex underperforms. IT stocks under pressure. Auto stocks provide some solace to the Nifty benchmark index. The White House revises its fact sheet on the proposed India-US trade deal within 24 hours, drops pulses from the list of US products on which tariffs would be reduced, changes the $500 billion purchase commitment to an intent to buy. The portion claiming that India has agreed to scrap digital services taxes has been removed as well. Eminem reports a steady quarter. Auto and farm business volumes grow by 27% on a yearly basis. The group's consolidated revenue crosses the 50,000 crore rupee milestone for the first time. BHEL shares nosedive on a day one of its offer for sale. The government aims to raise close to 4,500 crore rupees by divesting up to 5% equity in the PSU. This includes a 2% green true option. The floor price for the OFS has been set at 8% discount to yesterday's closing price. The government clarifies on its new IT rules that make prominent labeling of AI-generated content mandatory, announces a 3-hour compliance window for government takedown orders and 2-hour deadline for removal of nude images. Also highlights that routine editing of photos PDF using AI need not be flagged as AI-generated. Higher pilot-to-aircraft ratio and a higher crew buffer enables Indigo to comply with the new crew rostering norms after a 2-month leeway. The airline on an average now has 7 pilot officer pairing per aircraft versus 6 earlier. Sources tell us that Indigo's pilot utilization and not headcount was the core issue behind the major disruption faced in December. Trump issues a fresh threat to Iran, warns them of aggressive actions if the country fails to reach a deal on an issue ranging from nuclear enrichment to ballistic missiles. Reports say Trump plans to send a second aircraft carrier to the Middle East. Lok Sabha leader of the opposition Rahul Gandhi accuses Prime Minister Modi of selling the nation over the India-US trade deal. Parliamentary Affairs Minister Rijiju rejects charges, hails Modi as the strongest Prime Minister, vows to file a privilege motion against Gandhi unless he authenticates the charges made inside the Lok Sabha by the evening. Paramount Skydown sweetens its offer for Warner Brothers Discovery amidst repeated attempts at a hostile takeover. Offers shareholders a quarterly ticking fee of 25% per share, but keeps its headline bid unchanged at $30 a share. 9 dead, dozens hurt after an assailant opens fire at a school in Western Canada, making it one of the deadliest shootings in the country's history. The suspect was found dead from a self-inflicted injury. Well, let's start with the day's market action. The Wall Street ending the day flat after a volatile session, with the Nifty ending above the 25,950 mark. Auto stocks led the race today, while IT stocks continue to be under pressure. Just about in the green, that's the Nifty for you. The Sensex closing 40 points lower, 118 points higher there on the Nifty Bank, and the Nifty Midcap Index also closing just about in positive territory. Prashant is standing by to wrap up the day's market action for us. Fairly choppy, fairly volatile off its intraday lows, but finally closing flat, Prashant.
A quieter day after 2 days of very, very decent moves. So Monday, of course, was big. Yesterday, was up. The market was up. But as we pointed out, right at the word go, the close right at the open, usually it's in technical terms, it's called a doji. The open and the close are the same and indicate some sort of wariness, exhaustion, whatever you want to call it. And I think today we followed through in that same kind of fashion. So 20 points. Higher, 25,950 or so is where we ended. Mid-cap and small-cap indices absolutely flat, nothing very much. The IT index, of course, came under some more selling pressure. It's not as if after the earlier episode of severe selling, which was last week, they had any large bump up or gains. It just sort of, sell-off, consolidation, and then, another leg down. And that's what we saw. And you look at the large stocks which were off on the Nifty, TCS, Infosys, HCLTech, all down. There's also Coal India, Eternal, which saw some profit booking. ITC's done well recently from the lows. That also gave up gains. On the upside, Eicher Motors was the big one. Apollo was the other one. So both earnings reactions. Apollo, of course, the management was with us. SBI followed through with another 3.5% gains. Superb numbers, of course, earlier. And there was Max Healthcare, which has been seeing a bit of profit booking, and that came back up.
All right, Prashant, many thanks. Now, the White House has revised its fact sheet on the proposed India-US trade deal. All of this within the last 24 hours. Now, the word pulses has been dropped from the list of US products on which tariffs would be reduced in the overnight revision. It has been replaced with the phrase, and I quote, a wide range of US food and agricultural products. In the updated document, the phrase about India's commitment to buy $500 billion of American products has also been changed to, and I quote, an intent to buy. The portion in the earlier fact sheet claimed that India has agreed to scrap digital services taxes. That has been removed as well. So that's the latest there on the US-India trade deal. US Trade Representative Jameson Greer has said that India could be a potential way station for US supply chains. In an interview with Fox News, Greer said that India was a viable option for companies seeking to diversify away from China. He also said that India had started winding down purchases of Russian energy products and ramping up purchases of American energy. Commerce Minister Piyush Goyal is likely to meet exporters and industry associations later this evening. Industry sources say the meeting will be aimed at discussing the contours of both the trade deal signed with the US and the EU. We'll, of course, be tracking that. On to earnings now. Eminem's Q3 numbers in line with estimates. Net profit up 33%. Revenue rose 26% on an annual basis. Darshan is standing by to take us through the fine print. Eminem details, Sud?
With Mahindra & Mahindra, an Argo company has come out with Q3 FY26 earnings. Both the segments, auto and farm segment, have been seeing healthy volume growth. It was up 23% YOY in Q3 FY26. That has helped company to report a double-digit revenue growth. On the consolidated basis, Mahindra Group has reported revenue of more than 50,000 crore for the first time ever. Now, on the standalone basis, profit was up 33%. Revenue has increased by 26%. EBITDA too has seen a jump of 27%. And margin was in line with expectations and has come at 14.7%. Going forward in FY26, companies expecting tractor industry to see a growth in the range of 20 to 24%. Even SUV is going to see a healthy growth because the demand for the recently launched vehicles remains strong.
Sid, many thanks. Shares of EV maker Eicher Energy declined in trade after nearly 33 lakh shares worth 233 crore rupees changed hands via block deal. Sources say the National Investment Infra Fund, the NIIF, was likely to sell up to 1.9% stake in the company. The stock closing almost 2% lower. Shares of BEHL tanking nearly 6% in trade. This after the government launched an offer for sale to divest up to 5% stake in the company. Under the OFS, the government will sell 3% stake initially with an option to offload an additional 2% stake in case of oversubscription. The floor price has been fixed at 254 rupees a share. Indian artificial intelligence firm Fractal Analytics' 2,800 crore rupee IPO was oversubscribed on the final day of bidding. This was led by robust demand from qualified institutional buyers section, followed by non-institutional investors. That's the Fractal IPO for you. Chinese automaker BYD has sped ahead of Ford Motors in global sales last year. This for the first time ever. Ford sold nearly 200,000 fewer cars than BYD as its sales fell 2%. With this, the Chinese auto company is now at the number 6 spot in the global sales rank. While Ford's US sales increased last year, the company lost ground in Europe and China, a significant milestone there for BYD. Higher pilot-to-aircraft ratio and a higher crew buffer enables Indigo to comply with the new crew rostering norms after a 2-month leeway. Sources tell CNBC TV 18 that Indigo's pilot utilization and not headcount was the core issue behind the major disruptions that it faced in December. Shivani joins us now with the details. Shivani, what are the changes that Indigo has made that has allowed it now to comply with the new flight duty timing norms?
Well, yes, Indigo is back in full compliance with the flight duty time limitation norms. And the question today is, what has changed since December when they were exempted from these norms? Sources tell CNBC TV 18 that the airline has actually raised crew deployment to 7.2 crew sets per aircraft in February. This is up sharply from under 6 per aircraft in November, December. One crew set, remind you, is one captain and one first officer, so 2 pilots. At 7.2 sets across 350 active aircraft, Indigo needs over 5,000 pilots to operate compliantly. Government data as of December 8th shows that the airline already has 5,000 plus pilots, which is 5,085 pilots on its roll already. So the pilots were always there. Headcount was not a problem. Utilization was. When the DGCA tightened night duty and rest norms in November, effective availability dropped. Indigo was operating at under 6 crew sets per aircraft, leaving almost no buffer in the system. Zero cushion whatsoever. So when duty hour caps were hit or sick leaves rose or weather disrupted schedules, cancellation snowballed and cascaded effects that we saw in December. Now, aviation experts say that resilient operations require 7 to 8 crew sets per aircraft. So by moving from under 6 to 7.2, Indigo has finally built back the operational breathing room. So it looks like Indigo is back on the FDTL track as of now.
All right, Shivani, many thanks for joining us. Up next, the government clarifies on its new IT rules that make prominent labeling of AI-generated content mandatory. That and more when we return. Now, the government has issued a clarification on its new digital content rules that make prominent labeling of AI, that's artificial intelligence generated content, compulsory. The government has highlighted that routine editing of photos, PDF using AI need not be flagged as AI generated. Ashmit joins us now with more details. Ashmit, take us through what the government is saying in its FAQ on the use of digital content.
Well, the government expanding on the scope of the notified rules that were put out yesterday and clarifying as to how and when these rules can be implemented. Firstly, as far as synthetic media or AI-generated content, the government defines it as per the FAQs by saying media that is defined that can appear like a real person or a real event that can possibly deceive a person into believing that it is real. That is something that will then qualify as AI-generated or synthetic content. But having said that, what is not on the government's radar are routine edits that you and I may make while clicking a photo, adding a filter to that photo, using AI for editing of PPTs, or for editing PDFs. That is permissible, that can continue. No reason for concern there. However, the focus area for the government will be AI-generated content, especially illegal content. So what qualifies as illegal? Well, child pornography, obscene content, vulgar content. We'd seen only a few days back, Grok had been generating sexually inappropriate images. Images like those, content like that is something that the government is keen on targeting by way of these latest regulations. Not just that, the AI companies are also required to prominently label all content that is being generated via their platforms. It should have a very prominent label displaying that this content is synthetically generated or generated using AI tools. But that's not all. The rules also require social media companies to shoulder a part of that responsibility. The social media companies on their part will also have to verify whether content that is being uploaded by users is AI generated, and if it is suitably labeled as well. That responsibility will rest on the shoulders of social media companies. But having said that, there's more to it. The rules also prescribe for a tighter timeline that social media companies will have to work with. In case of nude images, that has to be taken down within 2 hours. Earlier, the deadline was 24 hours. In case of government takedown orders, that has to be actioned within a 3-hour time frame. Earlier, the time window that had been allowed to social media companies was 36 hours. So clearly a tightening of the time frame as well with respect to AI-generated or synthetic content.
All right, Ashmit, many thanks for joining us. The standoff in Parliament continues. Lok Sabha leader of the opposition, Rahul Gandhi, accusing Prime Minister Modi of, and I quote, selling the nation over the India-US trade deal. Speaking in the Lok Sabha today, he claimed India's strategic autonomy is under pressure and that key decisions on energy and economic policy are being influenced by global power dynamics. Parliamentary Affairs Minister Rijiju rejected Gandhi's charges, hailing Prime Minister Modi as India's strongest Prime Minister. Speaking at a press conference later, he vowed to file a privilege motion against Rahul Gandhi unless he authenticates the charges made inside the Lok Sabha by the evening.
You have sold India. Are you not ashamed of selling India? Yes. Do you have no shame of selling India? You have sold our mother, Bharat Mata. Do you have no shame? But sir, the interesting thing is, I know that the Prime Minister would not sell India under normal circumstances. He will not do it. You know why he sold India? Because they are choking him.
Mr. Rahul, address to the chair, please.
He has sold India because they are choking him. They've got a grip on his neck.
आज तक कोई माई के लाल पैदा नहीं हुआ जो भारत को सेल कर सकता है, कोई खरीद सकता है, नहीं हो सकता है। और आपने प्रधानमंत्री जी को कहा, मैं दावे के साथ कहता हूं, इस देश का आज तक सबसे मजबूत प्रधानमंत्री नरेंद्र मोदी जी है।
Well, fireworks in Parliament. President Trump has issued a warning to Iran again. Trump hinting at aggressive action if Iran does not adhere to the US's demands. Speaking to a news channel, Trump said, and I quote, either we reach a deal or we will have to do something very tough, end of quote. This comes after the Trump administration sent a large fleet of warships towards Iran. Reports say that Trump also plans to send a second aircraft carrier to the Middle East.
As you know, we have a massive flotilla right now going over to Iran. We'll see what happens. I think they want to make a deal. I think they'd be foolish if they didn't. We took out their nuclear power last time, and we'll have to see if we take out more this time. They want to make a deal. They wouldn't talk to anybody else, but they're talking to me. But, you know, it's a good question. A lot of people say no. And I would say that I'd rather make a deal. It's got to be a good deal. No nuclear weapons, no missiles, no this, no that, all the different things that you want. But some people worry that they've been very dishonest with us over the years, right?
Now, Paramount Skydance has sweetened its offer for Warner Brothers Discovery amidst repeated attempts at a hostile takeover. It has offered shareholders a quarterly ticking fee of 25 cents a share. Paramount has also said it will fund the $2.8 billion termination fee that Warner Brothers would owe Netflix if the deal falls through. However, Paramount has kept its headline bid unchanged at $30 a share. 9 dead, dozens hurt after an assailant opened fire at a school in Western Canada, making it one of the deadliest shootings in the country's history. The suspect was found dead from a self-inflicted injury. As New Delhi prepares to host the India AI Impact Summit 2026, hotel room prices in the national capital are going through the roof. In some cases, staying in the city to attend the entire 4-day event could cost upwards of 1 crore rupees, and that's just for accommodation. Timsy Jaipuria reports that this unprecedented surge in hotel tariffs has prompted the Tourism Ministry to step in.
New Delhi is gearing up to play host to between 15 and 20 global leaders, over 50 ministers, representatives from 40-plus companies, and nearly 500 leaders from the global AI ecosystem, along with their entourage when they fly in for the India AI Impact Summit 2026. The week-long summit, scheduled from 16th to 20th February at Bharat Mandapam, is expected to be the largest of its kind so far and has reportedly received over 35,000 registrations spanning more than 100 countries. So it comes as no surprise that this has sent hotel prices across New Delhi through the roof. Screenshots from hotel websites and popular booking platforms show that rooms which typically cost around 20,000 per night in March are now being offered at over 1 lakh rupees per night. In addition, availability is restricted to just a day or two in many properties. At some of Delhi's top 5-star hotels, prices have climbed to extreme levels. For the summit period, top-end luxury categories are being quoted as high as 32 lakh rupees per night, while mid-tier premium rooms are priced at 19 lakh per night or more. On online booking apps, even the starting price for available hotels is hovering between 20,000 and 40,000 rupees per night, far above normal seasonal rates. Peak demand is especially visible on February 19th and 20th, when several 5-star hotels are sold out. Luxury suites and club rooms are priced even higher, often with strict minimum stay conditions. Marquee properties like the Leela Palace, ITC Maurya and Taj Palace have all raised tariffs significantly for the summit window. Hotels in central Delhi are seeing a similar spike in demand and in tariffs. Properties like the Imperial, Shangri-La Eros are nearly sold out between February 18 and 20th, with the handful of rooms still available are listed at steep prices. Travel platform Make My Trip, for instance, shows a room at the Imperial in Connaught Place priced at over 2.4 lakh rupees per night on February 17th. A room at the Radisson Blu, meanwhile, is listed at around 1.1 lakh rupees for that date. Taking cognizance of the surge, Tourism Ministry sources tell CNBC TV 18 that the government is holding a series of meetings with hotel associations. The concerns go beyond pricing. Officials are also worried about service quality, security arrangements, and manpower readiness to host thousands of global delegates. Hotels we reached out to regarding these meetings have declined to comment. However, sources say that for the government, this spike in prices is a cause of concern. While Delhi wants the global spotlight, it feels the need to balance demand with affordability and service standards, because hospitality costs should not threaten to overshadow India's ambition to lead the global AI conversation. In New Delhi, Timsy Jaipuria.
Well, the Home Ministry has directed that all 6 stanzas of the Indian national song Vande Mataram be sung first when the national song and national anthem are played together at government events, government school programs and other formal gatherings. The 10-page order issued to all states and union territories on the 28th of January included the official version of the song. This version includes the 4 stanzas that were not included in the song adopted by the Constituent Assembly. With that, it is time for us to wrap up this edition of Business 360. The news will continue on CNBC TV 18. Stay tuned. We're back with more right after this.
Let's talk money.
Hello and welcome to another edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Gold and silver. These metals have been in the headlines for the past many months, in fact, for perhaps the past 1 year. But what's really interesting is the way Indian investors have taken to investing in gold and silver via the ETF route, exchange-traded funds. Now, exchange-traded funds and commodities are nothing new in the Indian landscape. One of India's mutual fund houses, Nippon MF, set up, in fact, a gold fund as way back as about 18, 19 years ago. So this is not a new instrument, but what indeed is absolutely startling is the kind of money that's now pouring in these precious metal ETFs. In the month of January, by the way, gold and silver ETFs combined pulled together 33,000 crore rupees. That's more than the money that investors put in all equity funds put together in the month of January. So that's the kind of market we're in. The question is, should you be chasing returns? Should you be waiting for dips? And whenever you want to diversify and add some precious metals to the portfolio, do ETFs make the cut? Are they indeed the best option? Well, we'll be talking about all of this, debating and discussing some of these trends and points. And I have with me Mr. Vikram Dhawan, who is a fund manager and head of commodities at Nippon India Mutual Fund, and Nasir Salim, managing director at Flexi Capital. Gentlemen, thank you so much for joining in. And Vikram, thank you very much for being with us and taking this head on. Because, like I said, Nippon in some sense defined the category well ahead of everybody else in the market. So I'm glad you're here because I'm sure some big tough questions are coming your way looking at the inflows that are going into those ETFs. So let's get your opening thoughts first.
Well, thank you very much for inviting me on your show. Well, while we are very flattered on the kind of development which has happened in this space, but just to share a few data point that out of the $4-5 trillion holdings of Indian household gold, we are just not even $4 billion. Even in the AUM of mutual funds, we are barely 3%, 4%. So I think it is still very early days as far as the gold ETFs and silver ETFs are concerned.
That's an interesting point you make, Vikram, because yes, Indians have always invested in gold, but investing in gold through a financial channel, that's a more recent trend, right? The thing is that I think as the price appreciates and because equities underperformed, it seems to be accelerating that trend. Do you agree?
I think what has happened is that, since we are a very, important developing economy in the world, and there's been a lot of focus on the risk assets like equities, both overseas and in the Indian market. And the concept of asset allocation still is fairly niche in India. I mean, just to give you an example, the AUM of, the multi-asset funds will be like 2 to 3% roughly of the total AUM. But if you go and see the similar AUMs, let's say in Europe or America or developed market, it is many times of that. I mean, in certain market, the asset allocation funds account for roughly 10 to 15 or even 30% of these strategies. So I think this is the what you can say the dawn of asset allocation, where people have realized that to generate wealth on a long-term basis, you should not put all your eggs in one basket. So I think that's where gold ETFs and silver ETFs are gaining traction.
Absolutely, and the price kind of displayed how true that thought process is, right? Because in 2025, it was all about these precious metals when equities were struggling, especially here in India. Let me bring in Nasir into the conversation as well. Nasir, I was looking at some data which was put out by the World Gold Association. We'll get those graphics up for your, for our viewers on the screen as well. It's staggering. Gold made 53 new all-time highs in 2025. So there were 53 days out of 365 days where gold was constantly touching a fresh all-time high. And I think these headlines were enough to draw investors in. What have you made of this big gold rush?
Well, clearly, firstly, thank you very much, Subhi, for having me on your show again. Great to be back. But to your question, I think, my simple answer is FOMO, right? There is a lot of fear of missing out that we've seen in terms of participation. Look, from the asset allocation perspective, Surabhi, there is no doubt, and I agree with Vikram, that, there is an asset allocation discussion today when we sit with clients. It's a clear discussion of saying you should have 10 to 15% allocation in commodities, for example. And within that space, obviously, you get in commodity ETFs. There is, gold, for example, which is now being allocated. And I think that is something which is eminent and has always been the core, right? It's also a natural hedge against inflation. And also a lot of Indians, I must tell you, cannot participate in dollar return assets. as conveniently as possible. Of course, there are many avenues opening up, and therefore gold comes in. So I think a lot of the appetite today you see is also on account of this sudden demand. Obviously, it is also being followed up by central bank purchases, and that continues to make these new highs. But of late, what we've seen is that the asset allocation model is going for a toss. And as people like us, as experts, we try to tell our clients that we can't be chasing FOMO because of these sudden hikes that we see. As you rightly said, multiple hikes in the last 365 days. Also boards a little bit of caution. But the case is obviously that when anything goes up euphorically, it attracts a lot of attention and obviously leads in with FOMO appetite.
Oh, absolutely. So, gentlemen, before we talk about the way to invest and if this is the right time, do you wait for dips, etc., and which is the right instrument? Before we get into that, Vikram, since you track the commodity itself, the underlying commodities, 25 has been a stunning year in my memory as well, recent memory. Copper was going up. I mean, there was demand for aluminum and, of course, gold. And then silver caught on. And silver completely eclipsed the gold rally. Now, people are rushing in. And January data, Amphi data tells us that people are following the headlines and they're coming in. But just purely as someone who understands commodity cycles, would that be a bad strategy if you come in now and suddenly decide, oh, I need more gold, I need silver in my portfolio? Not necessarily as an informed asset allocation call, but more simple return chasing.
See, we'll be leaving at least two problems for the next generation. One is the climate and second is the debt. If you look at the debt load in the world today, the global debt is about $360 trillion, out of which the sovereign debt itself is more than $100 trillion, which used to be about $20-30 trillion 25 years back. So we are adding anywhere between $4 to $5 trillion in sovereign debt every year. And there is no political will to either counter climate or higher debt. Now, gold is a straightaway hedge against debt, overload. Why? Because gold is one of the very few asset classes which doesn't have a credit risk. So it is basically an antidote to high debt loads. Silver, since 2024-25, one of the hottest years on record, and I think if you're traveling across the world, you'll see the summers are getting a lot hotter across the globe. So there, I think, again, there's no political will globally to address that, which means that how do you hedge yourself against some sort of a climate challenge or a crisis, which may not happen. I mean, a debt crisis or a climate crisis is not going to happen next Monday or even next year also. It is something which we'll be leaving for the next generation. So how silver fits in? The more the climate challenges rise, the more you will have to invest into renewables. And silver is a proxy for the green tech. So I think for people looking for building portfolios for generational wealth, it is absolutely a straightforward, asset allocation. But for somebody who's looking at horizons of three weeks or 3 months, I would say if you're looking towards gold and silver from tactical point of view, I'm pretty sure there are other, shows in town that you would like to vis-a-vis gold and silver.
That's a really important statement coming from someone who's understanding commodity markets for years, who's been sort of tracking these trends. So right now, I take your point that at a long-term fundamental, level, there is a strong case for gold. There's even a case for silver. But right now, is the market overheated? Right now, is there still a lot of froth in the international and in the Indian market?
So I think, from the asset allocation point of view, again, we don't treat it as standalone security. It is part of the multi-asset, investment strategy, if you would like to call that. So from an asset allocation point of view, it's never a bad time or a good time to put gold and silver. What's more important is discipline.
Okay. All right. Fair enough. So we've understood the basics of how to invest in these commodities. They're not for the faint-hearted and maybe not for someone who's looking at a quick trade in and out. With that important lesson under our belt, let's take a break. On the other side, we talk about ETFs. Are exchange-traded funds perhaps the best way of investing in precious metals? The debate continues after a break.
Let's talk money. Let's talk money.
Welcome back. You're with us on Let's Talk Money. And this week, we're talking about the huge surge in inflows in gold and silver ETFs. Indians are making a beeline for these products. Is this the right strategy? What are the do's and don'ts you must keep in mind? That's what we are discussing on the show. Nasser, I want to come to you now. We all know that ETFs are a very cost-efficient product, right? Whether it's commodity ETFs, equity, any form of ETFs. But, ETFs also came in the news for the huge premium and sometimes a discount. Extreme volatility in the prices, particularly some of these commodity ETFs in the last few months. What did you make of that and how do we wrap our head around it?
Very good question, Surbhi. I think in the early of 2026 also, I must tell you, many silver ETFs in India experienced steep intraday declines. In some cases, actually down up to almost 21% as bullion prices corrected from record highs. I think gold ETFs also saw some significant declines, with many sliding in the single digit to low digit, double digit percentage, close to around 7%. I think these moves were driven, by global market forces. And I think ETFs, by and large, are sold on the stock exchange, right? So their market price depends on demand and supply. The underlying value of an ETF reflects, such as gold and silver, is basically on account of 3-4 main reasons, right? And that's when there's any mismatch that happens. Commodity prices moving sharply in global markets. Many investors then tend to also buy or sell at that same point of time because they want to avoid panic. Market makers also are unable to create or redeem units quickly. Now, some of these, and then again, of course, global commodity prices, prices exchange, after Indian market hours. That's also a very, very important point. So, they change after Indian market hours shut. So I think in some of these situations, ETFs can temporarily trade at a premium, which are usually higher than the NAV, or at a discount price which is lower than the NAV. So I think that's one of the main reasons why we've seen a lot of steep premium or discounts to the underlying commodities.
So let's understand this. Vikram, join on this because, see, if I'm investing in commodities, I know I'm taking some risk. So if silver crashes 8% in US overnight action, if my ETF falls by 8%, I'm okay. It's part of the risk I've taken. I start worrying when my ETF price is down 15-16%. Or the reverse, sometimes the premiums. I mean, just because there's maybe so much of FOMO, I realize that the price of the ETF is moving at a pace which is far higher or steeper than the price of, say, gold or silver itself. Why are these anomalies happening? Are they frequent? Are they one-off? Should we expect more of them? What should we be, aware of as investors?
Sure. So the regulations are very cut and dry as far as the gold and silver ETFs are concerned. The gold and silver has to be held within the geographical constraint of the country, which means so underlying for us is physical metal in the Indian market. So we are the price discoverers of the physical metal in the market, because in absence of an official spot market, ETFs are actually giving you price discovery of the physical market. I'll tell you why it happens. First of all, every commodity has a locational premium or discount. Silver will cost you different in India, it will cost you different in China, different in New York and London, as the case may be. Now, what happens is that since these are listed, securities, now just to give an example, suppose if I'm trading at a 1% discount to the local Indian market, then there are market makers who can buy units from the market, give the units to me, take the metal at 1% discount and sell it in the Indian market. Reverse the case in premium. The fact that if you see the top 3 liquid ETFs, in gold and silver, why is it not happening? It is not happening because the underlying market is at that position. So, the ETFs will always reflect the reality of the underlying market, except, in a situation where there is a liquidity issue in the market, local market, then obviously you could have a situation where the market makers may not be that prompt. But again, we have not reached those level for these things to happen frequently. Let's take about China. China, silver ETFs have been consistently trading at a premium. Similar situation. It's a closed market. Export and import is, allowed, but on quota basis. So any market which is closed, because ETFs are not allowed to directly import and export gold and silver.
Correct.
So which means that for us, the Karam Bhumi is India,
Yeah.
and we will only reflect what is happening in the Indian market.
Ah.
Now, obviously, going ahead, what may happen is that we are seeing, the positive, knock-on effect about gold and silver ETFs becoming popular is that the whole ecosystem of market making, the algo traders, and a lot of people are getting interested in this ecosystem. So I think the liquidity, the number of players will increase, and the liquidity will increase. You have to understand one thing, that unlike the Western markets, where the market making is also done by banks and institutions, in India, we are left with the bullion dealers.
Okay.
So that will take time to grow, but I think it's growing simultaneously, and going ahead, I think such episodes will be quite less.
Okay, well, that would be good for investors, because I mean, it does cause you sleepless nights when you see your ETF values decline more than the kind of fall you've seen in the international market. Of course, when it's the reverse, we like it. I mean, if the premium is very high and it's running ahead of the market. But Nasir, that brings me back to the question that a lot of investors would ask. You can also invest in these commodities through funds, not exchange traded funds, but just regular funds, right? Fund of funds, where you don't even need a demat account. So why bother with ETFs at all? Weigh out the pros and cons on both sides.
So clearly, you try to bring in the comparison between the two. So commodity-oriented mutual funds, which are FOFs, which you rightly said, are better suited for investors who prefer the traditional mutual fund route, right? The transactions at the end of the day anyway, rather than intraday trading. So someone who's interested in intraday trading, may look at ETFs as against an FOF in this case. And these funds are appropriate for investors, FOFs, who want a systematic or a long-term allocation to commodities without actively monitoring market prices during the course of the day. I think that's one of the major distinctions. And for those who prefer operational simplicity over trading flexibility. On the other hand, ETFs are suitable for investors who value intraday liquidity and price transparency, and obviously it comes in at a lower cost. I must say this very candidly, and who are comfortable transacting on stock exchanges. Now, they're ideal for investors seeking direct exposure to gold or silver prices through a physically backed, low-cost structure, and for those who want the flexibility to enter or exit positions during the market hours. I think those are the two key distinction points. And the other quick thing is that, largely we've seen the SIP route is available because usually through ETFs, you have to speak to your broker, and if they have an SIP option available in FOFs, in fund of funds, commodity-oriented funds, mutual funds, you have an option available both on SIPs and STPs, which can be used to park in funds. So those major distinctions are evident.
Vikram, let me ask you the same question. And what would you advise? I mean, ETFs are suitable for what kind of investors, and which are the investors who should probably stick to simply these commodity funds?
So I think from accumulation point of view, the gold funds definitely have an upper hand, because you can do an SIP in that, in the mutual fund ecosystem.
Yeah.
But I think from asset allocation point of view, during the market, people may like to see their what kind of asset allocation they need to do. So it's more live. Again, it's passive versus active investors. For active investors, ETFs are more suitable. For passive, maybe long-term SIPs.
Fund of fund.
Yeah.
So gentlemen, coming down to final thoughts, and we have to take tax into account as well. And I think this is one point where ETFs will score, correct? Because I think the long-term capital gains tax treatment is more favorable for ETFs, Vikram?
It is. ETFs as an asset class, yes, which also includes gold and silver ETFs. 1 year is the holding period for application of LTCG. For fund of fund, it is 2 years.
Okay, all right. Nasir, so first of all, will you allocate fresh money to gold or silver right now? That's question number one. And question number two, if you're allocating, which route will you choose?
So clearly, Surabhi, going back to traditional wealth management studying that we've all done, it has to be basis asset allocation. I completely agree with Vikram. Allocation in gold. We are overweight on gold as we speak. We feel that between gold and silver, we feel gold should be a part of your portfolios. It's a natural hedge against, over debt, inflation. So it's a good, allocation to have. You can do it through an SIP. small tranches, has to be in combination with the overall portfolio allocation. So in our opinion, not more than 10 to 15% is something which can be done. And again, in SIPs is a good route. I would suggest the FOF route for passive investors, long-term wealth creation, and for somebody who's willing to do intraday trades, who has a shorter time horizon, who's looking at quick in, quick outs, ETF could be a better route. But broadly, we will be overweight on FOFs and gold funds as against ETFs, because it also gives you the option of SIP, long-term SIP and STP. So monies can be parked in liquid, and from there you park in, moving money through STP routes into these gold funds and fund of funds.
Okay, and Vikram, your final advice to our viewers and potential investors, and also tell us, how to choose an ETF. That's also an art, right? Because every ETF is investing in the same underlying asset, but not every ETF is equal.
Sure, absolutely. Well, you buy precious metals because they are liquid, they're fungible with cash. So I think liquidity is a very important factor. And I think, Surabhi, I'd like to add, I mean, you've not asked it, but I'd like to add a few things. What ETFs have done at the macro level in the country is that wherever ETFs have become, gold and silver ETFs have become dominant, whether it is the North American markets or the European markets, they tend to suppress the overall physical demand or overall physical imports. Because let's talk about in the Indian context, there is a lot of stigma attached to selling your family gold and silver. But in the case of ETF, they give you all the anonymity and all the liquidity possible. So I think in the long run, as ETFs become more dominant, it will suppress the hoarding of gold because the novelty will go away as far as the product is concerned. Secondly, I think it has raised the awareness of regulated versus non-regulated products in the market. So people clearly have taken the right choice. And thirdly, I think what ETFs have done is they have given, in absence, again, just to repeat, in absence of a official spot market, they have become, the beacons of where the market is heading in terms of demand supply, which is then shown in the discount and premium.
And the premium.
Now, with regards to, gold and silver, I mean, gold primarily is an asset allocation, security or an asset. Silver is the higher beta version of it. So again, depending upon your risk profile, if you are risk averse, then gold, ticks all the balances. If you can take some higher beta risk, then maybe some silver can be added to it. But again, I would like to re-emphasize, these are very long-term trades. And if you're taking a view of less than 3 to 5 years, the chances of disappointment will be higher. And but if you can take a long-term view, and if you believe that we have a climate challenge and a debt challenge coming in the way, then I think you'll sleep better with these assets in your portfolio.
Okay, well, advice well taken. Thank you so much for joining in, both of you gentlemen, and demystifying some of the finer nuances associated with commodity ETFs, considering now that they're becoming center stage when it comes to investments here in the Indian mutual fund landscape. Thanks very much. Great conversation. Viewers, do send us your feedback, comments, queries, and as always, we'll see you with another theme next week. Thank you for watching.
Let's talk money.
Hello and welcome. You're watching News Center. I am Ashmat Kumar. Now, a day after notifying the rules for AI-generated content, the government has released a set of FAQs, or frequently asked questions, set to give clarity on intent and implementation of these rules. Firstly, the FAQs clarify that synthetic media or AI-generated content is media that can appear like a real person or event in a way that may deceive viewers into believing that it is genuine. This is the kind of content that the government is looking to target. What is not on the government's agenda, government's radar, are routine edits using AI. Say, for example, an AI filter on a photo that you may have clicked, or using AI to compress video for uploading, or translating a video from Bengali to English, or for that matter, making a PowerPoint or a PDF file using AI. The government calls them good faith edits, and they can continue without any change. What is on the government's radar are illegal content generated using AI. The FAQs give detailed examples on what cannot be permitted by AI platforms. The FAQs say that the AI cannot be used to generate sexually explicit deepfake videos, especially those of children. AI tools also cannot be used to allow synthetic images or videos that violate bodily privacy. For example, recent instances were seen of Grok generating inappropriate images. As per the rules, AI also cannot be used for generating fake government IDs or creating false documents like appointment letters, mark sheets, salary slips, or bank statements. Now, the FAQs also give us specific scenarios pertaining to public personalities. As per these rules, AI platforms cannot create videos showing an election candidate making inflammatory remarks that were not made, or show a celebrity falsely endorsing a product, or a deepfake news clip of a sports star making controversial remarks, or for that matter, allow a video of a government or a corporate leader giving false instructions. Now, as per the latest rules, AI companies are required to ensure that all lawfully generated content contains a prominent label saying synthetically generated. Meanwhile, all AI-generated audio clips will be required to have a prefix saying this audio is generated using AI. Further, social media companies are required to verify if content being uploaded by a user is AI generated, and if it is, the platform will need to ensure that it is labeled appropriately. Social media companies are further mandated to inform their users every 3 months that no illegal content can be uploaded by them by the users, and that if they do, they could be liable to face legal or even criminal action. The rules have also compressed timelines given to social media companies to respond to takedown orders and requests. As per the rules, users can request removal of nude images within 2 hours as compared to 24 hours earlier. Social media companies need to act on government takedown orders within 3 hours. Earlier, it was 36 hours. And videos featuring impersonation need to be removed within 36 hours as compared to earlier response time of 72 hours. But while this move may be well-intentioned, experts are raising concern about the implementation, feasibility, and efficacy of the new rules. To help us unpack and to get a better understanding of how these rules are likely to play out in the days to come, joining us now to discuss this is with us Nikhil Pava, founder of Medianama. Also with us, Apar Gupta, lawyer and founder, director of Internet Freedom Foundation, and Rohit Kumar, founding partner at the Quantum Hub. Nikhil, let me come to you. And before we dive into the details with respect to synthetic content, I just want to get a sense as far as the timelines are concerned. Compress greatly. Take, for example, government takedown orders from 36 hours to 3 hours. The government's rationale has been, we spoke to a few government leaders, what they tell us is that these videos have a sense of virality to them. And if not taken down immediately, it defeats the whole point of the takedown. What is your assessment of this compressed timeline that social media companies now have to deal with?
Look, Ashmit, I think it's a difficult ask for both the government and the social media companies, because the government needs to be responsive to what we are seeing now with these nudify apps and what happened with Grok, and platforms need to be in a position to respond faster. So I don't envy the government's position here. They're trying to do with these particular timelines the best that they can for people who are impacted the most. At the same time, I think from a platform perspective, there's a feasibility question. It means that they will have to have 24-hour cells that are there to respond to orders and requests. What if you get an order at, let's say, 2 o'clock in the morning? You have 3 hours to comply, 2 hours to comply in other cases. How is it that you're going to be able to respond that quickly, right? Quite many of them also have very concentrated sort of content management operations that operate in different jurisdictions, they will need to set up these operations in the country. So these are also unrealistic timelines to take a judgment call in some cases where there needs to be a judgment call taken. Like if you have to go to your legal team for opinion on whether this order is lawful or not, how do you do that? You don't have the time. So what it does is that what is basically a requirement saying if you don't do this, you lose safe harbor, and you had a position to challenge it earlier. Now it just means there will be compliance no matter what orders they get because they don't have time to think. At the scale at which these things might come at them, it becomes even trickier. How do they respond within 2 or 3 hours when there are hundreds of requests coming in, right? Where is application of mind coming in? And this is, by the way, not these restricted timelines are not just for AI generated content. They are for all content, right? In some of these cases. So then a 3-hour timeline for all content is crazy because complaints will come thick and fast.
So huge compliance issue there. Apart, let me get you in on this. Are there concerns that given this time frame that they're looking at, compressed down to 2 hours to 3 hours, and as Nikhil was pointing out, this is not just for AI-generated content, but all content, that may result in over-policing of content, self-policing of content by the social media platforms themselves?
Ashmit, I think there are multiple concerns which emerge on the basis of these rules, which have been made through a process of executive notification and adds to what is a censorship framework for online content under compliances which are placed on social media platforms and intermediaries. And the worrying aspect of this has been a continuation of a great amount of opacity, which means that the person whose content is taken down does not get clear notice, the ability of a hearing, and gets a reasoned order. Because quite often these actions can also be actions which target speech, which is completely legal by itself. So if it is just a notice which is being sent by the government to a social media platform under these expedited timelines, which apply now to all social media content, then it would be an incentive for a social media platform to take down the content rather than risk antagonizing exchange with the government or even the potential of losing its immunity from safe harbor. I would also just like to take a step back that the government has also operationalized a censorship portal, which is called Sahyog. Part of it was litigated in the Karnataka High Court, and in the Bombay High Court, there is a petition which is being filed against it. And this platform essentially allows different functionaries of also state governments, not only the central government, to send takedown orders. Now imagine hundreds of takedown orders, which are going under these expedited timelines directly from a public authority to a social media company or an intermediary without any natural justice. There is a high chance that it leads to censorship, which is extraneous to the intent of the of tackling the problem of deepfakes and how it is harming and impacting especially women and young children.
Fair enough. Right, so a number of issues there, Apar, that you've pointed out. Let's unpack them one by one. Rohit, let me come to you. One of the first issues that this set of rules does is that it goes beyond the social media platforms and then also casts a burden on the shoulders of the AI companies to say that even you have to ensure that no illegal content is generated. First things first, is there a capacity and technologically feasible for companies to do this on a daily basis with hundreds and thousands and millions of prompts going through their systems every day to ensure that no illegal content is generated? Is that technical capacity available with the companies to even discharge this compliance burden?
So, Ashmit, I think, see, the technical capacity is slowly building. Having said that, it's not perfect. Now, with the C2PA and, especially with certain kinds of AI detection techniques, I think it's definitely the technology is getting better slowly by the day. But having said that, it is nowhere close to perfect. So I am sure that tech companies will also falter in many different occasions. In fact, there's one specific point in the FAQs which highlights that for the significant social media intermediaries in the earlier versions of the IT rule, the provision was that they were nudging those significant social media intermediaries to deploy technology tools to do some of this detection better. Now they are kind of mandating it and sort of trying to see if they're doing it well enough as a precondition to safe harbor. So I feel that it will definitely put a lot more pressure on companies. Having said that, this is not to say that the tech is not there or the tech is not improving. It is definitely not 100% accurate, and there are a lot of misses that will definitely happening. Also, just building on what Apar and Nikhil was saying, I feel that the compressed timelines, as Nikhil was saying, it's definitely, there are victims on one side who have been adversely affected because something has gone viral. And therefore, the government also has a responsibility to those victims. And I think the attempt is that before things go viral, they kind of nip it in the bud. Having said that, it will definitely affect speech. Now, the question is whether this is a tactical call that the government has taken, between this freedom and harms balance that it is trying to achieve on a spectrum. And there will also be misuse. For instance, if government issues an order around political speech, there will be no way, as Nikhil said, to kind of question it, no time to sort of evaluate its legal efficacy, and the platforms will have to take it down. And most likely they will have to go in an automated direction to pull them down within the timeline that is kind of prescribed.
Sure. Let me come back with a supplementary question, Rohit. One of the aspects that, in fact, has been lauded by certain sections is that the clarity that the FAQs bring in, that number one, regular good faith edits will not be something that will be a part of this AI regulatory mechanism. So if I take a picture and if I add a filter to it, that's okay, that's not a problem. If I make a PowerPoint presentation, that's fine as well. If I use AI for translating Bengali into English, that's fine as well. How welcome is this this move, this watering down of this mechanism by the center? This was a concern that had been flagged by the industry.
Absolutely. And in fact, I would have started with that, to give credit where it is due. When the first draft of the SGI rules had come in, the definition of synthetic media was very wide. They were also very prescriptive. They were saying that 10% of a visual medium and 10% of the audio clip, etc., has to sort of have those disclosures. But I think in that sense, the government has done really well. So I think they have listened to the industry, and credit needs to be given where it is due. In fact, to say that, okay, we understand the limitations, we are narrowly defining what is synthetically generated content, what is deepfake, and we would like you to label it, and we will give you the flexibility to label it in a way that works best for the kind of medium that you use, while also preserving the authenticity or the integrity of whatever output is being generated, right? And I think this recognition also that there are positive use cases of SGI, that is very well appreciated. So on that part, they've done well.
Right. So on that note, let's head into a very short break. But there's a lot to unpack here as far as what the implications of these rules are. We'll come back to that with the benefit of our panelists in just a bit, but slipping into a very short break. Welcome back. We're discussing the new AI content rules notified by the government. Nikhil Pava, Apar Gupta and Rohit Kumar are still with us. Nikhil, coming to you, as far as the distinction that these rules draw, there's a distinction between social media intermediaries and significant social media companies. No such distinction is drawn for AI companies. The impression is that a Sarvam, say here in India, will have to do the same heavy lifting that a ChatGPT will need to do with respect to ensuring regulation of content.
Yeah, it doesn't make sense. I just looked it up on Hugging Face. There are 2.5 million AI models uploaded on Hugging Face right now. There are several open source models that people can use. And remember, these regulations don't just apply to images. They also, as far as I understand, they still apply to text as well. So these requirements are from everything that you can think of. So there is 2.5 million models. How will they enforce these regulations? These regulations are also going to be applicable extraterritorially by the looks of it. How will they impose it on someone uploading content and making it available in India? What all will they block? How will they address on-device processing? I think we need to have a more meaningful conversation about these issues. And I don't see the government having the kind of technical understanding of how models work, how AI is being used. Bringing intermediary regulations onto generation platforms makes absolutely no sense. There is, yes, the ability for some of these models to block outputs, like from what I understand, OpenAI blocks copyrighted content from being reproduced on chat, even though they do train on copyrighted content. So there are ways and means of preventing them. If you ask Gemini a question about our Prime Minister, it might probably end up refusing to comment on it because of what happened with Bard a few years ago. So there are mechanisms for prevention. But the fact is that only lies with the large models. It only lies with the ones that are widely diffused. There are still people can still gain access to images being made through API rather than through the models, through the formal apps, and there may not be restrictions that are jurisdiction specific, for example. So that I think we need to have these many provisions in these regulations were not put up for consultation. There is no transparency from MeitY about what responses they received that nudged them to make these kind of changes. If someone puts up a video of a movie that has visual effects,
right,
and that is not simple editing, right? You also have de-aging, for example, in case of Harrison Ford in the latest Indiana Jones movie a couple of years ago. That is a significant change. I think Shekhar Kapoor recently uploaded a photograph from Masoom that seemed to be AI generated and very different from the original photo that was there. This had more color. So what is a significant change here? And can you really regulate using FAQs? Because the rules are legal, and I think they ought to be challenged in court. But the FAQs can't define law today. They can't define rules. FAQs are not accountable in Parliament. We've had this tendency to regulate using FAQs ever since the RBI did it with data localization, which is an abomination when you look at lawmaking processes in the country. It seems like we put out bad regulations and then we try and paper over some of the cracks using FAQs, saying we will not enforce it. But when they want to enforce it, the FAQs will hold no weight.
Let me come in on that. Let me also get Apar on that. Apar, again, similar question. Some of the scenarios that have been pointed out in the FAQs, they give the impression that perhaps even parodies or political satire may fall foul of these regulations, these rules. Political comedy, satire based necessarily on extrapolations, on exaggeration. Does that mean that tomorrow there can be no AI-generated parody of political leaders as well?
So, Ashmit, I think so. One needs to understand the rules in the existing political economy of how technology regulation is operating. As I stated in my initial comments, the government essentially has built a platform on which different government departments, not only at the center and the state, can send and upload orders. And these orders are directly then sent to online platforms, so the orders in effect are secret. They're never put to scrutiny, right? So one does not really know also how they are satisfying the thresholds which have been set in these rules or in these FAQs. So without transparency, usually what you have is that censorship actions do not turn towards a system of accountability in which we get to know what is being censored and why is it being censored, right? And here, I think so what's also important to understand is that the definition under these rules of synthetically generated information does have some carve-outs. But it says all of these carve-outs proceed from routine or good faith editing. Now, what is good faith? Who determines it? Is basically a government notification to a platform and a platform's obligation within 3 hours to act. And further, when you look at the definition of the carve-outs, there is no express exclusion for parody, satire, and in fact, there's a clear heading for significant social media intermediaries in which there are positive obligations put on it. And I will only tell 2 obligations. One, they have to prevent depiction of real life events. And quite often, what is the use of AI in visual creation is a real life event quite often. And that is also nebulous. That is vaguely defined. The second is that, according to me, there is vagueness. There's sufficient vagueness in this law that without a court order, a person who has generated an AI video, any AI video, if it is found to be illegal through a private notice of a lawyer, their details need to be provided by the online intermediary to the person who sent that notice. So I think so there are several aspects here which should deepen our concern and cannot be
out of time. Apart, I'll just have to intervene. We're completely out of time. Rohit, just quick 30 seconds. Given the scope of issues that you, along with the other panelists, have flagged, is there room for perhaps a legal challenge as well as far as these rules are concerned?
Ashmit, actually, I won't go into the legal challenge. I would actually disagree with what Nikhil and Apar said a little bit. I think this is one, SGI rules is one where MeitY did 2 consultations. In fact, a lot of the changes they have made is in response to the issues that came up. We also have to understand that the grok controversy happened in between, and the government is in a difficult place. All the issues that Nikhil pointed out about tech being extra-jurisdictional issues, they apply to all technology regulation. And lastly, when we say that the definition of SGI is vague, how else would you define it? I think there is really no easy way to define it tightly and objectively when the tech can be used in multiple different ways. So I would just like to end it with saying that, yes, it is not completely like how we would have wanted it. I do personally have a disagreement with the timelines that the government has put in. Having said that, I think to give credit, it's a good faith attempt to try and address a very difficult problem.
Right, Rohit. So clearly we have a divided house on our hands, but that's the nature of these rules, inspiring very diverse conversations from across our band of panelists who've joined us. I'd like to thank all of our guests, Nikhil, Apar, Rohit, for making this a very engaging conversation. But that's all the time that we have. It's a wrap on this edition of News Center. More news and updates will continue right here. Hello and welcome to this special broadcast right here on CNBC TV 18. Now, New Delhi is gearing up for hosting the AI Impact Summit 2026. We're only a few days away now from what is likely to be a landmark moment in the course of AI, its evolution, and as the name of the summit suggests, its impact going forward. Now, to help us break down and unpack what AI-led journey will look like in 2026 and beyond is with us Sylvain Duranton, Managing Director and Senior Partner, as well as a global leader at BCGX. Sylvain, thank you so much for joining us, being a part of this conversation. You're joining us all the way from France. It's an early morning for you, but thank you for taking out time. First question, AI, this is that landmark moment. At least that's what the Indian government is saying, that this will turn things around as far as India is concerned. Now, India is a late entrant to the AI party. We've already seen huge a capex-led investment coming in the United States, clearly having the edge over the rest of the world. China has had its DeepSeek moment. India coming late. Is that a handicap or an opportunity for the country going forward?
I think it's an opportunity because, as you say, maybe India is coming late in terms of investment, but India has something that many other countries are envying, which is one of the highest usage rate of AI in the world, with 92% of Indian workers using AI at work at least once a week. So there is a battle of investment, and in the last summit last year in Paris, there was a lot about the billions and billions and billions that would be invested in data centers. I think this year in Delhi, it will be a lot about adoption. Inclusive adoption is becoming a very important topic across the world. And on that front, India is clearly leading the way.
I just want to borrow from the economic survey, a formal document released by the chief economic advisor of the country. There, a difference was sought to be drawn, that the approach that the West is following, which is capital heavy, energy intensive, is perhaps an approach that India needs to shy away from, needs to move away from, and have a more cost effective, energy efficient approach. Is that a word of advice perhaps that you'll share with some of the leaders when you do join here for the AI Impact Summit?
I do think that the battle cannot be only about pouring billions in dollars into infrastructure. Yes, there is a need for infrastructure, but looking for cost-effective way, using chips, for instance, that are more efficient from an energy standpoint. And we see a new generation of chips which will be coming, which will be more frugal, and using less energy is important. I think there's another domain where India has been super innovative, is everything related to the digital public infrastructure, those digital backbones enabling to bring service to the manys in the country. India has been investing a lot in that over the last decade to be able to facilitate public procurement, for instance, or digital banking for everybody, or government tasks for everybody, access to government services. That digital layer is much less talked about than the billions that are put into the physical infrastructure, but they are extremely critical. And there is more and more research and attention paid to those digital public infrastructure, where India has been leading the way.
Sure. Since we are talking on the subject of CapEx, let's bring in that conversation here as well. 2024, the big four companies out of the United States, that's Amazon, Google, Microsoft, Meta, invested $250 billion in 2024. It went up to $350 billion in 2025. And estimates suggest it could go up to as high as $600 billion in 2026. Is this sustainable going forward?
So there is a race which is open on building the most powerful frontier model possible. There will be a market for very powerful frontier model, and that's why you have this race. How many will survive? How many of those models will we have in the end? I don't know, but they will play a role. In parallel, you will have much smaller model. Gartner is predicting that 50% of the model used in the world in corporation will be much smaller model. So there will be alternative, and we'll have an ecosystem with both super powerful and big frontier model, but other smaller models. And I think that's where the battle of adoption is so important. Everyone has been focused on the infrastructure layer, on the big model. I think the wave of application now is coming, and application will drive adoption.
Interesting that you talk about applications. I just want to bring in the India perspective there as well. India offering SaaS is something that is central to the service economy here of the country. Now, all of that came in for a big shock a few days back when we had Anthropic release its new wave of automation. The IT stocks here in India at the announcement fell by as much as 6%. There's a huge concern that this automation will take away work from the Indian IT companies. In fact, the word that was being coined here in Indian circles was SaaSpocalypse. That's the language being used. Are those fears legitimate in terms of what this new wave of automation will do to a labor-intensive model that is followed by IT companies here in India?
So SaaSpocalypse might be a bit too strong a word, but we saw pressure on those models across the world. What's difficult to completely interpret is how much of the correction that we saw on the stock market was linked to too high expectations, because many companies had sold a lot of upside and growth related to the wave of AI, versus a real threat on those companies and on the sector. And it's probably a bit of both. Some of the dream of AI will bring so much that all those companies will be increasing revenue growth massively. I think this is proving harder than expected. But I do believe that IT companies, SaaS companies, BPO companies who leverage AI have a bright future. And the question is not so much, am I on the right spot? The question is much more, I think, given the spot where I am the best, fastest, most effective at deploying AI into my business.
I just have two questions based on news triggers. Number one, as far as the India-US trade deal is concerned, as a part of that trade deal, as a part of that ongoing negotiations, there is an assessment from both the sides that India needs to cut back on some of the digital trade barriers that have been there in the form of equalization levies, etc. They have been removed. There's a greater understanding between the two countries going forward. In the meantime, we've seen three big hyperscalers commit to $70 billion in data center investments in the country. With an India-US deal on the anvil, do you expect this engagement to grow further, those investments to perhaps stack up even further as we head into 2026?
So I'm not an expert of trade policies and trade deals, but what I can say is that India has a very special position, because India is, I would say, a rising force as far as AI is concerned. It's not an AI superpower like the US or China. It's a different type of player. It's a rising, I would say, second-tier force with large population. I think 14% of the data scientists in the world are in India. And the way India is building its ecosystem is a combination of technology from the US, sometimes technology from China, also your own tech ecosystem. And I think that for India, being part of this global ecosystem while building your own tech stack in some of the layers or bricks is the right approach. So my expectation would be that, yes, there will be this booming global tech ecosystem related to AI, and there will be a local Indian version of that stack. So
And we said we need to have India's Semiconductor Mission 2.0, the second edition of it. And in that, I like to highlight that I've spent a brief mention of investing in cutting-edge areas like carbon capture, because carbon capture is a very important means through which our 2070 net zero goal can be achieved. We have mentioned about carbon capture also. The strategy, the technology, and the ways to do it are all evolving, but even as it is evolving, we have invested in it so that we can be a leader in that. By doing these, which are somewhat leading us towards a medium and a long term, we are also continuing our push in building infrastructure. Now, it's not just roads, it's not just national highways, it's also looking at waterways so that the cost of logistics in this country can come down, and states which are very much in the hinterland, not connected to any seaport, will have the advantage of moving goods faster at a lesser cost. So we very clearly created freight corridors as part of the very exclusive land on the surface transport, but equally spending resources and planning for infrastructure through waterways, national high waterways. Even as we are doing this, Madam Deputy Speaker, emphasis on labor-intensive sectors and giving them emphasis so that not just they can have more resources to improve, but even looking at legacy industries which are waiting for rejuvenation have been funded. I'll take the example of building champions out of MSMEs, particularly the medium-sized units, which do not want to grow out of the MSME category, even though they have the capacity, even though they have every strength. But even in the last budget, we expanded the definition of MSME so that even if they go beyond a certain level in their turnover, they'll still be defined as MSME. They don't lose out on their benefits. But this budget, we've taken that a bit further and very clearly announced ways in which such medium-sized industries which have potential to grow and export and also become champions in their sectors can be given further help, and I've announced several steps towards equity help, professional help, and also making sure that they will have liquidity access. And in the process of 3 ways in which we want to reach them, they will be leaders in their sectors so that they can participate in India's growth. Is this only for industries? And is it not going to concentrate, is this budget not going to concentrate on building manpower so that our youth can aspire in a particular sphere of activity to go with skills in his hand or her hand and achieve jobs or become entrepreneurs themselves? In this, I would like to highlight 2 major announcements that we've made, in which I have not named any states. In fact, I have openly said, for creating this big facility, states can aspire, any state can aspire, going through the PM Gati Shakti filters. If you think you have a proposition in your hand, any state can ask for one of the 5 that I've announced in terms of the allied and health service, where we want to set up medical hubs. States can aspire to be a part of it, wherein all the aspects of medical education and hospitals for treatment of patients can all be focused in one area, where nurses or any other 10 different allied health services will have their institutions through which people can learn, get themselves skilled, find jobs there itself, and that will become a medical tourism hub. So any state can qualify, and I'm sure states which have traditional strength can also be coming in for it. And this includes Ayush as well. So this is a major forward-looking proposition, wherein immediately, because of the medical tourism advantage that India has, this will become a center of multi-purpose, multi-speciality allied health service center through which we can promote medical health, medical tourism. So that was one of the major announcements. Similarly, we have said, instead of waiting to qualify and finishing your education and coming out and seeking where should they go for acquiring skills, the skilling element can be brought into education itself, and at the end of the day, when they come out, students can say, I can become entrepreneur, and this kind of a mega center can be kept next to any industrial cluster that any state has. So these mega entrepreneurship building centers as education hubs can also be coming up from any state. We are willing to work with the states so that this mammoth higher education center can be propped up, and therefore students can go there, come out as entrepreneurs, get to doing businesses. So if we've done these 2 in the major education-related activity, health-related activity, we've also openly said that mega textile parks, we are willing to work with states, particularly looking at industrial textiles, looking at textiles which are going to be new age, which are now becoming a part of manufacturing in industries, whether they manufacture a car, where the safety cushion which comes in is all completely made out of industrial textiles. So these kind of new age textile requirements can also be produced. So these are major announcements, and I welcome any state which wants to come into this area. The center is willing to work with them and promote it. If this is all being done at the level of youth and students and larger centers where jobs and education can go together, health and education can go together, health and providing services to patients who come from different parts of the world come together. We are also placing emphasis in animal husbandry, fisheries, to make sure that in every district you get the facilities for a veterinary surgeon, veterinary hospital, testing labs, so that animal husbandry can be given that priority immediately in the rural areas. So farmers or those who are not farmers who want to get into animal husbandry can also benefit. That is why these announcements for fishing sector, it goes along with money being put in for restoring 500 Amrit Sarovars, the waterways, and the particular waterway which has been, national waterway which has been announced, also has institutions of excellence along its course, along the course of the river, so that shipbuilding, boat building, particularly I mentioned this, the route in which the national waterway is being announced, which will end up covering all the mineral-rich parts of the country and linking up with Paradip or with Dhamra port, is passing through states where the Nishad log can become boat makers, and they're already experts in it. They can also teach people. They can become part of the Institute of Excellence, so that inland shipbuilding for the transporting of huge logistical facilities will all have the support of the local experts who for generations have done this work. They can also benefit in this growth. Equally, ma'am, as I said, not just helping the MSMEs which are new, but also the old and legacy industries, 200 legacy clusters which have been known for decades as those places which supported MSME, and from there they produce and export. It can be any of them. It can be Ludhiana, it can be Jalandhar, or it can be Kanpur, or it can be centers near Bihar, it can be anywhere in Bengal. So any legacy cluster, 200, we have volunteered that it can be funded, upgraded, given the modern instruments, hardware, software that is required, we'll be undertaking that. Other than also providing for girls' hostel in every district, so that girls do not hesitate to take up to science education, which requires long-term, long hours to be spent in the colleges and universities. All of them, not just the girls' hostel, but the training, the internship, and the kind of programs that we're looking at education centers are all with AI provisioning. So AI education is not anymore kept at elite levels. It's going to be available for all our young. So if I very quickly move to mention the numbers, madam. Gross tax receipts are at 44.04 lakh crore in this BE. It's about 8% more than what was in BE of RE of 25-26. 3.26 lakh crores more than the RE. And if I were to look at the total expenditure, madam, for 26-27, it's at 53.47 lakh crores, so much more than what we receive as tax receipts. The capital expenditure is at 12.22 lakh crores, which is 3.1% of GDP, and also 11.5% higher than the RE 25-26. Of this, I'm glad to say, on the recommendation of finance ministers from the states who met me before the budget preparation, which is a normal calendar event, which before every budget I meet up with the state finance ministers. On their recommendation and accepting their recommendation, capital expenditure grant that we grant, call it loan without interest for 50 years, which eventually would be equivalent to a grant, has been increased on their request to 2 lakh crores under SASKI, and that is very much for their capital expenditure. Many states have actually shown that some of the signature projects of their states have been completed over the years since 2021, when we have been giving them SASKI, 50 years interest-free capital expenditure, money which goes to the states. So with this, the effective capital expenditure, although I said capital expenditure is 12.2 lakh crores, the effective capital expenditure, which includes grants that I give to the states as well, is 17.1 lakh crores, which is 4.4% of the GDP, which goes only to build India in the states and everywhere else, union territories and so on. So states and union territory put together for the capital expenditure, 17.1 lakh crore is being given effectively. I'm not spending too much time on the fiscal summary, madam. Fiscal deficit, as you know, for this coming year has been pegged at 4.3%. There are, of course, quite a few honorable members who said it's by restricting your expenditure that you've come to that fiscal consolidation. I'll explain it, that it is not by restricting the expenditure, but I can expand on that a bit later. The resources transferred to the states. Often we are accused of not really transferring the 41%, which the Finance Commission has recommended, that Government of India should give 41% of devolvable tax to the states. It's not 41%. I will assure this House through you, madam, 41% it is that we have transferred to the states. We have not reduced any states transferred devolvable tax which has to go. And that I will also bring in the details. Total resources to be transferred to the states, including the devolution of states' share in taxes and releases that are made under the centrally sponsored scheme in 26-27, the coming year, is estimated to be at 25.44 lakh crores. इतना पैसा states को जाएगा इस साल आने वाले साल 25.44 lakh crores. This entails an increase of 2.70 lakh crores. ये पिछले इस साल जो मार्च तक है, उस साल से कंपेयर करते हुए अगर हम देखें तो 2.7 लाख करोड़ का इंक्रीज है 25-26 में, और 3.78 lakh crore more than the actuals of 24-25. So इतना स्पष्ट इंक्रीज स्टेट्स को जा रहा है. और इसके साथ साथ मैडम क्रेडिट अवेलेबिलिटी कैसा है? इंडस्ट्रीज काम करने के लिए, छोटे इंडस्ट्रीज, छोटे उद्योगों के लिए टोटल क्रेडिट has actually expanded by 13.8% in the current financial year. As of January 15th, 2026, non-food bank credit has grown by 13%, and the non-bank credit, which is NBFC, has grown by 15.4% at the same period. So credit का कोई कमी नहीं है. I want to highlight the fact, madam, the 16th Finance Commission, whose report I had tabled in this House, has very clearly said, क्योंकि बार-बार ये प्रश्न आता है कि सेंटर स्टेट्स को देने वाले पैसा नहीं दे रही है, उसका विषय में फिनांस कमीशन अध्ययन करने के बाद उनका बयान है रिपोर्ट में. मैं I'm not exactly quoting it, I'm putting that वो रिपोर्ट में क्या कहा गया. 16th Finance Commission analyzed the state's share transferred by the center to the states from 2018-19 to 22-23 and and concluded that in each of these years, the devolution made by the center exactly matches the recommendation of the Finance Commission. So सिर्फ हम नहीं क्लेम कर रहे हैं, Finance Commission ही विस्तार से इसको अध्ययन करने के बाद उनका रिपोर्ट में ये बताया गया कि सेंटर से जो पैसा स्टेट्स को जाना है, ये उदाहरण लेकर के 19 to 2022, 23 इन सालों का विषय में अध्ययन करने के बाद स्पष्टता से बोला है कि केंद्र सरकार से राज्य सरकार को जितने भी पैसा जाना है वो टिक गया है स्टेट्स को, कोई इसमें शक करने का गुंजाइश नहीं है। क्योंकि इस विषय में इतना स्पष्टता से मैं बात करना चाहती हूं, थोड़ा सबको मालूम है फिर भी मैं याद दिलाना चाहती हूं। ग्रॉस टैक्स रेवेन्यू मतलब टोटल टैक्स से जितना कलेक्ट होता है उसको ग्रॉस टैक्स रेवेन्यू कहा जाता है। वो सेसेस भी और सरचार्जेस भी उसमें शामिल होता है, वो अलग है। फिर कॉन्स्टिट्यूशन ये बताता है कि सीएजी के द्वारा ऑडिट करने के बाद नेट प्रोसीड्स क्या है, ये निर्णय करने वाले सीएजी है। नेट प्रोसीड मतलब ये ग्रॉस टैक्स रेवेन्यू जो अमाउंट है उससे सेस को हटा दो, सरचार्ज को हटा दो, उसके बाद जितनी भी है उसको डिविजिबल पूल कहते हैं, वो ही है नेट प्रोसीड। उससे हम 41% स्टेट्स को भेजा है कि नहीं भेजा है उसका अध्ययन होना चाहिए, ना कि ग्रॉस टैक्स रेवेन्यू के ऊपर। ग्रॉस टैक्स रेवेन्यू में सेस भी है, सरचार्ज भी है। सो जब डांटना है केंद्र सरकार को, आप सेस भी कलेक्ट कर रही हो, सरचार्ज भी कलेक्ट कर रही हो, हाँ कलेक्ट कर रहे हैं क्योंकि कॉन्स्टिट्यूशन में हमें प्रावधान है सेस कलेक्ट कर सकते हैं और सरचार्ज कलेक्ट कर सकते हैं कॉन्स्टिट्यूशन के मुताबिक। वो हटाने के बाद जो पूल रहता है उसके ऊपर आपको 41% मिलना चाहिए, वो मिल रही है कि नहीं मिल रहे आप उसके ऊपर कैलकुलेट करो, ना कि जीटीआर के ऊपर, और उसके बाद बोलोगे कि सेस भी आप कलेक्ट कर रही हो और उससे हमें कम भी दे रही हो। नो, यू कांट हैव इट बोथ वेज। So I think we should be very clear। और ये Annex 4A और Annex 4B, sorry?
माननीय सदस्यगण, सभा की सहमति हो तो सभा की कार्रवाई माननीय वित्त मंत्री जी के भाषण की समाप्ति तक बढ़ा दी जाए। माननीय मंत्री जी, कंटिन्यू।
Yes, there is less accountability. The CAG also has said that. So the concerns that the state raised is that if you take everything in cess, then what are the states left with? Like even the new schemes, if you keep cutting, then what will the states have? That's the limited point I think the opposition is raising. I don't think there's any allegation about it. It's just to what...
There's no suffering to the states even on that score, Madam Honorable Member. I'd like to explain that as well, and I will go into the detail with that as well. Cesses and surcharges, cesses particularly are collected for a particular purpose. Health cess, education cess, road cess, इन सब में जितने भी कलेक्ट होते हैं वो हमारे काम में नहीं आता है, वो स्टेट्स को जाता है उस पर्पस के लिए। स्कूल बनाओ, एजुकेशन सेस, हेल्थ सेंटर में कुछ कमी है, मशीन्स खरीद लो, उसके लिए जाता है हेल्थ सेस। रोड सेस, रोड बनाने में जाता है, और जितना कलेक्शन हुआ उससे ज्यादा ही हम स्टेट्स को दे रहे, वो नंबर के साथ मैं अभी बताऊं। इसीलिए सेंटर कलेक्ट करता है, ये नहीं है कि वो सेंटर ही उपयोग करता है। आखिर सेंटर के पास कोई रोड नहीं है और सेंटर के पास सिर्फ एक हॉस्पिटल है, ऐसे भी नहीं है। हॉस्पिटल हर जगह पर है, और हर जगह पर जितने भी हॉस्पिटल है स्टेट के साथ हम शेयर करते हैं। सो सेस कलेक्ट करने के बावजूद पैसा जाता है स्टेट्स को ही। सो ये आई जस्ट वांट टू एक्सप्लेन दैट, एंड वो नंबर भी मैं देती हूँ। और रिसीट बजट में, क्योंकि ऑनरेबल मेंबर्स इस विषय में बहुत रुचि लेते हैं, ये बोलना चाहती हूँ। रिसीट बजट एक डॉक्यूमेंट है, बजट के समय बजट डॉक्यूमेंट के साथ वो भी आता है। उसमें अनेक्स 4A और 4B देख लीजिए, उसमें CAG ऑडिटेड नंबर का बयान उसमें रहता है, आप देख सकते हैं। हम हमारे बजट को रिफॉर्म करने के रास्ते पे चलते एक नया रिसीट बजट में जोड़ा है, 4C। वो 4C भी हर साल आता है। उस 4C से आपको और क्लियरली डेटा मिलेगा कि कहां जा रहा है पैसा। ये भी फिनांस कमीशन अभी रेकमेंड भी कर रहे हैं कि हर साल आप डेटा निकालो उसका, वो निकाल रहे। और हमारे बजट के डॉक्यूमेंट में रिसीट में वो भी है, सिर्फ मेंबर्स का जानकारी के लिए मैं देना चाहती हूँ। और इसमें से मैं शुरू कर रही हूँ ऑनरेबल मेंबर्स का क्वेश्चंस। ऑनरेबल NK प्रेमचंद्रन जी हैड आस्क्ड रिलेटेड टू दिस। आप अभी टारगेट डेट टू GDP में जा रही हो विदाउट अमेंडिंग द FRBM, ये प्रश्न था उनका। मैं उनको कहना चाह रही हूँ, डेट टू GDP रेशियो ये नया टारगेट कुछ नहीं। अलॉन्ग विद फिस्कल डेफिसिट, डेट टू GDP ऑलरेडी इंक्लूडेड है एज अ टारगेट। 2018 अमेंडमेंट ऑफ द FRBM एक्ट में वो बनाया गया है, वो प्रावधान। दिस इज मेंशन्ड अंडर द सेक्शन 41B ऑफ द FRBM एक्ट। इसके कारण हम ये स्पष्टता से कह सकते हैं, गवर्नमेंट के स्ट्रैटेजी टू अचीव विकसित भारत is to provide capital investment in the economy. For that purpose, we have allocated effectively 17.15 lakh crore, and this will work as a force multiplier and therefore accelerate our move towards Vikasit Bharat, and this will be a very important factor in achieving Vikasit Bharat, not by moving this or that. We have not moved, both are available through the FRBM Act. मैडम, बहुत सारे लोग युवाओं के लिए बात किए और ये विषय था कि कुछ ऐसे नया पॉलिसी नहीं ले आ रहे जिससे युवा के लिए रोजगार मिले और उनको कैसे क्या स्कीम्स के द्वारा अटेंड कर रहे। मैं
Good evening. Thanks very much for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. Range-bound session on the Lal Street. The Nifty holds 25,900. The Sensex underperforms. IT stocks under pressure. Auto stocks provide some solace to the Nifty benchmark index. The White House revises its fact sheet on the proposed India-US trade deal within 24 hours, drops pulses from the list of US products on which tariffs would be reduced, changes the $500 billion purchase commitment to an intent to buy. The portion claiming that India has agreed to scrap digital services taxes has been removed as well. Eminem reports a steady quarter. Auto and farm business volumes grow by 27% on a yearly basis. The group's consolidated revenue crosses the 50,000 crore rupee milestone for the first time. BHEL shares nosedive on a day one of its offer for sale. The government aims to raise close to 4,500 crore rupees by divesting up to 5% equity in the PSU. This includes a 2% green true option. The floor price for the OFS has been set at 8% discount to yesterday's closing price. The government clarifies on its new IT rules that make prominent labeling of AI-generated content mandatory, announces a 3-hour compliance window for government takedown orders and 2-hour deadline for removal of nude images. Also highlights that routine editing of photos PDF using AI need not be flagged as AI-generated. Higher pilot-to-aircraft ratio and a higher crew buffer enables Indigo to comply with the new crew rostering norms after a 2-month leeway. The airline on an average now has 7 pilot-officer pairing per aircraft versus 6 earlier. Sources tell us that Indigo's pilot utilization and not headcount was the core issue behind the major disruption faced in December. Trump issues a fresh threat to Iran, warns them of aggressive actions if the country fails to reach a deal on an issue ranging from nuclear enrichment to ballistic missiles. Reports say Trump plans to send a second aircraft carrier to the Middle East. Lok Sabha leader of the opposition Rahul Gandhi accuses Prime Minister Modi of selling the nation over the India-US trade deal. Parliamentary Affairs Minister Rijiju rejects charges, hails Modi as the strongest Prime Minister, vows to file a privilege motion against Gandhi unless he authenticates the charges made inside the Lok Sabha by the evening. Paramount Skydown sweetens its offer for Warner Brothers Discovery amidst repeated attempts at a hostile takeover. Offers shareholders a quarterly ticking fee of 25% per share, but keeps its headline bid unchanged at $30 a share. 9 dead, dozens hurt after an assailant opens fire at a school in Western Canada, making it one of the deadliest shootings in the country's history. The suspect was found dead from a self-inflicted injury. Well, let's start with the day's market action. The Lal Street ending the day flat after a volatile session, with the Nifty ending above the 25,950 mark. Auto stocks led the race today, while IT stocks continue to be under pressure. Just about in the green, that's the Nifty for you. The Sensex closing 40 points lower, 118 points higher there on the Nifty Bank, and the Nifty Midcap Index also closing just about in positive territory. Prashant is standing by to wrap up the day's market action for us. Fairly choppy, fairly volatile off its intraday lows, but finally closing flat, Prashant.
A quieter day after 2 days of very, very decent moves. So Monday, of course, was big. Yesterday, was up. The market was up. But as we pointed out, right at the word go, the close right at the open, usually it's in technical terms, it's called a doji. The open and the close are the same and indicate some sort of wariness, exhaustion, whatever you want to call it. And I think today we followed through in that same kind of fashion. So 20 points. Higher, 25,950 or so is where we ended. Mid-cap and small-cap indices absolutely flat, nothing very much. The IT index, of course, came under some more selling pressure. It's not as if after the earlier episode of severe selling, which was last week, they had any large bump up or gains. It just sort of, sell off, consolidation, and then, another leg down. And that's what we saw. And you look at the large stocks which were off on the Nifty, TCS, Infosys, HCLTech, all down. There's also Coal India, Eternal, which saw some profit booking. ITC's done well recently from the lows. That also gave up gains. On the upside, Eicher Motors was the big one. Apollo was the other one. So both earnings reactions. Apollo, of course, the management was with us. SBI followed through with another 3.5% gains. Superb numbers, of course, earlier. And there was Max Healthcare, which has been seeing a bit of profit booking. And that came back up.
All right, Prashant, many thanks. Now, the White House has revised its fact sheet on the proposed India-US trade deal. All of this within the last 24 hours. Now, the word pulses has been dropped from the list of US products on which tariffs would be reduced in the overnight revision. It has been replaced with the phrase, and I quote, a wide range of US food and agricultural products. In the updated document, the phrase about India's commitment to buy $500 billion of American products has also been changed to, and I quote, an intent to buy. The portion in the earlier fact sheet claimed that India has agreed to scrap digital services taxes. That has been removed as well. So that's the latest there on the US-India trade deal. US Trade Representative Jameson Greer has said that India could be a potential way station for US supply chains. In an interview with Fox News, Greer said that India was a viable option for companies seeking to diversify away from China. He also said that India had started winding down purchases of Russian energy products and ramping up purchases of American energy. Commerce Minister Piyush Goyal is likely to meet exporters and industry associations later this evening. Industry sources say the meeting will be aimed at discussing the contours of both the trade deal signed with the US and the EU. We'll, of course, be tracking that. On to earnings now. Eminem's Q3 numbers in line with estimates. Net profit up 33%. Revenue rose 26% on an annual basis. Sudarshan is standing by to take us through the fine print. Eminem details, Sud?
With Mahindra & Mahindra, an Argo company has come out with Q3 FY26 earnings. Both the segments, auto and farm segment, have been seeing healthy volume growth. It was up 23% YY in Q3 FY26. That has helped company to report a double-digit revenue growth. On the consolidated basis, Mahindra Group has reported revenue of more than 50,000 crore for the first time ever. Now, on the standalone basis, profit was up 33%. Revenue has increased by 26%. EBITDA too has seen a jump of 27%. And margin was in line with expectations and has come at 14.7%. Going forward in FY26, companies expecting tractor industry to see a growth in the range of 20 to 24%. Even SUV is going to see a healthy growth because the demand for the recently launched vehicles remains strong.
Sid, many thanks. Shares of EV maker Ather Energy declined in trade after nearly 33 lakh shares worth 233 crore rupees changed hands via block deal. Sources say the National Investment Infra Fund, the NIIF, was likely to sell up to 1.9% stake in the company. The stock closing almost 2% lower. Shares of BEHL tanking nearly 6% in trade. This after the government launched an offer for sale to divest up to 5% stake in the company. Under the OFS, the government will sell 3% stake initially with an option to offload an additional 2% stake in case of oversubscription. The floor price has been fixed at 254 rupees a share. Indian artificial intelligence firm Fractal Analytics' 2,800 crore rupee IPO was oversubscribed on the final day of bidding. This was led by robust demand from qualified institutional buyers section, followed by non-institutional investors. That's the Fractal IPO for you. Chinese automaker BYD has sped ahead of Ford Motors in global sales last year. This for the first time ever. Ford sold nearly 200,000 fewer cars than BYD as its sales fell 2%. With this, the Chinese auto company is now at the number 6 spot in the global sales rank. While Ford's US sales increased last year, the company lost ground in Europe and China, a significant milestone there for BYD. Higher pilot-to-aircraft ratio and a higher crew buffer enables Indigo to comply with the new crew rostering norms after a 2-month leeway. Sources tell CNBC TV 18 that Indigo's pilot utilization and not head count was the core issue behind the major disruptions that it faced in December. Shivani joins us now with the details. Shivani, what are the changes that Indigo has made that has allowed it now to comply with the new flight duty timing norms?
Well, yes, Indigo is back in full compliance with the flight duty time limitation norms. And the question today is, what has changed since December when they were exempted from these norms? Sources tell CNBC TV 18 that the airline has actually raised crew deployment to 7.2 crew sets per aircraft in February. This is up sharply from under 6 per aircraft in November, December. One crew set, remind you, is one captain and one first officer, so 2 pilots. At 7.2 sets across 350 active aircraft, Indigo needs over 5,000 pilots to operate compliantly. Government data as of December 8th shows that the airline already has 5,000 plus pilots, which is 5,085 pilots on its roll already. So the pilots were always there. Headcount was not a problem. Utilization was. When the DGCA tightened night duty and rest norms in November, effective availability dropped. Indigo was operating at under 6 crew sets per aircraft, leaving almost no buffer in the system. Zero cushion whatsoever. So when duty hour caps were hit or sick leaves rose or weather disrupted schedules, cancellation cancellation snowballed and cascaded effects that we saw in December. Now, aviation experts say that resilient operations require 7 to 8 crew sets per aircraft. So by moving from under 6 to 7.2, Indigo has finally built back the operational breathing room. So it looks like Indigo is back on the FDTL track as of now.
All right, Shivani, many thanks for joining us. Up next, the government clarifies on its new IT rules that make prominent labeling of AI-generated content mandatory. That and more when we return.
and welcome to Startup Street. I'm Shruti Mishra. These are the top headlines from the startup space. Indian artificial intelligence firm Fractal Analytics' 2,800 crore rupee IPO was oversubscribed on the final day of bidding. This was led by robust demand from the qualified institutional buyers section, followed by non-institutional investors. Shares of EV maker Eicher Energy declined in trade after nearly 33 lakh shares worth 233 crore rupees changed hands via a block deal. Sources said that National Investment Infra Fund was likely to sell up to 1.9% stake in the company. Nesta, a premium design first tech-driven homeware brand, has raised 19 crore rupees in a pre-Series A funding round led by Fireside Ventures and OTP Ventures. The fresh funds will be utilized to understand consumer pain points and innovate products with high functionality that simplify routines, chores and homes. Government has issued a clarification on its new digital content rules that make prominent labeling of AI-generated content compulsory. The government has highlighted that routine editing of photos, PDF using AI need not be flagged as AI-generated. Chinese automaker BYD sped ahead of Ford Motors in global sales last year for the first time. Ford sold nearly 2 lakh fewer cars than BYD as its sales fell 2%. With this, the Chinese auto major is now at the number 6 spot in global sales ranks. While Ford's US sales increased last year, the company lost ground in Europe and China. Well, those were the headlines we've been tracking for you this evening. Digital financial platform Olive, focused on emerging India, has raised $23 million in a Series B round led by Fundamentum with participation from SMBC Asia Rising Fund. What makes this deal stand out is not just Olive's scale, 5 crore app downloads, 10,000 crore rupees in cumulative transactions, and 11 straight quarters of profitability, but the fact that this is Fundamentum's 11th and final investment from its Fund 2, underlining the fund's maturing fintech thesis. Joining me now to break down the deal, the sector, and what's next for Indian fintech is Mayank Kachwaha, the investor and fintech thesis led at Fundamentum. Mayank, welcome to Startup Street. Now, this is the final investment from Fund 2, which was launched in 2022. Why did Olive make sense as the closing bet, Mayank? And in a crowded digital lending market, what convinced Fundamentum to lead this $23 million Series B?
Well, thanks for having me, Shruti. So I think the opportunity in Indian digital credit is quite large, right? Continues to sort of be a very large opportunity going forward as well. And we've been obviously spending time with Rohit and team for a long time. I think what made the cut for us, again, given that we are an early growth fund focused on post-PMF investments, I think Olive has consistently sort of delivered profitability over the last few quarters, has been growing quite well, but has also shown very high quality risk through the cycle as well. So I think that got us over the line. I think given it's a large opportunity, I think that's what got us excited.
All right. Picking up from what you just said, Olive has reported 11 consecutive quarters of PAT profitability, still rare in consumer fintech. Mayank, in today's environment, post the regulatory reset in digital lending, is profitability and unit discipline now a non-negotiable at the Series B stage at least? And how has your fintech thesis evolved over the last 3 to 4 years?
So I think unit discipline is certainly very important, right, for Series B. But especially in lending companies, I think profitability has become super important. I think we've been obviously looking at investing in companies that are post-profitability. But what's changed over the last 3 years, I think, is that I think we've seen, people building or founders actually building on top of digital rails, right? Everything that's happened on DPI, I think there is that advantage. So the platform's almost set, and I think all the fintechs are actually able to benefit from that and scaling up quite well. And of course, actually being able to underwrite risk well. So I think all of those things have changed in the last few years.
Okay. With this round, Olive plans to expand into insurance, UPI and business loans. Mayank, are we entering an era where the real winners in fintech will be full stack financial ecosystems rather than, single product or monoline lending players?
Yeah, I think the short answer there is yes, certainly. I think what's happened is because India financial services is so vastly underserved still, right? So what some of these platforms are able to do is essentially offer customers, a sort of first product, which is the foot in the door, but then able to offer through cross-sell various other products. And I think at the end of the day, I think the next era is going to be about serving the customer well. And these are largely underserved customers who are sort of trying to bridge the trust gap. So I think to the part that, to the extent that, platforms like Olive can actually bridge that trust gap, I think they get the opportunity given by the customer to be able to cross-sell other products, right? Which are, again, insurance, wealth, and all the other services that Olive provides.
Okay. Mayank, India's fintech ecosystem has seen a sharp regulatory tightening from the RBI over the past few years, from digital lending guidelines to stricter compliance norms. And at the same time, India's stack, UPI and account aggregator rails have deepened. So what fundamentally looks different in this new phase compared to the hyper-growth cycle of 2022 to 2022?
I think this part of the cycle is actually, is about clarity, right? I think there's a lot of clarity that has come from the regulator. I think that's certainly helped, right? So all of the founders that we meet now have, crystal clarity in what they want to build, how they want to build. I think they're across the board, right? So I think there's been certainly that change, and that sort of helps, right, build confidence for us investors as well as the founders. I think that certainly changed. The other aspect that I touched upon earlier, right, which is the digital public infra. I think we've seen an entire decade of, digital public infra sort of come into effect, right? But finally, I think it's starting to bear fruit, where we're actually starting to see fintechs really use it, right from KYC to account aggregator. So I think the ability to underwrite risk that wasn't there before, the ability to do KYC, the costs of it, all of that is starting to play out. And I think that's what certainly changed in the last few years.
Okay. Again, picking up from what you just said, Olive is focused on middle-income consumers in Tier 2 and Tier 3 India, many of them new to formal credit. From a risk and returns perspective, why does this segment remain so attractive and misunderstood? What are investors getting wrong about emerging India?
I think historically there hasn't been any data, right? And I think this has been largely because this has been the informal sector of the economy, right? And with everything UPI, right? Because obviously UPI has taken off, and we see it when we're sort of meeting companies and talking to customers as well, that I think customers are increasingly using UPI, that's sort of enabling an entire ecosystem where, there is traceability of data, on top of which I think some of these models are being run. I think certainly what has not been there in the past is is data. Now that we have the data, I think there is the ability to underwrite. And I think this is where platforms like Olive excel.
Okay. Fundamentum has made back-to-back fintech investments since June last year. When you evaluate fintech companies today, Mayank, what metrics matter most? CAC, lifetime value, cost of capital, NPA ratios? How do you ensure founders are balancing growth with long-term risk discipline?
See, I think the most important for us sort of early growth is certainly, I think, unit economics, right? But I think that combined with customer love, I think those two would be, I think, in my opinion, critical, but then I think nuanced in cases of lending companies. I think it's profitability through the cycle risk as well. But yeah, I think customer love and, unit economics sort of being figured out are super important.
Okay. India's digital lending market is projected to reach $1.3 trillion by 2030. Mayank, where do you see the biggest opportunities emerging and the biggest risk in fintech over the next 5 years?
I would say, I think there's two large opportunities. I think one, supply chain credit, right? I think we're and I would sort of bucket that into embedded credit in general. I think there's a large opportunity on the embedded credit, supply chain credit side. It's sort of very early days still. I think a lot of work is still being done there. And I think in general, on the other side, AI is going to have a big impact across the board, right? Right from underwriting to fraud detection to actually just vernacularization.
Okay. One final question, Mayank, before I let you go. With Fund 2 fully deployed, what are the key learnings you're carrying into the next fund? There is buzz around Fundamentum preparing to raise Fund 3 soon. Will it be larger than Fund 1 at $100 million and Fund 2, which was at $227 million? And will fintech continue to be a core pillar of your strategy?
So I think next fund sort of work in progress, right? For us, I think we'll come back on that. But yeah, from a core focus on fintech, I think that continues. I think India fintech opportunity is ever larger. I think our ability to sort of partner with founders in this space, or intent especially, I think continues to be there. So certainly, I think there's going to be more fintech. But yeah, I think on that front, it's more work in progress.
All right, and we surely track that back to you. Many thanks, Mayank, for joining us today on Startup Street.
Thank you. Thank you for having me.
Well, moving on the hot seat today, Eicher Solutions, a full-stack platform for distributed solar, has raised $15 million in a pre-Series B round led by SMBC Asia Rising Fund, the venture arm of Japan's Sumitomo Mitsui Banking Corporation. Now, despite being 3 to 4x cheaper than grid power, distributed solar still accounts for just about 20% of India's solar capacity, highlighting a massive untapped opportunity. Now, Eicher says it's addressing this gap by integrating financing, procurement, and technology into a single digital platform. Joining me now to talk about the fundraise and Eicher's next phase of growth is Anand Jain, the founder and CEO of Eicher Solutions. Anand, welcome to Startup Street. You've raised $15 million with SMBC leading the round. What does bringing in a global banking major at this stage signal about Eicher's ambition? And where will this capital go first? Deeper EPC enablement, wider geographic expansion, or faster MSME and homeowner adoption? What should we expect over the next 12 to 18 months?
Yeah, thank you, Shruti. Really glad to be here again. It's great to have SMBC on our cap table, joining some of our illustrious, investors and backers. Having SMBC on board it's a threefold advantage or benefit, I would say. So first of all, it's an endorsement of what we are building. Second, it signals that distributed solar as a asset class is moving from being an emerging opportunity to a large and mature asset class.
Yes.
And also this gives us solid backing, to help solarize millions of homeowner roofs. There are 50 million home roofs that need to be solarized, and there are 20 million MSMEs in India. Those roofs, all of these need to be solarized. It's a massive, large work ahead of us, that's our passion. And so all of this backing, the SMBC name coming behind us will help us do that. In terms of users of the capital, which you asked, we will obviously continue to scale the lending and commerce businesses by deepening our relationship with the existing installer network and then expanding to new geographies. This will all help help launch new products because there are quite a few things that we are unable to do because of the size and the capital we have today.
Sure.
Other thing is also build the next version of seamless end-to-end tech platform, because this is essential component of bringing in scaling a distributed ecosystem that cannot be done offline.
Okay.
And so all of this will enable us to go from about enabling 1,200 megawatts of rooftops to about 5,000 to 6,000 megawatts of rooftop in next 18 to 24 months.
All right. Anand, like I mentioned earlier, distributed solar is significantly cheaper than grid power, yet adoption remains low at just 20% of India's solar capacity. How much of this is an economic issue versus a structural trust and execution problem for MSMEs and homeowners?
Shruti, it's all about structurally. It never was an economic issue. This is what I've been in solar since 2009 in India. Since Mr. Modi was the CM in Gujarat, he started the solar revolution. And I was in the US, I came back and I joined, started doing solar. And we figured that in 2018-19, that rooftop solar is about 70 to 80% cheaper for any of the companies, MSMEs.
Yeah.
So the issues that were plaguing or preventing rolling out of solar in a rapid way or proliferation was really the structural issues and trust deficit, which is what we are solving for. First and foremost being, if you were looking for a solar rooftop, you would be hard-pressed to find a good installer, right? So we connect you to the right installer, bring the right quality. And then once you find an installer, you'd be or end customer faces the issues of right design and engineering, right procurement or right makes. That the question is, are the right makes going into my plant? And then if that is figured out, is the construction quality proper? And all of that after the commissioning, the AMC piece and the operations and maintenance becomes a big problem for the customer because he's not aware, right? So all of that ecosystem, there's a lot of friction, it is broken, and that's what we're solving for.
Yes, that's what you're solving for. In fact, RM positions itself as a full-stack distributed solar platform, integrating financing, procurement, design, and lifecycle monitoring. So tell us, how does this integrated approach materially, reduce execution risk compared to the fragmented models we've seen so far?
Manifold, actually. But first of all, it just makes the life much easier for the customer and the end user. It solves for convenience and quality assurance. Because imagine as an end user, for example, if you have a home, Shruti, or a factory, and you're going to multiple parties, like someone just doing the design engineering and procurement, and some party doing construction, and then there's another party does O&M, and someone else is financing it. So it's hugely cumbersome and poor coordination. And the customer really doesn't know in terms of technicality what solar really entails and involves, right? So by bringing all this together at one place, we become answerable. We tell the customer, we take the headache away for you from your solar execution and solar risk point of view. And we come in and just give a far superior experience. And we give him a plant that is of high quality and that would last for 25 years. And that would do what it's supposed to do, which is generate the right amount of solar power every year for 25 years.
Okay, but access to affordable capital remains one of the biggest bottlenecks in solar adoption. So how central is your financing layer to unlocking demand? And how do you underwrite and manage risk while scaling rapidly?
Well, I mean, financing, Shruti, so we started, when I was figuring out, the business model for Eicher and we started in 2021, we saw that financing is core to this and it becomes, it really is the core layer, right? And it helps us build the ecosystem around it. So we started with financing, then layered, commerce, and then we started building the quality assurance part of it, right? So, and then second, it helps build trust with the customer because when we say, go in and say, we will do entire thing for you in terms of giving you a high quality plant, but not only that, we will also put in our own capital. We'll finance through our own NBFC. So that builds high amount of trust from a customer lens. So of course, it becomes quite important and integral layer. And this is all done by our own in-house NBFC for Net Zero Finance, and which is duly RBI licensed.
Okay.
And in terms of scaling, like the risk, it's all about digital processes because it's distributed ecosystem, thousands of roofs, and we'll go to millions of roofs right at some point.
Okay.
So the digital processes systems become highly critical, and this keeps risks also in check.
Okay.
It helps us manage quality. We also have a platform called Eicher Remote Operation Center, where each and every plant that it goes through our ecosystem, we finance or we enable, it's real-time tracked on our platform.
Okay.
And that gives us visibility on if the plant is connected, where is it connected, what it is generating. Is it generating what it's supposed to do? I mean, actual versus expected. So all of that comes into place.
All right, one final question before I let you go. You've already, like you mentioned, enabled 1,200 megawatt of solar capacity, financed 2,000 plus projects, and helped avoid 35 million tons of, CO2 emissions. As you scale Anand faster post this fundraise, what does the path to sustainable profitability look like for Aram? And if you could share with us your near-term revenue targets.
Sure. We've been, our operating businesses, Shruti, have been profitable for about a couple of years. When I say operating, which is the lending and the commerce piece. And then they continue to be profitable and we scale them. We spend some amount of money and a very minimal amount of money on building our tech platforms, and which is a required necessity today. But going forward, overall next 8 to 12 months, we see overall on a console level becoming PAT profitable. When I say profitability, we're talking about PAT profitability, really not profits. So that's been the DNA, and we want to do that. In terms of revenues, we want to get to on the commerce side about $150 million of run rate, which is about 1,500 crores, and lending side we want to get to a book of about $100 million, about 900 crores of AUM in next 18 months.
All right. We wish you the very best and hope you meet all those targets that you just mentioned. Many thanks, Anand, for joining us today on Startup Street.
So thank you, Shruti, for having us. Really pleasure joining you.
Well, with that, let's slip into a short break. But up next, Bath and Body Works is expanding into smaller Indian cities and doubling down on quick commerce as demand for premium beauty spreads beyond the metros. Stay tuned for more details. Welcome back to Startup Street. Bath & Body Works is stepping up its India strategy, expanding into smaller cities while placing a bigger bet on quick commerce. As premium beauty demand spreads beyond the metros, the global fragrance brand is recalibrating how it grows in the market. In an interaction with CNBC TV 18's Aishwarya Anand, the company's global EVP Tony Garrison outlined why India is becoming central to its international playbook. Take a look.
I think it's safe to say that most of us have gifted Bath & Body Works at least once. Maybe a candle, a body mist, or a last-minute gift set. I'm here at DLF Promenade in Delhi's Vasant Kunj area to see what's new and how this brand continues to play a big role in how India shops for fragrances and self-care. See, this is how you get lost in a store like this.
Well, you have picked a wonderful place to stop. You have stopped at Champagne Toast. Are you familiar with Champagne Toast?
No, but I did smell it. It smelled quite nice.
Tell me what you liked about it.
It's got a very feminine, very fresh kind of smell.
Makes you feel excited and bubbly like a champagne toast,
it does.
right? So this is one of our best-selling fragrances globally.
Do you work for Bath & Body Works?
I do work for Bath & Body Works. I am fortunate to be the leader of Bath & Body Works International, who's visiting the store today.
Okay. I'm Aishwarya from CNBC.
Tony Garrison, nice to meet you.
With over 50 stores across 25 cities and aggressive expansion plans underway, India is no longer pilot for Bath & Body Works. It is now scale play. When was the pivotal moment where India shifted from becoming a strategic play in your plan to more of a growth story there?
10 years ago, we were very fortunate to have Indians who had traveled and came back and said, oh, I love this brand. I've seen it somewhere else. Now it's their brand, and that's what we want to do, is make it an Indian brand for her. We have doubled the business every 5 years, and I actually see that happening faster. I could see us getting on a trajectory where we would double the business every 3 years. I think if you had asked me a couple of years ago, I said this could be a $100 million business. I think now we could be more of a $250 million business.
What are some of your top and high growth categories right now currently in India?
And throughout the world, you'll see a different mix in our categories between home fragrance, body, hand soaps. She loves our fragrant body care. She loves the body lotion for its moisturizing, and she also loves the fine fragrance mist, which is the #1 form here in India. Our opportunity will be to distort and focus on those categories. Men's has the highest percent of shop in India than anywhere else in the world, even in our domestic market.
While you're also expanding your stores, you're also leaning a lot towards quick commerce, which is a very India-specific phenomena right now, and also marketplaces. So how is that space looking for you, and what is the growth potential that you're noticing on that front?
I think it's going to be our biggest growth potential. Offline is high teen digits for us right now. Safe. I think that could easily be half of our business go forward. Not that it's going to take away from here, but I think it's going to be so much more of our business. I could actually see that to a 70-30 split.
Do you tinker with pricing, considering what the spending capacity in India looks like as compared to other markets?
Obviously, the product is all made, most of it's made in the US of A.
Correct.
So getting in here has a cost, right? So there's a slight, I'd say, pricing uptick
on that
from
side.
the US.
Will you think of bringing some manufacturing to India?
Bath & Body Works has over 2,500 stores around the world. And so by producing for 2,500, it allows us to be that affordable price point and accessibility. When you're producing for a single country, you obviously lose a lot of your economies of scale, et cetera. So when we get to that tipping point of where the volume is, it's definitely something we want to do.
What does the growth roadmap for Bath & Body Works looks like in the next 5 years?
So we have some new home fragrance collections that are coming out. We have some product lines that they'll have a fragrance element to them because that's who we are, but they are designed specifically for certain skin types. We have a new sensitive skin collection. We have a new hydrating skin program.
Is India already a profitable market for you right now, or it's building? It is profitable already?
We have a new thing that you might enjoy hearing about. We're going to call it a neighborhood store. So in different parts of India, you may not have 2,500 square feet store. You might have a 500 square foot store that allows you to have the core as well as our seasonal introductions.
And will that mean going deeper into not just the metros, but also the smaller towns in the country?
Yes.
Is that the idea
yes,
behind
that's
it?
my
Okay,
idea,
fab.
yeah.
India's beauty and personal care market is already a multi-billion-dollar opportunity, valued at $30 billion today and projected to hit $50 billion and beyond in the next decade. The fragrance market in the country itself is growing double in size as customers across cities and smaller towns increasingly spend on grooming, gifting, and everyday indulgences, making India one of the fastest growing markets for global brands. With camera person Gaurav Tyagi and Balbir Singh, Aishwarya Anand for CNBC TV 18.
Well, with that, it's a wrap on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.
Welcome to Indianomics. As of February 7, the US has removed the 25% penal tariff rate on India, and the reciprocal tariff on India falls from 50% to 25%. It will fall to 18%, we understand, in a week or so, as per the Commerce Minister. But in exchange, India has had to open its doors wider to all US industrial products and some agricultural products at lower or nil tariff. The details are still not public, but from what we know, what can be the impact on India's growth, India's current account deficit, the rupee, and of course, India's political standing? We are analyzing all this today with some of the best in the industry. Ajay Srivastava, founder of the Global Trade Research Institute, GTRI, Pranjul Bhandari, Chief South Asia Economist at HSBC, Mithil Kotecha, the Head of Currency and FX at Barclays, and Madhvi Arora, the Chief Economist at MK Global. Ladies and gentlemen, it's an even house. Thank you very much for joining me. Pranjul, let me start with the growth question. We did not struggle much on GDP when the 50% tariffs were present. Now that they have been reduced to 25, can we say that a GDP upgrade is in order?
Yeah, thank you for having me, Lata. I think so. We can talk about a GDP upgrade at this point of time. When we had the 50% tariff levied on us, our sense was that over 1 year, it could shave off about 70 basis points from India's GDP growth. I know that export levels hadn't fallen, but sequential growth in exports had fallen quite dramatically, and that could show up in growth over time. So now that a lot of this has been removed, our sense is that half of the growth drag has gone away. And I was earlier thinking growth could be closer to 6.5%, but now I think in the next year, growth could be closer to 7%. So definitely there's been a positive on growth from that perspective. But I would also want to say that there are indirect benefits as well. For instance, I think the heart of all the funk that we were seeing in India over the last year, where across the three asset classes, rates, FX, equities, India had underperformed, EM indices. My sense is the US trade deal had sort of become a catalyst. And to the extent it leads to a stable currency and therefore more stable liquidity, my sense is over time, all the three asset markets, equity, rates, and FX, will benefit from this. And of course, there is this final thing that India has once again opened its door to this China plus one theme, that FDI inflows that Vietnam and Malaysia was getting, but we were not getting. I think that's an important one as well. And the final one is services. We were all very worried. When will the focus move from goods to services? And now that we have a trade deal, it seems like services could be protected for a little longer, at least, from US tariffs. So I think on the whole, I would think it's a constructive move. Of course, we could have thought of a better deal, but the counterfactual for me is to live in a world where the tariff rate on India was 50%, and we were seeing what we saw in the last 6 months in markets and in the economy.
Okay, do you have a GDP number right away, or you say, have you upgraded it since the past week?
No, we don't upgrade that quickly, but and also we are waiting for some of the details because we want to do it a little carefully. Okay. But I would say I would go closer to 7% at this point.
From what? 7% to 7%
from about 6.6%.
Okay, so you expect some 30-40 basis points of upgrade. Mithil Kotecha, the rupee has behaved itself, and we've also seen FPI flows since the 2nd of February turn positive, very big on the first day, and thereafter, a minor positive. At least we have not seen big sell numbers. Do you think that there is some lasting relief to the fall of the rupee?
I think there is some relief, Lata. And again, thanks for having me on the show as well. I think the reality is that the lack of trade deal had been something that had been weighing on investor sentiment towards Indian assets for some time. And as you heard, it resulted in underperformance. But again, it is constructive that we've seen some inflows. Probably a little disappointing that we're not seeing more. And I think there are still concerns when we speak to investors about valuations of Indian equities, plus the, I guess, relatively low AI component of the equity market, which could still see some reallocation from India. And so I think that's still structural issues that may need to be resolved to get a substantial inflow back in. But it is more constructive that we're seeing some of that flow. I think for the rupee, we still continue to maintain this gradual depreciation path. We saw the rupee rally fairly strongly on the day of the trade deal announcement, and that wasn't surprising. We'd been expecting a 1% to 2% move. But for now, I think what we're starting to see that dollar buying coming back in. And I expect that to continue in the next several months. So I don't think this suddenly means a turnaround in a rupee, but it probably also means on the other side that we're not going to see any sharp drop in the currency, but rather a gradual depreciation path. We continue to maintain our forecast of 94 that we've had for some months now by the end of this year.
94 by end of 2026. Okay, so that means the yearly 3% continues, maybe even more than that if you're counting from 90.7 where it is at the moment. We are looking at perhaps 5% depreciation according to you. Okay, Mr. Srivastava, your note was much more cautious and worried about the way the trade has panned out. As you point out, for us, it is 18% plus the existing MFN tariffs for our goods, whereas when US imports come, even the MFN goes away for them, the most favored nation tariffs. So would you worry that we will head to a higher current account or a higher trade deficit?
Two things are there. First, we have to understand that this current arrangement talks will beneficially affect only 55% of India's exports to the US, not all. These are the products which attracted reciprocal tariff. So tariffs were earlier 50% plus 3% MFN average, 53. Now they will become 18 plus 3, 21% MFN. But these are only 55% of India's exports. What about 45%? Of these 45%, 40% were goods like smartphones, petroleum products, which were tariff exempt for all countries by the US. They continue to do so. Remaining 5% were the items like steel, aluminum, auto products, where 50% or 25% tariffs are applicable on all. They will continue to do so. So the current announcements, they will positively impact only 55% of India's exports. Of course, they will gain this. All the sectors you are mentioning here, all the labor-intensive products, leather products, plastics, everything will be there. But we have to see not all products to the US. Second, there are news articles that US is allowing zero reciprocal tariff on tea, coffee, many fruits. No. US in November, from November 13, is allowing these products at zero tariff for all countries, not only for India. It's not related to this trade deal. And you talk about current account deficit. I say when you are going to buy, say, $100 billion worth of goods from US, up from currently $45 billion, of course, import bill will rise and current account deficit, trade deficit, everything is going to rise.
Okay. Yeah, we have to wait for that because this 100 billion looks like a stretch. And I guess we will be made answerable only after 5 years because it doesn't say 100 billion every year. It says 500 billion at the end of 5 years. So perhaps the tough questions will not be asked immediately. I will come to that in just a bit. But Madhavi Arora, first, the growth question. My own sense was that we did well even when we were under stress. Like for instance, the marine products went and sought new markets in China. And didn't succumb to the loss of markets in the US. Likewise, we spoke to the textile exporters. They have carved for themselves new markets in Europe. So therefore, do you think in the short run, we are going to get advantages first? And therefore, both growth and current account will be better off?
Hi, Lata. So you, as you rightly said, FYTD, our exports actually have been relatively resilient. We've seen almost 3% growth. With exports rest of the world actually rising 4% from September when we started facing the tariff hit, while the US exports actually dropped 1% over the same period. In fact, if you look at the US exports, ex-electronics are actually down 7%. So large chunk of the US-led exports are also electronics oriented. As you rightly said, a part of it is diversification, transshipment, looking for new markets, even companies also taking a hit on their margins to remain competitive globally, to give discounts to new markets, to be able to capture new horizons. So yes, the impact of exports was much lesser than most of it expected. And thus the growth impact consequentially wasn't too much. To be very fair, while US is around 2% of our GDP in terms of total exports, the net value add is not more than 1.2% of GDP as per our maths, which implies that since not the large chunk of the hit is visible at this point in time, any which way the growth impact owing to merely because of US wouldn't have been more than 30 to 40 bips. So that chunk would get sort of rebounded. So I agree with Pranjal that we may see around 40-50 bips in gain in our export, in our GDP forecast from 6.5%. But otherwise, to a large extent, India had started to sort of diversify away from the US. We were doing that any which way pre-COVID. It sort of changed the dynamics towards US post-COVID. But last 6-9 months, we actually saw, a very different export dynamics than most of us expected. And I think that even as we sort of have the deal with the US and with EU, we shouldn't be too complacent and continue to strategize our terms and maintain transactional flexibility with the rest of the world, while also pushing scale in few key verticals and working on export efficiency, because that is, I think, a big deal. As Ajay was also mentioning, that the deal is not just India centric. Everybody in the world is also sort of trying to capture this market. So India has to be smart enough to ensure that we are able to scale up in line with our so-called FTAs. We have to work on factors like fast tracking custom, logistic, port efficiencies.
Fair enough.
Lowering domestic costs so that intermediate costs and the cost
those are the longer term issues. I'll just come to that in a minute. But at the moment, I think you agree that there is going to be an improvement in the GDP.
The hit was lesser than what we expected, so gain would also be equally less. It would be probably 40-50 bips at best.
Okay. Mitul, I wanted to ask you, what are you picking up from foreign investors? Our main problem has not been our trade deficit or our current account deficit. In fact, in the last 12 months, they've been at historic lows. Couple of quarters, we had 0.7% of GDP, whereas for the better part of my reporting career, which is 3 decades, I have been reporting 2.5% current account deficit as a percentage of GDP. So it's not the deficit. It is just that even that minor deficit could not be covered by capital flows, which were turning hugely into outflows. Are you picking up that India can once again become an attraction for a variety of reasons? The deal overhang being somewhat reduced, plus the inherent attractiveness of both growth and a cheap currency.
Okay, I think firstly, investors do see this as a good deal. Obviously, it comes a lot later than hoped for, but nonetheless, it's better late than never. And the fact is that even compared to peers, the tariffs on India now are slightly lower. So that is seen as very good news. It was a big impediment for foreign investors, and I think this does help. But that, at the same time, as mentioned earlier, there are some structural issues with regard to the equity market. Even on the bond market flows, there's some disappointment about the delay, for example, in the Bloomberg Global Aggregate Index inclusion decision, which has now been delayed by 6 months. And so I think investors are still a little bit wary. Also, there's investors cite, for example, the budget and the increase in gross borrowing requirements, perhaps a little bit of a headwind to bond market flows for now. So again, look, I totally agree with you. India's not got a balance of payments problem. Investors don't look at it in any way that they did historically with big current account deficits and worries about financing that. But as you mentioned, even small outflows do have a big implication for even with a small current account deficit. And that's been the problem here. Unless India sees a resumption of strong inflows, it's going to be very hard for the rupee, for instance, to strengthen much from here. And I think that's going to be an issue. Look, on growth, India is still one of the, if not the fastest growing major economy in the world. This does, I agree with your other speakers, it does add more upside risk to growth, certainly at least around 30 basis points in our view. So it's positive in many respects. And I'm not even talking about the trade deals done with Europe and elsewhere, UAE, etc. So there's a lot to be positive about. But I think it doesn't necessarily mean you're going to see a stronger currency against this backdrop. And look, one thing I would also add that RBI is probably still wanting to build up its FX reserves. They want to keep competitiveness with China. At the same time, the forward book and NDF book still is rolling off, and that's still sizable. So it's very hard to see dollar INR dip much from these sort of levels.
Okay, no, I'm buying your point that, there's a gentle depreciation in order. All I'm asking you is the chatter among foreign investors. Have you heard of anyone? Because we've had 4 days of FPI inflows, albeit small, are you getting a chatter that people are turning positive?
Investors, the chatter amongst a lot of the institutional investors that I've been speaking to is certainly more welcoming. But again, I don't think it necessarily implies a sudden rush to jump into Indian assets.
Okay. Well, I will have to thank you on that note, Mitul. Thank you for joining us. But I'm going to keep Pranjul, Madhvi and Mr. Srivastava for a few more longer-term questions on the economy and on the political economy. Back in a minute. Welcome back to Indianomics. We are discussing the impact of the US-India trade deal, the details we know, and their impact on Indian macros. I've been speaking with Mr. Ajay Srivastava of GTRI, Pranjul Bhandari of HSBC, and Madhvi Arora of MK Global. Ladies and Mr. Srivastava, thank you very much for waiting on. Mr. Srivastava, your worries are more of a political economy nature. Can you explain to us? You are worried that we may lose our autonomy in terms of non-tariff, I won't call them barriers, non-tariff standards, quality standards. We may have to adhere to US standards. Tell us, what are your fears outside just tariffs?
The deal is not about trade and tariffs. I will say it's just 1/3 part of the deal.
Okay.
Most of the part of the deal, they deal with India removing all the limitations on the digital trade, aligning its security policy with the US, and of course buying $500 billion worth of goods from US. And the worst is that we almost lose our energy policy independence. Of course, US is saying that India has agreed to not buy oil from Russia. There is no yes or no from Indian side, but US is very clear that if we start buying oil from Russia, they will reimpose 25% tariffs or even more penalties may be there. Now, these things have many ramifications. First, let's talk about aligning with the US interests. We have to know at this stage, it's just the outline, just the framework. It will be translated into hundreds of pages of legal text. I was reading the US-Malaysia trade text, and I find the seeds of that in this framework agreement. So it says that India and US will align their actions on the third countries with non-market economies. That means it's a clear reference to China. On one hand, China is the number one buyer of oil from Russia, and US dare not touch China by imposing duty or any things. And they are trying to be on good terms with China through many trade deals, but they want India to follow these things.
Pranjul, I wanted to get to the other idea of growth. In any case, a Harley-Davidson at 150% or 50% was not a challenge at all. It was not something that was threatening Indian two-wheelers. Even if it came at the face value, would it really hurt us? We still don't know the duties on many of those products. But my point is that import competition in the past only made us stronger. So would you worry that we will be seriously impacted on any industry?
Lata, I think we will be. And it's also possible that our imports will rise. It's possible that our trade deficit in the short run will also widen. But I want to really take that step beyond all of this and say that this is a growth path that India has currently chosen. It's not just about the India-US trade deal. It's about the package that India is right now signing up for, signing more and more trade deals like we've done with EU and several others, trying to right-size our customs duty, being a little bit more open to FDI, also softening our relationship with China to the extent we can. My sense is all of this is giving an indication, which was very clear in the Economic Survey of India, that we really want exports at the center stage of our growth strategy. All of the economies who have gone down this path, Vietnam, Malaysia, in recent times, in the past, China, they all have seen their imports rise. But on the top of it, they've also seen FDI rise, other inflows rise, manufacturing a lot more, yes, importing a lot, but also adding value and exporting. So we are signing up for that. And I think that's the right thing for us to do at this point of time. Just want to take a side step. We've been asking for 10 years, where is private capex? We've done everything. We've cut tax rates. We've done public capex to crowd in private capex. We've cleaned up our balance sheets. But where was this public capex? Why wasn't GDP as a investment as a percent of GDP rising? My sense is we were not taking exports seriously. And I think we have a great opportunity. One last point, which is very interesting, is that we are not just a goods exporter, we're also a services exporter. And today, in a world of hybrid goods, where even cars are more like software on wheels, I think if we can make as much effort for goods manufacturing as we've done for services trade, I think we will be very well set for a world of hybrid products going forward.
Well,
So
that's Pranjal, I'll have to cut you off because there's absolutely no time. I just want quick answers from you and Madhavi. Madhavi, your current account deficit, forecast for the current year and your rupee forecast. I mean, as of March and December 26.
So Lata, for this year, we were looking at CAD at 1.1%. I think it could probably go down to a 1%. We're not moving that number too much. For next year, we were looking at a 1.2, 1.3%.
And the rupee?
And again, taking modest export growth, ex-US, which I think would have an upside risk at this point in time. I think, as you rightly said...
No, Madhavi, only rupee. No, Madhavi, we don't have so much time. Madhavi, we don't have so much time. Rupee.
So INR very tricky. I don't think any of us would actually get it right, even though I would try to sort of play the range. I think the move away from 89 to 91 plus 92 was largely speculative. I don't think we really have a massive downside on this. So I don't think we'll go really below 89.
Fair enough. I'm sorry, I really have to cut you off. We don't have that much time. Pranjal, just two numbers, current account deficit and rupee as of March 31st and December.
So annual CAD at about 1% of GDP and dollar rupee at 90-91 range.
Okay. For the entire year, 26?
That's right, yes.
Okay. All right. So we had a more pessimistic or at least a depreciating forecast from Mithul. But the women, the ladies think that it's more likely to be 90-91. Mr. Srivastava, you've raised some very important long-term questions, but I'm hoping that the shifting geopolitics will make all these issues also evolve, and it may not be that dire in the end. Thank you very much, Mr. Srivastava, Pranjal and Madhavi for joining me. That's it on this edition of Indianomics. Thanks for watching.
Hello and welcome to CNBC TV 18. India and the United States have finalized a joint statement whereby the two countries have agreed on an interim trade agreement, due to which the United States will reduce tariffs on Indian goods from 50% to 18%. To decode the fine print of this trade deal, we're joined by Commerce and Industries Minister Piyush Goyal. Minister Goyal, thank you very much for being with us.
Thank you.
So the joint statement is done. I think investors, exporters would now want to know, when does the 18% tariff rate become effective?
Since we had the weekend, Saturday, Sunday, after the joint statement was issued, I would suspect any day during this week, the executive order to reduce tariffs to 18% should be coming out.
Right. So does this mean that with that executive order, the rate would immediately come down to 18% in the federal system?
Right.
Would it require a signing?
It would require a signing by the Honorable President of the United States of America. But now, having entered into the framework agreement and all terms being finalized, I see no difficulty in that.
Right. So are you also expecting a visit from the United States to somehow jointly announce this deal, or are you going to US?
We will have our teams now put the entire documentation in legal format so that we can sign the interim trade agreement or the first tranche of the bilateral trade agreement, for which I have invited the USTR, the United States Trade Representative, my good friend, Ambassador Jameson Greer, to visit India. He has indicated that he would accept the invitation, and maybe mid-March sometimes he would be visiting India.
All right. So for exporters, for Indian exporters, that would be the date possibly when the new tariffs would become effective?
No, the 18% would become effective immediately. There are other areas of concessions, some areas where we've got a zero reciprocal tariff. Those will become effective after the execution of the interim agreement.
Right. Now, over the last 1 year, there was uncertainty about the trade deal, and that was impacting investor sentiment towards India. The stock market sentiment also was impacted to some extent. What would be your expectation now?
Well, Indian economy powers on. It is the fastest growing large economy. Companies are reporting huge demand. January performance numbers should come out quite well in terms of the volumes. Recently, I was told steel mills are working at full capacity. I was told auto stocks are all sold out. There's no inventory at the dealers' end. Cement stocks were down to just about under a week or a few days. I mean, the indications which I have received from the market sources or public from industry, which clearly reflects that there's a good amount of enthusiasm in the marketplace. The execution and finalization of the EU trade deal coupled with the US trade deal coming in quick succession of each other, I'm sure will give a big fillip to the India growth story.
All right. Now, as far as the concessional rate of 18% is concerned, what would be the volume of the goods? If we ask you to quantify that, what volume of Indian exports going to the US will be now subject to a lower 18% tariff?
First of all, there are many goods which will get zero duty tariff. Some are already going at zero duty, some more will come at zero duty. In the aggregate, my sense is about half the exports will become zero duty, zero reciprocal duty in terms of tariffs. On the other half, almost 10 or 15% would probably be sectoral tariffs, which for steel, aluminium, and products and derivatives of that, in some cases could be as high as 50%. But then they'll have to look at how much is the steel or aluminium content, and accordingly it will be a calibrated or a calculated import duty as a Section 232 tariff, not as a reciprocal tariff. Everything else will be at 18%.
Right. How do India's labor-intensive exports benefit from that? Because majority of them will now be tariffed at a rate of 18%.
Well, they will benefit hugely. And it's not that majority of them will be 18%. Many of them will even be lesser. I see a great fillip in the textile industry.
Let's talk money.
Hello and welcome to another edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Gold and silver. These metals have been in the headlines for the past many months, in fact, for perhaps the past 1 year. But what's really interesting is the way Indian investors have taken to investing in gold and silver via the ETF route, exchange-traded funds. Now, exchange-traded funds and commodities are nothing new in the Indian landscape. One of India's mutual fund houses, Nippon MF, set up, in fact, a gold fund as way back as about 18, 19 years ago. So this is not a new instrument, but what indeed is absolutely startling is the kind of money that's now pouring in these precious metal ETFs. In the month of January, by the way, gold and silver ETFs combined pulled together 33,000 crore rupees. That's more than the money that investors put in all equity funds put together in the month of January. So that's the kind of market we're in. The question is, should you be chasing returns? Should you be waiting for dips? And whenever you want to diversify and add some precious metals to the portfolio, do ETFs make the cut? Are they indeed the best option? Well, we'll be talking about all of this, debating and discussing some of these trends and points. And I have with me Mr. Vikram Dhawan, who is a fund manager and head of commodities at Nippon India Mutual Fund, and Nasir Salim, managing director at Flexi Capital. Gentlemen, thank you so much for joining in. And Vikram, thank you very much for being with us and taking this head on. Because, like I said, Nippon in some sense defined the category well ahead of everybody else in the market. So I'm glad you're here because I'm sure some big tough questions are coming your way looking at the inflows that are going into those ETFs. So let's get your opening thoughts first.
Well, thank you very much for inviting me on your show. Well, while we are very flattered on the kind of development which has happened in this space, but just to share a few data points that out of the $4-5 trillion holdings of Indian household gold, we are just not even $4 billion. Even in the AUM of mutual funds, we are barely 3%, 4%. So I think it is still very early days as far as the gold ETFs and silver ETFs.
Point you make, Vikram, because yes, Indians have always invested in gold, but investing in gold through a financial channel, that's a more recent trend, right? The thing is that I think as the price appreciates and because equities underperformed, it seems to be accelerating that trend. Do you agree?
I think what has happened is that since we are a very important developing economy in the world, and there's been a lot of focus on the risk assets like equities, both overseas and in the Indian market, and the concept of asset allocation still is fairly niche in India. I mean, just to give you an example, the AUM of the multi-asset funds will be like 2 to 3% roughly of the total AUM. But if you go and see the similar AUMs, let's say in Europe or America or developed market, it is many times of that. I mean, in certain market, the asset allocation funds account for roughly 10 to 15 or even 30% of these strategies. So I think this is the what you can say the dawn of asset allocation, where people have realized that to generate wealth on a long-term basis, you should not put all your eggs in one basket. So I think that's where gold ETFs and silver ETFs are gaining traction.
Absolutely, and the price kind of displayed how true that thought process is, right? Because in 2025, it was all about these precious metals when equities were struggling, especially here in India. Let me bring in Nasir into the conversation as well. Nasir, I was looking at some data which was put out by the World Gold Association. We'll get those graphics up for your, for our viewers on the screen as well. It's staggering. Gold made 53 new all-time highs in 2025. So there were 53 days out of 365 days where gold was constantly touching a fresh all-time high. And I think these headlines were enough to draw investors in. What have you made of this big gold rush?
Well, clearly, firstly, thank you very much, Subhi, for having me on your show again. Great to be back. But to your question, I think, my simple answer is FOMO, right? There is a lot of fear of missing out that we've seen in terms of participation. Look, from the asset allocation perspective, Subhi, there is no doubt, and I agree with Vikram, that, there is an asset allocation discussion today when we sit with clients. it's a clear discussion of saying you should have 10 to 15% allocation in commodities, for example. And within that space, obviously, you get in commodity ETFs. There is, gold, for example, which is now being allocated. And I think that is something which is imminent and has always been the core, right? It's also a natural hedge against inflation. And also, a lot of Indians, I must tell you, cannot participate in dollar return assets as conveniently as possible. Of course, there are many avenues opening up. And therefore, gold comes in. So I think a lot of the appetite today you see is also on account of this sudden demand. Obviously, it is also being followed up by central bank purchases, and that continues to make these new highs. But of late, what we've seen is that the asset allocation model is going for a toss. And as people like us, as experts, we try to tell our clients that we can't be chasing FOMO because of these sudden hikes that we see. As you rightly said, multiple hikes in the last 365 days. Also, boards a little bit of caution. But the case is obviously that when anything goes up euphorically, it attracts a lot of attention and obviously leads in with FOMO appetite.
Oh, absolutely. So, gentlemen, before we talk about the way to invest and if this is the right time, do you wait for dips, etc., and which is the right instrument? Before we get into that, Vikram, since you track the commodity itself, the underlying commodities, 25 has been a stunning year in my memory as well, recent memory. Copper was going up. I mean, there was demand for aluminum and, of course, gold. And then silver caught on. And silver completely eclipsed the gold rally. Now, people are rushing in. And January data, Amphi data tells us that people are following the headlines and they're coming in. But just purely as someone who understands commodity cycles, would that be a bad strategy if you come in now and suddenly decide, oh, I need more gold, I need silver in my portfolio? Not necessarily as an informed asset allocation call, but more simple return chasing.
See, we'll be leaving at least two problems for the next generation. One is the climate and second is the debt. If you look at the debt load in the world today, the global debt is about $360 trillion, out of which the sovereign debt itself is more than $100 trillion, which used to be about $20-30 trillion 25 years back. So we are adding anywhere between $4 to $5 trillion in sovereign debt every year. And there is no political will to either counter climate or higher debt. Now, gold is a straightaway hedge against debt, overload. Why? Because gold is one of the very few asset classes which doesn't have a credit risk. So it is basically an antidote to high debt loads. Silver, since 2024-25, one of the hottest years on record. And I think if you're traveling across the world, you'll see the summers are getting a lot hotter across the globe. So there, I think, as again, there's no political will globally to address that, which means that how do you hedge yourself against some sort of a climate challenge or a crisis, which may not happen. I mean, a debt crisis or a climate crisis is not going to happen next Monday or even next year also. It is something which we'll be leaving for the next generation. So how silver fits in? The more the climate challenges rise, the more you will have to invest into renewables. And silver is a proxy for the green tech. So I think for people looking for building portfolios for generational wealth, it is absolutely a straightforward asset allocation. But for somebody who's looking at horizons of three weeks or 3 months, I would say if you're looking towards gold and silver from tactical point of view, I'm pretty sure there are other shows in town that you would like to vis-a-vis gold and silver.
That's a really important statement coming from someone who's understanding commodity markets for years, who's been sort of tracking these trends. So right now, I take your point that at a long-term fundamental level, there is a strong case for gold. There's even a case for silver. But right now, is the market overheated? Right now, is there still a lot of froth in the international and in the Indian market?
So I think, from the asset allocation point of view, again, we don't treat it as standalone security. It is part of the multi-asset, investment strategy, if you would like to call that. So from asset allocation point of view, it's never a bad time or a good time to put gold and silver. What's more important is discipline.
Okay. All right. Fair enough. So we've understood the basics of how to invest in these commodities. They're not for the faint-hearted and maybe not for someone who's looking at a quick trade in and out. With that important lesson under our belt, let's take a break. On the other side, we talk about ETFs. Are exchange-traded funds perhaps the best way of investing in precious metals? The debate continues after a break.
Let's talk money. Let's talk money.
Welcome back. You're with us on Let's Talk Money. And this week, we're talking about the huge surge in inflows in gold and silver ETFs. Indians are making a beeline for these products. Is this the right strategy? What are the do's and don'ts you must keep in mind? That's what we are discussing on the show. Nasser, I want to come to you now. We all know that ETFs are a very cost-efficient product, right? Whether it's commodity ETFs, equity, any form of ETFs. But, ETFs also came in the news for the huge premium and sometimes a discount. Extreme volatility in the prices, particularly some of these commodity ETFs in the last few months. What did you make of that and how do we wrap our head around it?
Very good question, Sabri. I think in the early of 2026 also, I must tell you, many silver ETFs in India experienced steep intraday declines. In some cases, actually down up to almost 21%. As bullion prices corrected from record highs. I think gold ETFs also saw some significant declines, with many sliding in the single digit to low digit, double digit percentage, close to around 7%. I think these moves were driven, by global market forces. And I think ETFs, by and large, are sold on the stock exchange, right? So their market price depends on demand and supply. The underlying value of an ETF reflects, such as gold and silver, is basically on account of 3-4 main reasons, right? And that's when there's any mismatch that happens. Commodity prices moving sharply in global markets. Many investors then tend to also buy or sell at that same point of time because they want to avoid panic. Market makers also are unable to create or redeem units quickly. Now, some of these, and then again, of course, global commodity prices. Prices exchange, after Indian market hours. That's also a very, very important point. So, they change after Indian market hours shut. So I think in some of these situations, ETFs can temporarily trade at a premium, which are usually higher than the NAV, or at a discount price which is lower than the NAV. So I think that's one of the main reasons why we've seen a lot of steep premium or discounts to the underlying commodities.
So let's understand this. Vikram, join on this because, see, if I'm investing in commodities, I know I'm taking some risk. So if silver crashes 8% in US overnight action, if my ETF falls by 8%, I'm okay. It's part of the risk I've taken. I start worrying when my ETF price is down 15, 16%. Or the reverse, sometimes the premiums. I mean, just because there's maybe so much of FOMO, I realize that the price of the ETF is moving at a pace which is far higher or steeper than the price of, say, gold or silver itself. Why are these anomalies happening? Are they frequent? Are they one-off? Should we expect more of them? What should we be, aware of as investors?
Sure. So the regulations are very cut and dry as far as the gold and silver ETFs are concerned. The gold and silver has to be held within the geographical constraint of the country, which means so underlying for us is physical metal in the Indian market. So we are the price discoverers of the physical metal in the market, because in absence of an official spot market, ETFs are actually giving you price discovery of the physical market. I'll tell you why it happens.